worth more than ever. Look, if you're listening to the Bitcoin Wizard, you are probably bullish on Bitcoin or MSTR, and you probably think there's a good chance that these two things will be the best performing assets over the next 5 years. Well, guess what? What if you could get more than half of that upside with your full principal being protected? Yes, that is what my friends at Solana.io are building. Every dollar of your investment being secured by a title insured recorded lien on US real estate. You split the upside with the property owner whose home equity backs your own investment. If you've been waiting for a way to buy Bitcoin or MSTR that lets you sleep at night, my friends at Solana are waiting for you right now. Scan the QR code or go to Solana.io/capital to get started today. Also, this cold card hack has pretty much rattled everybody when it comes to Bitcoin in self-custody. That is why I recommend my friends at the Bitcoin Way, who will help you on your journey to be a sovereign Bitcoiner so you can take 100% self-custody and feel secure in your family's financial future. You can run a node, you can be your own bank, and they will train you to become a sovereign Bitcoiner using only the best open source tools. Go to the bitcoinway.com/Adam or scan this QR code right here to schedule a 100% free introductory call. Do not delay, your freedom depends on it. Now, our modern American, I'm assuming that you are a modern American. If you're not an American, you probably are, living in close to the same situation if you are living in the midst of a government issuing fiat currency. You did everything the right way. You did what you were told. You attended college. You answered your emails during dinner time. You completed cybersecurity training. You praised your company's values. And then you learned that financial stability requires 2 full incomes and 3 side hustles and 1 dead grandparent that you can get an inheritance from and a regional bank who is willing to describe 40 years of debt as home ownership. Did you know that the real median household income reached $83,730 in 2024? After decades of technological miracles, the median household gained the ability to watch a refrigerator live stream its own contents while debating whether dental work qualifies as a Christmas gift. Since then, we have seen productivity only rise in our economy. Software ate the entire world. Executives discovered stock-based compensation, and ordinary workers, well, they received an employee wellness portal. And that employee wellness portal actually offers a breathing exercise called accepting organizational change. Meanwhile, modern American adulthood resembles a CAPTCHA designed by Satan himself. Select every square containing affordable health care. Select every square containing affordable childcare. Select every square containing an affordable home. Incorrect, incorrect, incorrect. Every single time, every single day throughout your life, you are failing the CAPTCHA that was created by Satan himself. Prove that you are human by identifying which medical bill belongs to which insurance deductible while a collections agency plays smooth jazz. People hear these complaints about our modern life, and you know what they do? They blame laziness. Apparently, the generation working through lunch and commuting with a podcast at double speed and selling old electronics online, well, they simply lack the grit required for success. A retired man who bought his home for the price of a used Ford Focus, he will explain discipline from a kitchen containing $600,000 of accidental appreciation. This is the situation that Bitcoin has entered. Bitcoin is entering this humiliation ritual with a brutally simple proposition to you. Your labor, your finite life energy, your hard work, your blood, sweat, your tears, and your urine, it deserves a monetary container whose supply cannot expand because a committee felt nervous about the economy. Every single paycheck converted into Bitcoin becomes a tiny act of refusal in this clown show. You performed the work. Those hours are gone forever. You are going to die, and your lifespan is finite. The result of your life should remain scarce after the meeting ends. Since 1971, yes, let's go back to August of that month. So what is that, 55 years ago? The CPI, the Consumer Price Index, it has risen more than 8-fold since then. Put differently, the dollar has lost 88% of its purchasing power against a basket that is fake and manipulated by the government. Yes, the numbers that are wrong, the numbers that they are lying to you with, they are literally that bad. They're not even telling you you the full story and your purchasing power has been utterly destroyed. Inflation receives the public relations treatment of a chemical spill that is sponsored by a regional hospital. Prices rose, the supply chains adjusted. Remember, the consumers, they remained resilient. Nobody says that your measuring stick was totally destroyed, do they? Last time I checked, a tomato didn't hold any emergency meetings, or the ground beef that I want to buy at the grocery store, does that have a central bank? Does your barber? The barber never discovered quantitative easing while trimming your neckline. More currency units chase scarce goods, asset prices continue to absorb the flood of the paper currency that continues to be printed, and the wage earners are invited to celebrate our small nominal raises year after year that purchases fewer groceries and maybe one additional streaming service filled with documentaries about the societal collapse that we are witnessing. And then the responsible adults like you and me, what are we doing? We are delaying our consumption. We are building our emergency funds. We are watching the reward of our hard work decay like lettuce trapped in a warm sedan. The debtors continue to receive their refinancing options. The asset owners, they get their tax advantages. The politicians, they of course receive the magical ability to spend today. And then of course, after spending today, they mail the invoice to citizens currently learning long division in 3rd grade. And this is why you need Bitcoin, because Bitcoin, it makes this monetary vandalism visible through contrast. There is a contrast that appears when you price the things that you want in harder money, in a currency that can't be printed or debased. The price swings in Bitcoin, they are loud, they are vulgar, they are impossible to miss. The fiat decay of your life, that thing arrives quietly. And it's always wearing a navy suit, and it's carrying a binder, and it's asking you whether you have considered a diversified portfolio of things already inflated beyond your reach. National home prices have climbed 54% from 2020 into 2026. Home values now hover near 5 times the median household income, far above the ratios common in the 1990s or even the 2000s. The homeownership rate for households under 35 is sitting at 35% so far in mid-2026. That, my friends, is pathetic. A starter home has evolved into premium content. The young couples who are out there browsing Zillow, they browse Zillow the way that medieval peasants viewed paintings of heaven. They get emotionally moved. They are vaguely suspicious, and they are fully aware that admission depends upon their death. We live in a pathetic society because housing has become money, because money became terrible housing for value. Capital fled into land and apartments and vacation rentals and lake houses and beige suburban rectangles containing the same gray flooring that were installed by a contractor named Cody. Every single house now carries 2 identities: shelter for a family and leveraged inflation hedge for a man who says doors instead of properties. You know what kind of scumbag I'm talking about. And that is because in our society, political incentives, they form a hostage negotiation. The existing owners of the homes, they require the higher prices, therefore they demand them. Young families, though, they need the lower prices. The banks, they require collateral stability. The municipalities, they enjoy the rising assessments, absolutely. And then on top of that, you have the builders who are facing land, labor, zoning, and financing constraints. The elected officials, separate from all of those people, what do? They promise affordability while praying that nobody's home value falls before this November. Then you have the rents consuming record shares of household income. Millions of renters are spending more than half of their earnings merely remaining indoors, preventing their lives from being lived underneath the highway overpass. And then we have society asking us why marriage and children are arriving later, as though a second bedroom can be manifested through positive thinking and a meal prep subscription. Bitcoin is offering the scarce property to you without bidding against a family for a roof. It's storing the monetary premium in digital cyberspace rather than forcing every bungalow to function as a retirement account and an inflation hedge and a college fund and an emergency reserve and a shrine to the holy fixed rate mortgage. You need to picture a future where houses return to being houses. That is the future that Bitcoin is going to give us as it absorbs the monetary premium from the other asset classes. That possibility can only begin when people gain access to an asset that has been engineered from ground zero for saving, rather than stuffing 40 years of anxiety into drywall and granite countertops. And you know, it's no big deal. We're just casually gonna reach about a $40 trillion of national debt. You know, the deficit approaching $2 trillion. Who even cares? The net interest expense on our debt is going to be double our defense spending by 2036. Do you remember when it was a big deal when the interest was going to supersede our defense spending? In 10 years, it is going to be double. Do you realize how ridiculous this is? This isn't me. This is the Congressional Budget Office. They are looking at $1 trillion in interest today and $2.1 trillion by 2036. It's more than double. So America is spending $1 trillion a year remembering their own previous spending. The interest bill has become a federal agency with 0 employees, 0 building, and somehow perfect attendance. Isn't that funny? And both parties right now, the Democrats and the Republicans, they have discovered this sacred democratic formula. Voters, they enjoy their benefits, they dislike their taxes, and they rarely inspect maturity schedules. You have one political coalition, what are they promising? Unlimited programs. And then the other one, they are promising unlimited programs, but there's a little bald eagle on the invoice. Every single campaign ends with someone vowing to restore economic sensibility. We're gonna balance the budget. After, of course, one final emergency involving bridges and missiles and tax credits, farmers, semiconductors, grandparents, or a factory that nobody has visited since 1987. And the arithmetic is just gonna grow increasingly feral. The higher debt is going to create the higher interest. This is the way that math works. Then that interest is going to create larger deficits. And then those larger deficits are going to require more borrowing. And then eventually the government must tax harder. It's going to repress the yield. It's going to cut promises. It's going to debase the currency even more. Or it's going to combine all 4 of them inside legislation that is named the American Prosperity and Grandchildren Appreciation Act. The bondholders of the government debt, what are they thinking right now? They want repayment in valuable dollars. That's hilarious. The bondholders are getting return-free risk when you adjust for the debasement of the currency. The retirees, they want their benefits preserved. The workers want lower taxes. Asset owners want liquidity. The defense contractors, of course, these people, this lobbying group, they want civilization to remain extremely eventful, let's just say politely. The politicians just want Tuesday afternoon to pass without a difficult vote. So are you starting to see what Bitcoin is going to provide society? It is giving us away. It's supplying us with this monetary constitution outside of the warped satanic incentive swamp. The rules of Bitcoin, last time I checked, they lack a campaign donor category. Miners can propose whatever fantasy they enjoy. The nodes enforce validity. Desire carries 0 legislative force against consensus, and that, my friends, is probably the most beautiful thing ever created. A lot of these terms, they're boring to people. Yeah, 100%. Not everybody can get into Bitcoin because these terms sound boring. But during fiscal decay of our lives, boring starts to become erotic. A supply schedule immune to campaign season? Well, that may be the most radical piece of infrastructure on planet Earth. We have a civilization that is now too expensive to reproduce. We are in a population death spiral. The United States recorded roughly 3.6 million births in 2025, and yet fertility fell again. Culture, marriage, education, technology, and personal choices. All of these things matter. At least they matter to any sane person. Economic insecurity still sits in the room like a sweating insurance salesman, pretending nobody can smell him. Last time I checked, starting a family requires confidence in the future. Modern adults, well, they receive a different invitation. Please produce children while housing costs 5 times your household income. Childcare resembles private school tuition. Health insurance communicates through riddles. And student loans, of course, they follow you with the emotional persistence of a Victorian ghost. I don't even know why people take birth control pills anymore. You don't need to. Just open the mortgage calculator. You know, it's easy to be romantic with your spouse when you have candles and music and wine, but then your passion encounters a daycare estimate and then it fizzles out. And then all of a sudden you're divorced and you're living in the basement of your mother, and then your ex-wife is now dating her Brazilian jiu-jitsu instructor. You see, a society capable of planning generations ahead would protect saving, and then it would reward family formation. And then it would create confidence that patient work accumulates into security for our nuclear families. Do we have that today? No, we don't, because we live in a society that is a pathetic, sad joke. Our particular arrangement that we're living through right now, unfortunately, it's rewarding leverage and consumption and the proximity to newly created money. Our households, they are performing increasingly elaborate financial acrobatics simply to reproduce at replacement levels. Get out of here. Civilization can only survive through people willing to plant trees beneath whose shade they will never sit. Hard money gives those people soil instead of a disgusting quarterly earnings call. In addition to that, roughly half of Americans, they report loneliness. How sad. We possess unlimited communication and the social cohesion of passengers fighting over the final charging outlet at an airport gate. Every person alive today is carrying a device that's capable of contacting nearly everyone alive, but most everybody is using their device to watch strangers argue about seed oils beneath a video of a raccoon stealing cat food. Trust collapsed because institutions repeatedly demanded faith while changing rules according to incentives. Banks protect you until compliance freezes the account. Platforms support expression until an advertiser develops heartburn. The governments are protecting our purchasing power with the precision care of a golden retriever protecting an unattended rotisserie chicken. And the public senses it. You know, the people out there, they trust Congress and the media, the banks, corporations, the universities, all of these institutions about as much as gas station sushi during a thunderstorm. Yet, 40 years of labor still rests inside promises that are issued by these exact same institutions. Bitcoin introduces verification as a cultural weapon to this disgusting madness of hell. And this is why Bitcoin is your revenge mechanism, my friends. You simply stop storing your future in a unit designed for a managed decline of your life. Bitcoin converts labor into scarcity. Every single sat represents a fragment of human time carried into an asset with a fixed terminal supply. Your boss can go ahead and create additional meetings. Congress can create additional currency. Your university can create an additional credentialed required for the job that you already perform. Nobody can manufacture another 21 million Bitcoin because a consultant described the quarter as challenging. The Bitcoin network separates money from political appetite. The leaders, they can continue to desire this expansion. The banks can desire rescue. The markets can desire sedation. The Bitcoin protocol remains spectacularly indifferent, like a house cat watching its owner experience a tax audit. Exit becomes possible without conquering the capital city, my friends. We don't need an election victory, or a lobbying firm, or a revolutionary committee, or dinner with the deputy secretary of monetary disappointment. Purchase sats, learn custody, protect your keys, and continue living, my dearest little goblin rats. We have a technology that's enabling saving to become rational again. A healthy civilization needs people who can carry value across time without becoming leveraged amateur hedge fund managers. When cash decays, everyone gets shoved toward debt and speculation and dependence. Bitcoin allows the ancient behavior of producing more than you consume and preserving the difference. Patience gains teeth. The bear markets of Bitcoin, what do? They just transfer the coins from the tourists toward the people capable of enduring sheer ridicule, boredom, and the sudden expertise of coworkers who bought an index fund 9 months ago and think they're cool. Volatility feels cruel because the network refuses to provide emotional customer service. Your revenge arrives very quietly each time another paycheck escapes dilution. There will be no parade that follows. The bureaucrats will sign zero release papers, but your balance, your finite, valuable human energy, it will update on the ledger beyond all of their permission, and the future of you becomes slightly harder to confiscate. Bitcoin is more important than ever. Don't be an idiot. Buy Bitcoin and retire your bloodline. My name is Adam Livingston. I am the Bitcoin Wizard. If you like this content, please like this video. Subscribe to the channel on YouTube. That way you can support me spread the orange gospel of Bitcoin to the masses. Have a very terrific day, everybody. Do not party too hard, my dearest little goblin rat children. Class dismissed. This video is sponsored by Solana, and if you are interested in gaining Bitcoin upside while keeping your principal protected, Solana may have built the most aggressively bullish product available for people who still enjoy sleeping at night. Yes, you as an investor can receive 50% or more of Bitcoin's appreciation with uncapped upside, while the structure is backed by the Bitcoin position itself and a lien on U.S. investment real estate. Basically, Solana is putting Bitcoin in body armor. You still get the moon math, while your principal has a rental property standing behind it with a baseball bat. If you are interested, scan the QR code or use the link below. Solana will help you every single step of the way. They will answer your questions and explain exactly how the structure works. Requesting information carries zero obligation or commitment. Go to solana.io/capital to buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it. Good day, everyone. Happy Monday. My name is Adam Livingston, and I am the Bitcoin Wizard. Well, I just gotta say, Bitcoin is inevitable. Victory is upon us, and therefore, strategy is going to win. If you guys want to hear the most bullish Bitcoin case ever, if you are bullish on MSTR, please do me a favor, like the video on YouTube right now and subscribe to the channel. I am bringing you killer updates every single day. And we have a massive one today because strategy just sold more Bitcoin. They just sold more MSTR and they bought back STRC. That's correct. They have stated that their goal is for Stretch to trade between $99 and $100, and they are zeroing in on that goal by any means necessary. They added $250 million to the USD cash reserve. Now they are sitting on 2.3 years of dividend coverage in cash, and the bears are out in the street, bloodied and depressed that they are wrong yet again. I keep waiting for the death spiral, but unfortunately, it's not here yet. I was promised a structural cascade as soon as Strategy sold their first Bitcoin, but what do I see? I see Bitcoin going up today, kids. So basically, the MSTR bears out there, they have built this entire theology around this one assumption that today's pain continues forever. But guess what, kids? We are 10 months into the Bitcoin bear market right now. That's correct. You remember we hit a Bitcoin all-time high on October 6th, 2025. It's been just about 10 months from then of Bitcoin going down. And unfortunately for the bears, none of them actually do any math. Have you noticed this? Literally zero of them. They just spread AI slop, this doomer boomer nonsense. The bears have their 47 quote tweets and their Monster Energy drinks, and they think that they're a better crypto trader than Michael Saylor. These people are totally clowns. Now, the subject of today's video is, can strategy, with this capital markets activity, can they buy enough time for Bitcoin to go back up? And I have two very specific Bitcoin indicators that are ushering in a Bitcoin bull market. That's correct. If you are a Bitcoin bull, you are going to love this news. And if you are listening to the Bitcoin chicken, gizzard, lizard, wizard, I just got to say, you are probably very bullish on either Bitcoin or MSTR. Now listen to this. My friends at Solana can give you more than half of the upside with full principal protection. That's correct. If you already think that Bitcoin or MSTR can be one of the best performing assets over the next 5 years, what in the world are you waiting for? My friends at Solana can give you every dollar of your investment secured by a title-insured recorded lien on U.S. real estate, so you split the upside with the property owner whose home equity backs your own investment. If you've been waiting for the right time to buy Bitcoin or MSTR and lock in a 5-year position that will let you sleep at night when Bitcoin and MSTR are at this level of oversold, now is the time. If you are interested, scan this QR code right now or go to solana.io/capital to get in line today. And you guys know how excited I get about strategy and Bitcoin treasury companies and this ongoing institutional adoption of the Apex asset. Do not lose sight of the fact that Bitcoin in 100% self-custody remains more important than ever. And on top of that, it's very important to have a partner with you alongside your journey, especially after this latest cold card hack fiasco. My friends at the Bitcoin Way are standing by right now to give you a 100% free introductory call to help you on your sovereign Bitcoiner journey. They will help you be your own bank the safe way. They will teach you self-custody the safest way possible. Scan the QR code right here. Go to thebitcoinway.com/Adam. Become sovereign. Become a node runner. Be your own bank with the Bitcoin Way. They are standing by to help you with any question that you have right now. Do not delay. Your freedom depends on it. So let's just do a quick review of exactly what we just saw right now. 2.3 years of dividend coverage in cash on the balance sheet. $4 billion. This is almost double what their cash reserve was at before the great stretch crisis of 2026. $4 billion in cash. Right now, they are sitting on 842,138 Bitcoin. Now, this gives them an additional 57 days of runway coverage in their cash reserve. And I actually broke down the CEBE math, the common equity Bitcoin exposure, because I want to know how much did I get diluted as an MSTR shareholder. Turns out, wasn't a lot at all. In fact, it was microscopic, 0.086% dilution. In my opinion, I'll gladly take this. They have been very clear that they want the stretch machine turned back on to buy more Bitcoin. I think this is 100% a necessary capital markets allocation decision. This capital formation makes total sense to me. This is a good defensive measure in the Bitcoin bear market. We're 10 months in. How much longer do we have to wait? Try to get stretch back up to par. Totally love it. So if you actually want to know what you got diluted in terms of the net asset value backing each MSTR share, let me tell you, it's about 8 cents per share. So really sorry if you don't like your 8 cents per share getting squandered to make this move. Really sorry. You might have to hit the sell button. Maybe go buy Bitcoin if you don't like playing this game. Personally, I'm holding the stock for a long time. I like the amplification that I'm getting in exchange for that share dilution, so I will gladly take it. So right now we are beginning to see over the course of this latest month that essentially their Bitcoin buying machine is slowing for a little bit. They are being very calm and methodical through this Bitcoin bear market, essentially to get the stretch machine turned back on. Now, in my humble opinion, they probably want to get the stretch ATM turned back so they can focus on paying down that convertible debt. Because remember, S&P Global, they said they want to see continued less reliance on the outstanding convertible debt The strategy management team has been very clear that they want to get that debt taken care of. And then once that debt is gone, you can amplify the Bitcoin stack by 60 or 70% or even 80 if you want to. And there's no defaulting because there's no maturity risk involved. So I love what they're doing now. Right now, it's a Bitcoin bear market. Just survive. If you guys remember, we've done the math on the channel about how much additional stretch issuance to buy Bitcoin is actually tacking on to your long-term MSTR returns. It's actually not a lot when you look at the embedded amplification already, at least in relation to the leverage that's already on the balance sheet. So right now, they just need enough cash to avoid forced selling. Clearly, they're keeping their refinancing choices open if they have to. The runway right now is the product, and they keep adding on to it, no problem. And that's exactly what I've been saying for the last 6 months. They are demonstrating their capital markets activity, whether it's selling Bitcoin, whether it's selling MSTR, which is still at a premium, believe it or not. They can continue kicking the can down the road and surviving any Bitcoin bear market. So I think that this is really good, prudent capital formation here. This is the exact breakdown. $395.3 million raised in 1 week. $290.6 million of it comes from the MSTR ATM. They sold over 3 million shares of MSTR at a $96.51 average. In addition to that, they sold Bitcoin for a total of $395.3 million. $395.3 million raised like it's almost nothing. At the drop of a hat, they can literally just raise capital in the hundreds of millions of dollars every single week, and their dividend obligations are like $1.7 billion a year. This is why throughout this entire bear market, throughout this entire volatile drawdown, I haven't been worried in the slightest. Now, this is how it breaks down in terms of the uses. $250 million even into the USD reserve. Preferred dividends, $52.4 million worth. Then they bought back that $81.2 million of STRC. And that means that about $11.7 million of cash is remaining. Now, this is really cool because when you look at the stretch move, they paid $81.2 million to retire $91.214 million of stated STRC claims. That is about $10 million of a discount captured immediately as soon as this transaction closed. Now, at the maintained 12% stretch dividend rate, those retired shares, they also retired $10.95 million of annual dividend burden. And then in response, we've seen Stretch rocket north of $92. So the market absolutely loved the buyback move. The market loved the addition to the USD reserve, both Bitcoin, MSTR, and additionally Stretch, all three of them up on the day's news. So in normal English, Strategy just bought a $100 obligation for $89, and they eliminated $12 a year of carrying cost on every 100 retired. This is the company improving both the liability side and the credibility side of the instrument. This is making it more appealing for the credit investors. The company is showing that they are willing to support it. To me, this is what competent treasury management looks like. I really dig it. This is the CEBE math. If you are interested, not going to explain it at all, but this is essentially the common equity Bitcoin exposure change week over week, keeping a steady Bitcoin price. Remember, the only thing you need to know about less actually than 8 cents of NAV of dilution, literally 124 sats per share. So, depending on the Bitcoin price, it's pretty much neutral effectively. So we cannot view all of management's actions in a vacuum. We cannot do that. We have to take a cohesive view of what the mission is, what is the long game, and what are SAYLOR and the team doing to make sure they could potentially get S&P 500 index inclusion. You got to remember that at the end of last year, S&P Global, they gave Strategy a B- credit rating, and they named 3 upgrade conditions. Now, what are they? Number 1, to improve USD liquidity. They established the USD reserve after getting that feedback, and now it's at its highest level ever at $4 billion. So they checked that box. They said, okay, thank you for giving us answers to the test on how to potentially get a higher credit rating. Then that opens up more buckets of capital to issue in STRC to. And then you got to remember, number 2, they said to reduce convertible debt reliance. They paid back some of that convertible debt this year. That was a winning move. So they checked that box as well. Now, this is my favorite thing. thing. They are proving market access under stress, which is essentially what S&P told them. They want Strategy to demonstrate capital markets access under a Bitcoin bear market stress. They are doing that. Clearly, they are still able to raise billions of dollars. They've raised over $10 billion this year in 2026. By issuing MSTR during a Bitcoin bear market, by selling Bitcoin during a Bitcoin bear market, by selling Stretch during a Bitcoin bear market. They are literally checking every single box. And on top of that, after Bitcoin's corrected 50%, they're even paying off their debt too. So clearly, they're checking every single box, proving that they have capital markets access during Bitcoin's price stress here. So right now, they're checking off every single box in terms of the answers to the test from S&P Global. So now let's take the time to connect the corporate runway to the Bitcoin cycle, okay? Because I decided to look at some on-chain data because I was curious about what is the current percentage of the Bitcoin supply in profit right now. I ran the numbers last night. I got 52.56%. Now, Strategy, they have that 2.3 years of dividend coverage in cash. That is the runway for their preferred dividends and their debt interest, of course. And when I was going through Bitcoin's on-chain data, I found out that every single time we hit this level of Bitcoin supply and profit, I found 5 independent historical instances since 2015. So over the last 11 years, there have been 5 independent scenarios where Bitcoin has corrected to this level of the supply, being in profit or in loss. Now, every single one of these regimes was positive 2.3 years later, which is the same length of time that Strategy has in the cash runway here. The weakest 2.3 year return in Bitcoin's price history whenever we have hit this level of Bitcoin supply and profit, the worst ever return was 105%. The historical median return was plus 312%, and the average was plus 325%. Now, this is not a forecast. This is me repeating what history has shown us. The sample is very small, but the point is the length of the bridge. The point that I'm making is that 2.3 years is a very long runway, and this is just their cash. And remember, they have over 3 decades in Bitcoin coverage, and clearly they can sell Bitcoin and MSTR and Stretch all go up. So I'm pretty sure they can continue surviving all of the bears telling you about a death spiral. These people are idiots. So the company doesn't need history to repeat exactly. They just need the current winter to end before the pantry does. And remember, we are right now more than 10 months into the Bitcoin bear market. We really got to wonder what in the world is going to happen over the next 6 months to a year to 2 years. Don't turn the median into a price target. Feel free to not do it. Take your pick here. There is a variety of results. We have a different level of return depending on what regime we were in here. But you know, if the worst outcome more than doubled and then the best outcome about 7x, you know, I'm not too concerned about Bitcoin's price performance over the next couple years, just given the fact whatever history says happens whenever we reach this level of oversold Bitcoin. Now, this was some more bullish Bitcoin news that dropped today, and I wanted to look at what happens throughout history whenever we do hit this indicator, because remember, Strategy just needs to survive. They need Bitcoin to go up. They're surviving no problem, obviously. This bear market is a cakewalk compared to 2022. They have like $35 billion of net Bitcoin after the senior obligations. But manufacturing just flipped from alive on paperwork to actual strong expansion for the first time in over 4 years, kids. It's been quite a while since we have seen this. Now, this is an indicator that has always proven to be a bullish signal for Bitcoin. The ISM PMI hit 55.6 after 49 consecutive months at or below 55. New orders were 56.7, production was 58.5, employment was 52.8, backlogs were 55, customer inventories were only 40.7. So orders plus production plus depleted customer inventories is a plausible restocking cycle. That matters because the broadening growth here can pull capital out of defensive hiding and into higher beta scarcity assets, you know, like Bitcoin, especially if real yields and the dollar stop acting like nightclub bouncers. This is a conditional macro signal that I really like to look at. Bears struggle with conditional statements because the only condition that they recognize is parole. But the setup is very clear here. The growth breadth is improving. If inflation and discount rates cooperate, Bitcoin has jet fuel. This is very bullish when you look throughout history. There are 4 clean historical signals whenever we have seen this happen. 3 of 4 of them were positive at every single time horizon. The median Bitcoin return whenever we have hit this level was plus 56% after 3 months, plus 139% after 6 months, and plus 554% after 12 months. Now remember, n equals 4. This is a small sample size, kids. This is not the 10 commandments carried down from Mount Bloomberg, kids. I'm not saying that. I'm not claiming that the PMI causes Bitcoin to levitate on release day. But 2013, when this happened, was just really bad timing because Bitcoin had topped. It was still in its infancy. Let's look at the other 3 winning scenarios whenever we have seen this expansion in the ISM PMI here. The 2012 signal finished plus 2,011%. Obviously, early Bitcoin was feral, but in 2017, plus 776% whenever we flipped this switch, and then back in 2020, plus 332% for a median of plus 554% here. Now remember, Bitcoin is down 49% from its all-time high, okay? So the lone losing PMI signal that you guys just saw right here in the red, this began only 6.8% below the high. So the winning setups here, they began roughly 11, 41%, 83% below their prior highs. Now today is starting with far more Bitcoin price damage already embedded than that one historical failure here. So do not overfit the 4 data points here. Remember, the drawdown depth is not statistically proven as the magic variable here, but starting point does matter in every single asset on earth. You can't ignore it. A growth acceleration after a speculative reset, that's not the same trade as a growth acceleration after everybody already maxed leverage near the top. And I went ahead and coded a visual for you guys right here so you could see what this looks like whenever we do see this business cycle signal here breakout. These 2 big Bitcoin bull runs right here, look at the shaded green, they coincided with the ISM breaking out over 55. It happened this year right here. It happened in 2021. And then we spent over 4 years in the doldrums, which is the longest time we've ever spent at this level in Bitcoin's price history. And we just got our first print. Hopefully, history rhymes and we see a Bitcoin breakout. So now let's translate the Bitcoin bull case into common equity Bitcoin exposure for MSTR shareholders. What would this mean if we get back to the Bitcoin price all-time high when we hit the all-time high closing price at $124,728 per Bitcoin? Well, if we hold the capital stack fixed, which isn't going to happen because obviously they're doing stuff every single week, but I just want to isolate what the Bitcoin move will do for MSTR because it is giga bullish. Just the Bitcoin move is going to move the net asset value backing each share just based on their balance sheet today. Remember, this is not me modeling them buying any more Bitcoin from now until then, but that brings you to $224 of the NAV backing each share from just Bitcoin going up. And then in addition to that, you get amplification because your common equity Bitcoin exposure sats per share goes up. That goes up plus 24.6%. This would bring down that amplification CEBE elasticity from 1.5x to 1.2x because obviously those senior claims stay fixed as a smaller percentage of the balance sheet when Bitcoin takes up more of it when it goes up in value. Whoopsie daisy, very sorry, I just cropped it out, but that's what it looks like. Now I do want to zero in on this orange number here on the left. Let's have a look at this for those who tell me that Bitcoin is going to outperform MSTR on the way to Bitcoin all-time high. Bitcoin going back to the all-time high would be a plus 94.8% return, but you know, looking at the CEBE NAV per share, that's plus 142.6%. So I'm not so sure if the math is going to agree with you there, bud. And then on top of that, this isn't including an MNAV expansion that might happen. If you remember, literally 2 months ago, we saw the MNAV go up to a 1.25x or so, and MSTR hit $200 when Bitcoin was literally only in the low 80s. So basically, the bears are stupid clowns, and MSTR is gonna go to the moon when Bitcoin decides to rip. But remember, this is not financial advice, this is financial entertainment. So they own 842,000 plus Bitcoin, $4 billion in cash, and they just bought 2.3 years of breathing room. The bear market doesn't need to end today, of course. Clearly, Bitcoin doesn't need to rescue the quarter. The preferred equity market doesn't need to become euphoric. That doesn't need to happen either. Strategy only needs to stay liquid long enough for one of these things to improve, like Bitcoin going up and to the right, which historically it pretty much always does. The bears need everything to go wrong in sequence and then remain wrong for years and years and years, potentially decades of Bitcoin price impairment. Their capital markets access must close, but unfortunately, none of these things are happening, and the bears continue to be wrong about absolutely everything. One side has $4 billion of cash and $55 billion of Bitcoin. The other side has 4 retweets, an upside down Dodge journey. Survival preserves the convexity of the common equity. Now, time is the asset that they are buying. They cannot be stopped. Now, did you know that Strategy has the same B- credit rating as Traeger grills? Yeah, Traeger wood pellet grills, the same exact credit rating. Traeger has $662 million of assets compared to the $56.7 billion of Bitcoin. And then Strategy has $4 billion of cash. Traeger has $34 million. So look at their asset to debt ratio, $662 million of assets versus $400 million of debt. So Strategy's cash alone is 10 times Traeger's debt, and Strategy's BTC is 142 times Traeger's debt. $30.9 billion of common book equity versus $175 million. So the debt of Traeger is more than double their common book equity. But yeah, the same credit rating. The world is asleep to Strategy still. It's gonna be the world's most valuable company, and it's being evaluated like it's a wood pellet grill company. The haters are absolutely clowns. Bitcoin is inevitable. Strategy will be the most valuable company in the world because clearly nothing can kill them. I'm waiting for a nuclear Armageddon EMP that will take out the Bitcoin network. Still haven't seen it happen. I'm seeing these bullish indicators for Bitcoin starting to flip, and Strategy has survived a way worse Bitcoin bear market in 2022, and they're surviving the 2026 Bitcoin bear market with flying colors. The bears are foaming at the mouths because they are going to stay poor, and they're going to look incredibly stupid at the same time. My name is Adam Livingston. I am the Bitcoin Wizard. If you guys enjoyed this presentation, please do me a favor, hit the like button on YouTube and subscribe to the channel. That way you can support me, spread the orange gospel of Bitcoin to the masses. Have a terrific day, everybody. Do not party too hard, my dearest little clown rat children. Class dismissed. This video is sponsored by Solana, and if you are interested in gaining Bitcoin upside while keeping your principal protected, Solana may have built the most aggressively bullish product available for people who still enjoy sleeping at night. Yes, you as an investor can receive 50% or more of Bitcoin's appreciation with uncapped upside, while the structure is backed by the Bitcoin position itself and a lien on U.S. investment real estate. Basically, Solana is putting Bitcoin in body armor. You still get the moon math while your principal has a rental property standing behind it with a baseball bat. If you are interested, scan the QR code or use the link below. Solana will help you every single step of the way. They will answer your questions and explain exactly how the structure works. Requesting information carries zero obligation or commitment. Go to solana.io/capital to buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it. day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Today, I am going to explain why investing in Bitcoin treasury companies can make mathematical sense even when the company is trading at a premium to the Bitcoin that they are holding. Now, this is very controversial to say because obviously, Bitcoin treasury stocks are down. Many people use price as their thesis for long-term investing, which is foolish in my humble opinion. Because every single time that somebody sees a premium, their brain immediately turns into a smoke detector with a dying battery. Why would you pay $1.39 for $1 of Bitcoin? You see this question asked many, many times. Why would you pay the premium just buy Bitcoin? Everybody constantly freaks out about this. Great question, Warren Buffett. Let me tell you why. The mistake that people in the Bitcoin community continually make, they treat a Bitcoin treasury company like it's a sealed Tupperware container filled with Bitcoin. You look inside of the container, you count the coins, then you compare that number to the market capitalization of the company, and then you declare anything above the net asset value to be financial necromancy. But common equity, the shares that you are holding, it's not a static pile of Bitcoin, so you are making a category error. It is a residual claim on the Bitcoin after the senior claims have been accounted for. That residual claim can change over time, it can grow, it can shrink, it can become dramatically more valuable as Bitcoin appreciates, and this is very easily measurable. You gotta understand, kids, you're not paying a premium for static Bitcoin. You are paying a premium for future growth of your residual Bitcoin claim, and Bitcoin going up can make that claim increase. And that distinction is literally pretty much the entire presentation, but I'm going to be giving real examples of why I love MSTR, why I love ASST, why I love the value proposition, because I can do basic math. I'm going to start with the most brutally conservative scenario imaginable. I'm talking no Bitcoin purchases, no preferred stock issuance, or capital markets wizardry, none of that stuff. I'm saying management spends the next 2 years sitting on their hands and Bitcoin just goes up over time. We will look at what happens to these balance sheets and what happens to Bitcoin, and then we will compare the two. And I will calculate exactly when the initial premium gets earned back, because premium isn't a moral category, kids. It is a mathematical variable into a much broader calculation that you have to make for yourself as you really think about your own risk tolerance and time horizon as an investor. Today, I am going to drag the lazy premium objection behind the spreadsheet barn and convert it into a tax loss carry forward, kids. You guys are going to love the video. If you could do me a favor, hit the like button, subscribe to the channel on YouTube. That way you can support me spread the orange gospel of Bitcoin to the masses. Now look, if you're listening to the chicken gizzard Bitcoin wizard, I'm going to go ahead and go out on a limb and assume that you are bullish on Bitcoin or MSTR if you want to go a little bit more out on the risk curve. I would assume that you're either bullish on one or the other. What if you could get half of the upside of either Bitcoin or MSTR with your principal protected? That seems like a fascinating suggestion. That is exactly what my friends at Sovana are building. Every single dollar of your investment is secured by a title-insured recorded lien on U.S. real estate. You split the upside with the property owner whose home equity backs your own investment. If you've been waiting for a way to buy Bitcoin or MSTR that allows you to sleep at night, this could be it. And honestly, what better time to lock in a 5-year position when Bitcoin and MSTR are sitting in a bear market? If you are an accredited investor, use this QR code on the screen and get in line at sovana.io/capital. And you guys know how excited I get about Bitcoin treasury companies and the insane levels of institutional adoption that we are seeing. But don't lose sight of the fact that Bitcoin in 100% self-custody is the real revolution, and the Bitcoin way is more important than ever in terms of properly self-custodying your Bitcoin because of the recent cold card fiasco that we have seen unwind over the last couple days. My friends at the Bitcoin Way will really train you to properly self-custody your own Bitcoin. They will turn you into a sovereign Bitcoiner with the best possible security. Go to thebitcoinway.com/Adam to schedule a 100% free introductory call. The Bitcoin Way is your ultimate Bitcoin support team. Don't delay, your freedom depends on it. Also, if you guys are interested in getting the Swiss Vault for your Bitcoin, the BitBox O2 Nova Bitcoin Only Edition is my cold storage wallet of choice. It is the Swiss Vault for your Bitcoin. There's a bug bounty program. So this company, they literally put out a bug bounty program where they reward people for finding bugs in their software, and it has been tremendously safe. No major security issues ever for the BitBox O2 Nova, and these guys have been around for more than a decade. This is the sleekest, best Bitcoin cold storage wallet I've ever used. I literally plug it into my iPhone, transfer my Bitcoin over, and I can sleep at night very easily. Use code ADAMBTC for 5% off the Swiss Vault for your Bitcoin. Link is in the description below. So we're going to talk about why the math can work, folks. It's very simple. Let's look at the return identity of a stock price return if you are buying a stock instead of Bitcoin. Very simple. It's a multiplication problem. You take your Bitcoin return, then you take the common equity Bitcoin exposure return, the growth in that multiple, or the decrease in the multiple if Bitcoin goes down. This is amplified Bitcoin. You know, obviously, these things can go down more than Bitcoin when Bitcoin goes down. But then on top of that, you could also multiply it by a change in the MNAV. So those are the three different variables that make up a stock price return of a Bitcoin treasury company. This is mathematically undeniable. Now, obviously, your entry matters, of course, your time horizon matters. These are all things that you need to judge for yourself as you make an entry into any one of these stocks. That's why this isn't financial advice. This is financial entertainment, because I'm comfortable with the volatility of these things for 10 plus years, and I acknowledge probably not everybody is. But regardless, it's very simple. When they are levering the Bitcoin, when they are amplifying it by issuing preferred stock, those are senior claims sitting senior to the common stock on the balance sheet. Those are fixed in dollars. Those are not compounding, and the Bitcoin is compounding. So basically, when the Bitcoin compounds, your common equity Bitcoin exposure, that residual claim increases, because remember, the senior claims above you, those are staying fixed. The Bitcoin goes up, you inherit the spread, you get the difference. Now, that is how these companies can outperform Bitcoin with zero MNAV expansion ever. Because Bitcoin going up, you get that return, but Bitcoin going up also increases your residual claim because the senior claims are staying fixed. Therefore, Bitcoin going up is one engine working, and then also that one engine turning also turns this gear as well, the amplification. That is how your exposure is amplified. So the MNAV change, that can be a huge bonus if you bought at a cheaper MNAV. It can also suck if you buy at a higher MNAV and you don't have a long time horizon to wait for the other two things to compound for you. So that is why your entry matters. So what we're going to be talking about today is obviously you are paying a premium. Sometimes you're getting a discount, depends on where you enter, obviously. But right now, if you look at MSTR or ASST, now you are paying a premium to get access to this machine that can increase your residual claim. It's not just Bitcoin. That's why it's the category error. Now think about it this way. If you're paying, let's say, a 39% premium to the value of the Bitcoin, you got to think, okay, but if my residual claim goes up when Bitcoin goes up, how long do I have to wait before the premium that I paid is paid back to me? That doesn't require terminal MNAV expansion at all. And that's where this gets really interesting. So I went ahead and loaded up the Strive balance sheet as example number one. I posted this to X yesterday just as one example, but you know, I decided to do some pretty bearish inputs, in my humble opinion. Crunch the math yourself before you buy any of these things. Remember, this is not financial advice. This is financial entertainment. If you're not bullish on Bitcoin, you're going to hate buying amplified Bitcoin. But this is just a hypothetical scenario, okay? Hypothetical, super hypothetical. I don't know that this is going to happen. I personally think it will. But Bitcoin, let's say it goes from $62,900 to $200,000 over 24 months. That means Bitcoin hits 200K in July or August of 2028. Now, I'm assuming that Strive doesn't buy another Bitcoin for 2 straight years. That's correct. They don't issue any more common stock or any more preferred stock. They literally sit on their hands and pretty much do nothing and just pay the dividends. And they pay those dividends by issuing common shares into the market. So you are being diluted. So the preferred balance is staying flat and the MNAV doesn't move at all. So we're going to answer the question, does paying that premium make sense? Well, let's look at it. So my point is, this really isolates the capital structure effect of the amplification, okay? I am correcting for all of those other variables like MNAV, expanding, share issuance. This is just what happens with the embedded amplification on top of the Bitcoin move. Even doing nothing outperforms Bitcoin. And this is what it looks like. So today you are paying a 1.39x MNAV premium to the common stock residual for Strive. Now, if you pay that premium and Bitcoin only goes up, there is that embedded amplification. Your residual claim increases. Your common equity Bitcoin exposure grows by 45.8% only by Bitcoin going up and to the right. Now, the common stock would be diluted by 9.4% to fund those dividends, but the common stock shareholders of MSTR and ASST, they understand that they will happily take this 9.4% dilution trade-off to get this level of amplification. So just in this one scenario with them buying 0 Bitcoin, no MNAV expansion at all, your premium is paid off literally within 15 months, literally month 14.3. So about 14 months and 10 days, that is your premium paid off from your residual claim increasing. And that is why you have to have a long time horizon when you are investing in an amplified Bitcoin treasury company, because you gotta give enough time for Bitcoin going up for the residual to expand, and then your premium is paid for. Now, obviously, we saw the MNAV expand to 1.8 2 months ago when Bitcoin went to 80K. So I'm not saying that the MNAV will stay at 1. Hardly. I'm not saying that at all. I'm just saying that the math works out if Bitcoin goes up. It's literally that simple. If you are bullish on Bitcoin, this math works here, and you got to be willing to wait for a little bit. Now, remember, this is corrected for those other variables. I am not saying that you will only beat Bitcoin after 14 months. I'm not saying that at all, because I think maybe they buy more Bitcoin, maybe they add more amplification, maybe the MNAV goes to a 2. I'm just saying this is how the common stock can outperform BTC with literally just Bitcoin going up. So it's very interesting. And this is the mechanism. It's very interesting. Right now, if you look at Strive's balance sheet, they have 20,000 Bitcoin, but obviously they are amplifying the common stock. If you actually just look at the amount of outstanding that is in SATA, their preferred stock, it's over like $780 million. Now, obviously, so what I like to do is to put that in Bitcoin terms, because you guys know that obviously you can take that cash and buy coin if you want to. That's what they do. I just like to put it into Bitcoin terms to make it very easy and digestible for people. We know it's in fiat, but remember, that's 20,000 coin on the balance sheet. So I like to separate it into senior claim coin and common equity coin. There's 20,000 Bitcoin on the balance sheet today, but if you actually look at the common equity Bitcoin after adjusting for the senior claim Bitcoin, there's actually only 10,699, but that's a good thing because they are adding the amplification, adding the senior claims while Bitcoin is so cheap right now. That's why I love this entry. So basically, you're going to see your common equity Bitcoin rise from 10,699 right here, and it is going to go up as Bitcoin goes up and to the right. That means that this Bitcoin is essentially released to the common residual over time. And then you see the senior claim Bitcoin go down and to the right. This is the claim compression. This is common equity Bitcoin exposure 101. So your residual rises 45.8% after the dilution that everybody cries about. So let's talk about the terminal result over this one scenario. And it's pretty interesting because if you hold Bitcoin, if you buy Bitcoin today, it goes to 200K. That means you have a 3.18x return. That's all fine and dandy. Awesome return. That's fantastic. That's this white line here, rounded up to 3.2x. That is the Bitcoin return. This orange line represents the modeled ASST scenario where you get a 4.6x greatly outperforming Bitcoin, remember, with no MNAV expansion or buying more Bitcoin. So a sizable outperformance over the next 24 months if Bitcoin goes up by just sitting on the stock doing nothing because the amplification is already there. The trebuchet is loaded. And a lot of people like to talk about the premium risk. Oh no, but what if the premium collapses? Okay, calculate your MNAV break even, because I just did. You want to know what's interesting? Even if the terminal MNAV, if somehow the MNAV of ASST goes to 1.0 after a move to 200K Bitcoin, yeah, I don't think that anybody actually thinks that'll happen, but even if it did, check this out. This yellow line right here, it still outperforms Bitcoin. So there you go. Obviously, if the MNAV went to a 0.9x after Bitcoin goes to 200K, then, you would underperform Bitcoin. And remember, that is if they buy no Bitcoin until then. That's up for you to decide how realistic that actually is. So in this scenario right here, Bitcoin goes to 250K over 24 months. So I added 50K to the Bitcoin price. That means that the premium paid back time horizon, okay? The time that you have to wait for when the premium over the Bitcoin NAV, it gets paid back in your residual growth, literally only 9 months at Bitcoin being $133.4 thousand. This is a 52.8% growth in your residual, and this is over a 6x while Bitcoin is only a 4x. So this is considerable outperformance over Bitcoin. And in this scenario, I still have the issuance machine remaining off. And even if the terminal MNAV is 1.0 after a move to $250,000 Bitcoin, it still outperforms Bitcoin on the way up. These are the numbers, folks. Remember, them buying no more Bitcoin, staying at 20,000. We still love the returns here, kids. And this is where it starts to get real fun if you are a Bitcoin bull and you want to hold it for more than 2 years, think maybe 5 years or 10 years. This is where my mind goes, because I think Bitcoin is going to $1 million, not only 300K like this scenario right here. But let's say Bitcoin does go to 300K over 24 months. I don't think that's crazy. That's less than a 5x from today. I think that's totally doable, no question. And if you actually crunch the numbers about how much SATA they have issued since the IPO, their annualized pace is around $67 million per month. That's been the pace post IPO for them. So it's been a very successful, not even full year for SATA. It IPO'd in November. But in this scenario here, I'm assuming that, let's say they turn that issuance machine back on, they issue less than their year one pace. So we're assuming that they slow down, only issue $50 million a month. They take that capital, buy more Bitcoin. Then the modeled terminal MNAV at the end of this projection, it rises to 1.5x. That scenario is almost a 10x return on your investment, while Bitcoin is only a 4.8x. That is more than double the performance of Bitcoin. And get this, even if the MNAV collapsed to 1 after Bitcoin goes to 300K, you still outperform Bitcoin 6.5x versus 4.8x. And your payback in terms of the premium that you paid today, it's paid back in terms of your residual expanding, it's paid back after less than 5 months, 4.6 months, Bitcoin at 108K. And the way I view it is like, okay, I want to hold this for a long time. After 4 months, wow, I'm home free. Now you can start to see the gears in your head turning. Wow, if Bitcoin goes up and to the right, amplified Bitcoin really does its job, doesn't it? And maybe you're more bearish on Bitcoin. You don't think Bitcoin's going to go to 300K in 2 years, but you think maybe 400K in 4 years is a more realistic scenario. Well, let's run it. Let's keep that same $50 million month issuance pace as the last scenario. Remember, that's less than their year one issuance pace. And let's say Bitcoin goes to 400K and the terminal MNAV goes to a 2x, because let's say the MNAV expands because there's Bitcoin bull run mania. Obviously, it's not going to happen linearly like this. Bitcoin's going to be volatile. It's going to be a roller coaster. I'm not saying it's going to happen linearly like this, of course, but this is the math projecting forward what it would look like if it was a smooth ride. ASST would be a 19.1x in this scenario. And even if the terminal MNAV collapsed to 1.0, you would still outperform Bitcoin considerably, a 9.6x versus Bitcoin being a 6.4. Your premium paid back would be right after month 6 here. This would be a $213 stock when it's, just over $11 today. That's why I love the entry today. And let's just do a 5-year scenario. Let's say that you think it's going to be over $500,000, 5 years from now. This would be August of 2031. And let's say they still don't quite reach their year one digital credit issuance pace. Let's say they issue $65 million a month for 5 years. Do I think this will happen? I don't know. I don't really really care. I like the returns just off of what they have now. But regardless, this would help them keep their performance amplified as Bitcoin goes up. If the MNAV went to a 2, this would be a 26.6x return. Now, if the MNAV went to a 1, the terminal MNAV, that is a 13.3x versus Bitcoin's 7.9x. So basically, the premium that you're paying today is paid back after 5 months of Bitcoin going up in this scenario. And the stock is diluted about 20.3%, but you get a 133.1% common equity Bitcoin exposure growth. Lots of amplification. That is how you at least get that 13.3x return at that 1x MNAV scenario, but the multiple expansion on top of that. You know, obviously, if there's a volatile upswing in the multiple, it's going to get crazy. And then, of course, let's say there's a huge bear market over the next 5 years too. Obviously, if you buy the top here and then the multiple compresses, but you're not willing to wait for those other two engines to bail you out over time, you're kind of screwed. So that is why time horizon really matters with these things. So that is all of those scenarios kind of lined up here when your premium that you'd be paying today is mathematically earned back. MSTR has a smaller premium today. ASST does have that 39.2% premium. And this is the return comparison across all of those scenarios. White is direct Bitcoin. Yellow is the terminal 1x MNAV return. And then orange would be the modeled MNAV return. You know, I was changing that variable depending on the scenario here. But I do notice one thing. In all of those scenarios, ASST outperforms Bitcoin. This white dashed line is the premium payback threshold. These lines here are those different scenarios. And, you know, obviously, depending on how long you wait, what Bitcoin does, depending on the scenario that unfolds, you would have to wait a certain length of time before the premium that you paid is earned back. But very clearly, all of those scenarios outperform Bitcoin. So we're going to load up the company terminal, and I want to tell you guys something here. Let's look at the cheapest CEBE MNAV right here. So if we sort all the Bitcoin treasury companies by the cheapest premium, and you know, technically, obviously, if this is a discount to the Bitcoin NAV, then you're not waiting a certain period of time for your premium to be paid back because you're not paying a premium. That is why I love Metaplanet right now, folks. You guys know that I'm super bullish on them. I'm holding Metaplanet for a decade minimum. I'm giga bullish on that company. But I just went ahead and loaded Metaplanet right here, and their current common equity Bitcoin exposure MNAV is literally a 7% discount to the common equity Bitcoin exposure NAV. So even ignoring the senior claims on the balance sheet, you know, just ignoring that, and you're only looking at the Bitcoin, the NAV that's backing each basic share, it's $1.68, but the stock is trading at a 156. So you're getting $1.68 of Bitcoin backing each share, but the stock is only 156. That is a solid 7% discount. Now, obviously, they're not as amplified as Strive is or as MSTR is. There's like a continuum, basically, of all of these different treasury companies, how the market's valuing them, how they're pricing the risk. Strive doesn't have any debt, so they can't really default because no debt is coming due. So that's pretty cool. Bitcoin would have to go to 0 for them to be in trouble, pretty much. So you see the market assigning Strive a higher multiple because they have that better risk profile than the companies that have outstanding debt. That's what I think is happening. And even looking at Anthony Pompliano's ProCap, it's trading at $1.70. But this is very interesting. The common equity Bitcoin exposure MNAV is a 0.59x. So you're getting Bitcoin exposure at a 41% discount, which is crazy. And on top of that, they are somewhat amplified because of this 24.6% claim ratio. About 1,330 Bitcoin is senior claim Bitcoin. Look at that, $2.89 of Bitcoin backing each share, but the stock is at $1.70. So if the market starts to price this as at least the value of their assets, and then on top of that, valuing the Sylvia operating business, I kind of like ProCap as an entry here too. None of this is financial advice. Nothing is financial advice. I'm just talking about how I view things here. But anyway, this seems super cheap in my humble opinion. And honestly, I think all of these companies, MSTR, Strive, ProCap, Metaplanet, all of them super cheap because Bitcoin is going up forever, Laura, and all of them have some leverage on their balance sheet. So if they can survive the leverage, whether it's convertible debt or preferred stock, as long as they can meet their obligations and survive the terms of their leverage, I can't be anything but bullish given the math that I just went over in this video. So that is why I love Bitcoin treasury companies. I hope that you guys found this educational and entertaining. Keep fighting the good fight. Some people pretend to not understand this because they are bad actors or they are literally just little clown people. My name is Adam Livingston. I am the Bitcoin Wizard. Please like the video, subscribe to the channel if you like the content. Have a terrific day. Do not party too hard. Class dismissed. This video is sponsored by Solvana, and if you are interested in gaining Bitcoin upside while keeping your principal protected, Solvana may have built the most aggressively bullish product available for people who still enjoy sleeping at night. Yes, you as an investor can receive 50% or more of Bitcoin's appreciation with uncapped upside, while the structure is backed by the Bitcoin position itself and a lien on U.S. investment real estate. Basically, Solvana is putting Bitcoin in body armor. You still get the moon math while your principal has a rental property standing behind it with a baseball bat. If you are interested, scan the QR code or use the link below. Solvana will help you every single step of the way. They will answer your questions and explain exactly how the structure works. Requesting information carries zero obligation or commitment. Go to solvana.io/capital to buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own, Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Boston.
And I'm Katie Greifeld. We're keeping an eye on equities, but let's check in on the world of digital currencies. Strategy beefing up its reserves to $3 billion following its recent stock sale, not buying or selling any Bitcoin between July 6th and July 12th. Joining us live, I'm pleased to say, is Strategy CEO Feng Li. Feng, fantastic to have you with us. So as I said, this week you issued that stock sale. Your cash reserves are up at $3 billion. My understanding is that this allows you to pause Bitcoin sales for the time being. But talk us through, what the next several months look like. Do you plan to sell more Bitcoin? And if so, how much?
Katie, thanks for having me. We have really evolved from being a Bitcoin treasury company to a full digital capital platform. We're the world's largest identified holder of Bitcoin in the world. We have over 840,000 Bitcoin. Digital credit has been launched in the last year, and the form is stretched just $10.5 billion. So we have a responsibility to our common shareholders, our preferred shareholders, and to Bitcoin, of course. We issued now, or we've accumulated $3 billion in cash because we listened to our preferred shareholders, and they said having liquid cash in our balance sheet in the short term is important. And we also sold Bitcoin to be able to show liquidity with our Bitcoin. Yes, we will continue to issue capital. It could be in the form of MSTR, it could be in the form of Bitcoin, and we're going to make the decisions that are best for our shareholders over time.
Well, could it also potentially be in the form of STRC? That, of of course, are preferred shares. They're known as Stretch. My understanding is that you last issued Stretch in mid-May. Of course, it's been trading at a discount here. Do you plan to issue Stretch again in the near future?
Yeah, our plan is to get Stretch back to par. Unsure how long that will take. Building up the U.S. dollar reserve was a big part of that, and we'll continue to build that. And yeah, when Stretch gets back to par, we'll issue more. We'll buy Bitcoin. We may continue to beef up our U.S. dollar reserve. That's a big part of our capital plan, is to issue more preferred over time, because it's very accretive to our Bitcoin per share, which is accretive to our shareholders.
Well, I am curious just about just kind of the structure going forward. I mean, to get back to par, is there a sense here that you can do that, whether it's with selling more Bitcoin or issuing more equity? Have you determined what might actually be the best path to get there, or the most efficient path to get there?
We think the first thing is the U.S. dollar reserve, right? I think we've learned over the course of the last couple of months that having that liquid access to U.S. dollar capital, whether it be 1, 2, 3 years, is quite important. And we saw when we increased it in the last couple of weeks, we got a stretch up from a low in the 75 range to close to 90. So we'll continue to build that. We increased the dividend. I don't think the dividend is as much of a factor. And I think a track record of success and a track record of execution. And then, of course, education. We're a year into the product. A lot of financial products take 2 or 3 years to mature. So we're early, we're learning, we're listening to the market. And the great thing is there are built-in mechanisms with the market. For example, going to par, right, and staying at par. That's a mechanism that lets us know what we're doing right and what we're not doing right and what we can improve upon.
What's the communication, though, with shareholders overall? There's been a lot more focus, obviously, on the preferred shares, but I mean, you guys issued a ton of common equity in the preceding years, and I am curious if there's any sense in trying to reconcile with some of those folks who bought a lot higher than where that 96.73 price stands right now.
Our shareholders understand our primary goal is over time to outperform Bitcoin, which is an extremely volatile asset, right? It's vol is somewhere in the 30, 40, 50 range, and they understand that MSTR is built to outperform Bitcoin, and as a result, when Bitcoin goes up, MSTR typically goes up more. When Bitcoin goes through a bear cycle like it is right now, MSTR can perform a little bit worse. But as long as MSTR is priced at greater than the net asset value of our Bitcoin, it means that our shareholders are giving us credit for the performance above Bitcoin. And when we do that, we can issue more equity for the most part. But we talk to our shareholders all the time. There's quite a few constituents, as you know, we're one of the most liquid stocks in the world. And when we talk to our shareholders, institutional, retail, we look at what people say in social media, we take a lot of comments. We bring that all in, and it's great to have the feedback.
And I mean, just looking forward again, I mentioned that, your cash reserves, they're $3 billion right now. It seems like you have several years of being able to cover your interest expenses. But I mean, when you game plan out in the future, 3 years, 5 years. It just feels like Bitcoin has been stuck in this rut for a while now, trading around $60,000 per coin or thereabouts. But do you have a break glass sort of plan if, we go down to 30,000 or 20,000 or even below?
Yeah, when Bitcoin gets down closer to 8 to 10,000 is when we're going to have, we have to consider some of the risk associated with our debt. Until that point in time, we feel very secure about the balance sheet. Look, to your point, Bitcoin has quite a bit of volatility. It goes up and down, and every time it's in a bear cycle like it is, people ask, okay, will it go to zero? And it hasn't yet in its 18-year history. In fact, it just achieves all-time highs. But what we need to do is build a capital structure that can withstand bear markets and, of course, benefit from bull cycles. And that's what we've done so far. We've been through this in 2022. We're going through it in 2026. And I'm pretty excited about the next bull market of Bitcoin.
So for those folks who are concerned that sort of strategy as being kind of the dominant buyer, or at least a perpetual buyer of Bitcoin, there's some reassurance you can give them that you are not gone from that market as a buyer?
We're not going anywhere. We're the largest identified holder of Bitcoin. My objective would be the largest buyer of Bitcoin for the foreseeable future. We're not going anywhere. Anybody that's worried about strategy shouldn't be. That said, Bitcoin's a lot bigger than us, right? We are 4% holder of Bitcoin. Bitcoin trades $30 to $40 billion a day. You saw a couple of weeks ago, we sold about $200 million of Bitcoin. It did not move the market. In fact, the market moved up during that period of time. So, but we're not going anywhere. We're sticking with Bitcoin for the long term. We'll be buyers of Bitcoin for the long term.
Okay, so you're not going anywhere. I do want to go back a little bit to the preferred shares because Bloomberg News did report last week that distressed funds, they're in talks to swap their preferred shares for other securities. Of course, that would be a negotiation. And with that in mind, can you give us an update on what those conversations sound like? What is actually developing there?
Yeah, there may be funds talking to each other about swaps. We haven't been any material conversations. The way we're going to make stretch work is we're going to continue to increase the U.S. dollar reserve. We're going to listen to the market. We've put out, the opportunity and the option to buy back stretch if it makes sense, but we're not in any material conversations otherwise.
And Feng, before we let you go, I want to reflect on strategy a little bit because you're the CEO of strategy. You're best known, of course, for being a Bitcoin treasury company, really the OG, but you also have a software business, and as of the end of March, you had more than 1,500 employees, and I'm wondering, sitting in the CEO chair, how much of your time do you divide between this ecosystem of financing that you've built up to accumulate more Bitcoin and the actual underlying software business?
I'll start with I'm an engineer really enjoy doing. 50-50, 40-60, a lot of the discipline is the same. And, keep in mind that the 1,500 employees, we have folks who are in finance and marketing, in engineering, in legal and accounting that are able to bring a maturity and 25 years of public company experience to our Bitcoin business that I think a lot of other companies that are in the Bitcoin or DeFi world aren't able to bring. And it's part of, I think, what makes us successful.
All right, Fong, really appreciate you taking time for us. Fong Lee there, the CEO over at STRC.
Trump is not doing the low government spending thing. He's going to inflate the dollar. He's going to print, but the printing is going to go towards the building. A lot of Bitcoiners thought that the Bitcoin revolution would happen from plebs just holding Bitcoin. That wasn't really a viable option.
My fear is that, unfortunately, on the other side, we have the takers who have never created a single dollar of economic growth in their life.
No one's buying that if you don't do it, China's going to do it and stuff. It's not motivating anyone. And that's what AI needs. It needs a corporate narrative.
There was a lot of noise because Bitcoin mining uses too much energy. Now it's AI data centers use too much energy.
The most humane way is a type of UBI for the sludge people who can't keep up. I don't want to. Some of these people aren't going to be able to change their minds.
As a master communicator and master of narratives, someone who's worked at the Senate Banking Committee, what is the master narrative that would sell this abundant future that you're talking about? I remember in Abu Dhabi, we talked all about the flood and all of that stuff. It's just interesting. Like, I'm all for conspiracy theories, but a lot of times, it's like not as conspiratorial as you think. And it's like there's these giants hiding, and if he's even afraid to even talk about it because they'll kill him, and it's like, come on, man, we got freaking phones these days, bro. Like, if there's giants, we'd freaking know about giants. And like, certainly there's like 8-foot guys in the NBA. Like, it's not that big of a secret.
No. I absolutely roll my eyes at all the UFO stuff, and always have. I don't believe in aliens or anything like that. But what I do believe is that just seeing how fake the news is over the past 10 years, let's say, and then realize that history is probably 10x faker. Like, we can't even get the last 20 years right. Like, you can ask half of the people randomly on the street, and they'll tell you Obama was the greatest president ever, Trump's a rapist. You're just going to get a fake version. Now, which one's real? That ends up being whoever wins the war. And so if we can't even get contemporary news right, what are our chances with history? It's a story. So all I'm saying is, I don't buy the story. Do I know what the real story is? No, not even close.
Do you think we're closer to truth today, even though we have more ability to manipulate and psyop, but because of the increased information, we might be closer to truth today than we were in the past?
We'll as we go through these times of change, you're already seeing the process. Like, we're reinterpreting the 1960s in America right now. We're reinterpreting World War II. If you ask the younger generation about World War II, it's not the same story we were told. World War I in particular, as Bitcoiners, we have reinterpreted for pretty much our entire Bitcoin existence. We don't buy the World War I story at all. And so this reinterpretation of history happens to be useful to the time you live in. So none of them are true. You just end up telling yourself a story that is useful to put the train back on the tracks and then re-experience a new kind of golden age. One day we'll destroy the one we're building now. We'll be back in a new period of anxiety, wondering about the time we live in now. It won't be us, but whoever else is there. So history is just a useful story that you can apply to get meaning out of the times you live in currently. So that's why it's so fake. It's not, no one, I mean, maybe someone's out there trying to trick you, but honestly, the people who win, good, bad, people we agree with, people we might have aligned with, reinterpret history as it relates to them, and then that becomes the official story going forward. We're doing it with Rome, we're doing it with all these places. You can't believe a word you hear about Rome. It's not even, it's fake,
All right. Nolan, give me a short 60-second introduction, like who you are, what's your key area of specialty and focus, and what have you been working on for most of your career?
Well, I'm trained as a lawyer. I never really practiced too much law. I worked in Japan for a little while, in fact, when Bitcoin was created. But in that period, I was in Canada as well. I went to law school in Canada, and there was a bit of a political revolution in Canada at the time. Stephen Harper was coming to power, a conservative, sort of a proto-MAGA time in Canada. The media hated us, that we couldn't win. U2 came and campaigned against us in 2004. But I was a young law student. We won. And this ended up giving me tremendous access to executive branch, legislative branch, research branch stuff. And I ended up working on the Canadian Senate Banking Committee. And the Senate Banking Committee is sort of the reason for Canada. Canada was created as a result of the US Civil War. But basically they were worried of commercial interests of the Union Army going up and taking all of Canada. That was a British colony at the time. So what ended up happening was London cut Canada off of money, because anything that was an investment for London and Canada just was seen as plunder, because the Grand Army of the Republic could have taken whatever was valuable. So they said, the city of London said we can't invest. So Canada got together and copied American federalism, but it put banking as a federal competency. So that's the one thing it did different than the United States. And so the Senate Banking Committee that I worked for was really the point of Canada. It's sort of the original committee. It has a certain amount of prestige, I guess you can say, in the sense that it's seen as kind of a think tank. It's not really contentious as a political body. It's not designed to be political. But I did a study of the financial crisis and then the FATF money laundering thing, and I had both liberals and conservatives furious about what a scam FATF was and how the whole money laundering regime wasn't working. They weren't catching anyone in Canada, and that had liberals super angry. But I heard about Bitcoin in that time in 2012, and so I got a Bitcoin study together in the Canadian Senate Banking Committee. I got Andreas Antonopoulos there. It was a big hit. We had a great time. Got some media out of it. That was kind of my job, was to get into media narratives, which is still kind of what I do, right? Hijack media narratives, find a way to get a story into the public consciousness. And so I did a magic trick, or a publicity stunt, or whatever you want to call it. When we tabled it in Parliament, I had the op return script already back in 2015. I used the op return to hash the report into Bitcoin's blockchain with a just a little slogan: Satoshi's invention deserves a light regulatory touch. This ended up getting worldwide media attention because it was just a fun thing for a committee to do. And so that got me in touch with the guys that were restarting CoinDesk in New York City. It had begun in London in 2013, but was moving because of financial distress. They did the whole Bitcoin balance sheet, but quite early in 2014. Not a great idea. Yeah. We had hundreds of Bitcoin on the balance sheet at CoinDesk, but had to sell it to keep the lights on. And finally, Barry Silbert bought it. And so I moved to New York City and helped build CoinDesk and the event up. But when I had a chance to go Bitcoin only, which is what Bitcoin Magazine did, I joined Bitcoin Magazine around the time of the Bukele show, 2021. And I worked with Bitcoin Magazine programming the events up until 2024. Throughout all that time, I had my own morning show, which is kind of an adaptation of Scott Adams' show, which was really just looking into persuasion, looking into what argument is going to carry the day. I run the mainstream legacy news through a Bitcoin lens and talk about what I think Bitcoiners are stressed about, worried about, thinking about, preoccupied with in the fiat world, and just try to track the change that we're all going through as Bitcoin and hard money finds its way into this soft system and starts changing it.
Money, politics, news commentary, social ability to digest those things. So I want to talk about, let's just jump in right there. So something I've talked a lot about is these technological revolution cycles that repeat on like this 50-year time frame, and how we're in one right now. And I think that AI and Bitcoin are both forming that up. And it's interesting to see sort of what Bitcoin has gone through, and now AI sort of going through the same thing. For example, there was a lot of noise, a lot of opponents of Bitcoin because Bitcoin mining uses too much energy. Now it's AI data centers use too much energy. Right? Too much water. Too much compared to what? So we're seeing sort of like the Bitcoin network and the AI network sort of going through these growing pains as they sort of move through, as all technology does from the Luddites' perspective. So how do you see those two things seemingly on opposite ends, but a lot of synergy between those things and how that's sort of changing synergy. How are you tracking that?
Well, don't forget, a lot of the Bitcoiners are setting up these data centers because Bitcoiners were the first to really understand this kind of real estate model of energy build out, which is kind of like the anchor tenant argument, right? So if you're trying to build a strip mall and you get a grocery store that puts a 30-year lease in your hands, you're going to be able to build the strip mall. So Bitcoin was the first to get into that with energy systems, and it ended up being Bitcoiners when the AI data centers needed to be built. I mean, you go and talk to any of the guys building them out in the UAE or in Texas. Very often, Bitcoiners, you look at what they're doing at Crusoe, for example. This was a stranded energy play that is now a hyperscaler. This is the Chase Lockmiller organization, and he was a Bitcoiner from the beginning. So the synergy comes because it's the same business model. But I can even talk about it in terms of the let's call it consequential change. When Satoshi Nakamoto came out with cryptography, his Bitcoin version in 2008, 2009, this was the first time cryptographic keys had been put into people's hands, right? They invented public key cryptography in the 70s. But that ended up being just co-opted by corporations because you were too stupid to manage your keys. So they developed the PKI system, the public key infrastructure. And even, going back further than that, cryptography was really just a state actor operation. It was for war. It really wasn't for anything else besides that. So after World War II, when the original computers were invented, which were for cryptography, the original, that's why we call them computers, right? They're not word processors. We don't call them that because they were used to compute big math and big numbers and were used in cryptography like the Alan Turing, Enigma, Bletchley Park in the UK. So after World War II, that's why cryptography was counted as a munition. It was counted as a bomb or a missile, and it had basically arms control around it around the world. So when Whitfield Diffie and Martin Hellman and Ralph Merkle came up with public key cryptography, it was the first civilian innovation in cryptography in hundreds of years since the Italian bankers. And what that ended up producing was a scenario where the companies then took over cryptography. So Bitcoin is the first instance where cryptography was put into individuals' hands. And this huge trickle down ended up creating Tether and ended up creating USDT. It created all these instruments because now cryptographic keys could be a US dollar. You got to think about what the money actually is. Is it paper? Is it a coin? By making cryptographic keys actually money, you're giving people the power of that cryptography, almost like math. That's why you hear about wizards and things like that. Now go and see what that leverage created by Tether and Paolo gave to someone like Trump when he got debanked simply for questioning the 2020 election. It was a don't trust, verify argument that he was saying. If you can't audit the elections in 2020, did we have an election? It sounded like an Ethereum transaction election. So no one bought it. And you didn't need enough proof that the 2020 election was stolen, right? And it was just like, can I prove it wasn't? No, so it's stolen. As Bitcoiners, we don't need any more proof than that. And that's what made Bitcoiners so attractive to Trump in the 2024 election, is that we had a worldview that didn't listen to political talking heads about the election. We didn't, on either side, I didn't have to hear Sidney Powell and her Kraken argument for how the election was stolen from Trump. We were able to just see there was no auditability. The whole thing is a scam. Now, what that ended up producing was this leverage that was created by Paolo and Tether and USDT and the early Bitcoiners and the psychological space that Bitcoiners were in. It allowed Trump to tap into that and bring a whole constituency into the forefront of American politics, thereby confirming Michael Saylor's bet, because he had already been suffering from fiat leverage and fiat manipulations in the sideways action of MicroStrategy in the stock over 20-something years with the stock buybacks and the inefficient fiat degradation of Wall Street and capital allocation. So that's where the story comes together. The AI data center story comes together with Bitcoin in terms of capital allocation. And you can see the human capital that's come to Bitcoin really predicted this, right? The cryptographers were the first, the Paolos were the first. The political people were next. Trump came around in 2024, but they were coming already in the 2012 Ron Paul reject failure guys that came out there and said politics aren't going to work. And then Wall Street came a little bit later, but you're seeing this happen in waves as it comes here. It was cryptographers. They had the power of cryptography. It was shared with political minds, political people. And then the Wall Street people came to it because the Wall Street people started to understand that the way fiat had denuded and denigrated and degraded Wall Street was taking risk out of the game. They made Wall Street into a porno. They made Wall Street into masturbation. There was no real risk. But a guy like Arthur Hayes, his company was, yesterday shut down, but this was a guy who wanted to fuck for real. He wanted to risk. He had to win and not win. Yeah. And so Bitcoin attracted the real hardcore Wall Street people that wanted to really bet. They didn't want to whack off. They didn't want to watch porno. They wanted the real thing. And so when you put the politics together with the markets and the power of cryptography, you end up getting almost a sovereignty stack. You can see it in the Tesla and the SpaceX IPO. You're seeing what pieces went into that, and you're seeing why the narrative was really so powerful around the SpaceX IPO, because you see the decentralized communications there with the satellites. You see the Bitcoin on the balance sheet. You see all of these things in that company, and you can see this trickle down. You can see what happened. It went cryptography. It went to politics. Michael Saylor had his Wall Street bet confirmed now that politics had aligned with the cryptographers, with this new elite class, and now you're seeing it manifesting in the most exciting company and narrative in the world. So that's where they come together. It comes together in fixing capital allocation in order to train investment on the energy build-out, which is what Bitcoin wants, which is what AI wants, which is not what the fiat Wall Street wants, but that's why Saylor made the bet.
If you hold Bitcoin, I want you to think about something just for a second. Not how you store it, but who gets it when you're gone. Most self-custody Bitcoiners have never tested if their family could access it if they were gone. Knowing where the keys are isn't the same as knowing how to use them. That's the technical side. But what they most often miss is the legal side. So even if your family found the keys and they knew how to use them, there's no legal structure telling them the Bitcoin is theirs or how it's supposed to pass to them. You see, Bitcoin that isn't properly retitled and documented could end up in probate. So it's not one problem, it's two. Yes, can your family physically access it, but is there a legal framework that says it's theirs? So if you want to find out, take a short 2-minute quiz and get your inheritance ready to score. Just go to unchained.com/Mark Moss. Again, that's unchained.com/Mark Moss. And it's definitely worth 2 minutes to find out that it's actually handled or not. So what you're saying is sort of like this this groundswell event, starting from the base layer, from the individual, growing up into eventually into the political and the Wall Street institutional complex. When you look at how technology reaches adoption, they call it the diffusion of innovation, and it has sort of like this bell curve, right? And so you sort of have like the creators and the early adopters, and then the early entrants, and then you have like the chasm. And the chasm has to be crossed. So something has to happen in the mainstream psychology to now bring in that sort of early majority kind of thing. So is that sort of how you're thinking about it? Like, of course, like in the beginning, it was the cypherpunks and it was the cryptographers. But eventually it comes for everybody. Eventually, every government, every institution, every bank comes into that.
That's what I'm seeing. Now, it doesn't mean we're still getting almost a fork in humanity that we saw after 2020, and you're seeing it play out in Bitcoin right now. Like you said, we're in this chasm, and people bet on Bitcoin early. But if they're not in the minority, if they're not in the rebellious phase, they're not altogether comfortable with Bitcoin being kind of imperial, if you will. Bitcoin is both we were talking before we went live a little bit about Egypt, and it reminds me of the Hermetic principles, right? Hermes Trismegistus, right? It was sort of a worldview. And one of the ones that he had was there are no opposites. It's all just a spectrum, and that black is white. It's just a different scale of black or white. And I think of America and Bitcoin much the same way. They were both revolutionary. America was begun as a revolutionary force, but simultaneously it's an imperial power. They're contradictions, but they're the same thing. And a lot of Bitcoiners have a problem with Bitcoin becoming this imperial force. It is revolutionary, but it's also imperial. And so we saw a fork kind of happen in humanity, I guess you can say, around COVID time. There are some people that are not going to be able to get off of this credentialist top-down system. They're not going to be able to change their worldview. A lot of Bitcoiners thought that the Bitcoin revolution would happen from plebs just holding Bitcoin. COVID taught me that wasn't really a viable option. It goes back to that human capital frame I was talking about. Bitcoin infecting and changing Wall Street, Bitcoin infecting and changing the energy industry. Those are the two pillars of this modern world, Wall Street and energy. And if it can re-coordinate the balance between these two, if it can retrain capital allocation, if it can retrain the psychology of markets, if it can retrain the time preference, as we hear a lot from the Austrians, then you're going to have this recalibrated situation, and you're going to get a Bitcoin standard. And a lot of people are going to be left behind from this because it is simply too difficult for some to be able to cross that chasm. Now, I don't want to see people left behind in a barbarous way. I think there are ways to handle this and pay for it, which is why we're going to this bimetallic system. I don't think we jump right to a Bitcoin standard. We end up in a world kind of like what El Salvador has already, or what Argentina has already, where you have one money for consumption, one money for saving. It's the world that existed in America before the Federal Reserve was created. We had silver for consumption. The farmers conducted themselves with silver. That was the money of exchange, of consumption. And then the Wall Street folks had the gold. That's what really the Wizard of Oz is all about, right? The Wizard of Oz, the movie, has nothing to do with the book in this sense. The movie was 30 years after the book. The book was written in the time of McKinley. It was written in the time of tariffs. It was written in anticipation of the Federal Reserve being created. And so it is really a story about, it wasn't ruby red slippers, it was silver slippers on a gold road. And with Bitcoin now, we have a chance to use fiat like Argentina does with the peso for consuming, and they use the dollar for saving. You go to Argentina and you ask them about how much they pay for their house or how much money they make in a year. They'll tell you in US dollars. You ask them how much this coffee or this Coca-Cola costs, they'll tell you in pesos. And so we have this bimetallic saving, consuming situation that looks like is imminent as we continue to move forward. It's what we see from MicroStrategy or strategy. It's what more or less they're doing. It's what a lot of Bitcoiners, how they already live. They'll spend their money in dollars and save in Bitcoin. So that's how I see it. It's an inevitable human capital.
So in order to get this sort of eventual world where AI and Bitcoin come together, and then all the things that brings. So now when you have AI, which then leads to robots, and then you have autonomous bots that can have money, and all the things, the agents, and all the things that opens up, we can see that requires a ton of energy. And to this bifurcation that you're talking about, I mean, we can look back through history and we can see that the rise of energy use leads to economic growth. But back to the bifurcation, the Luddites of the world are still trying to hamper the growth of energy, specifically in the United States and Europe specifically. They can't even run air conditioning over there. I mean, the insanity over there, right? And so you have politicians and stirring up the public to come out and revolt against these things. So what do you think about that? But more specifically, what do you think about that? It appears that potentially maybe our adversaries are stirring that up. China potentially stirring that up in the press to get people worked up. Do you put merit into that? And how do you see that rolling out or shaping out?
Yeah. I mean, I think most of Europe's trouble is because, I went to college in Europe, and a professor at the college I went to when the Ukraine-Russia war broke out actually came out and said in his investigation, almost all of the Greta craziness in Europe was actually all just Putin manipulation to get them so over the barrel, desperate for Russian oil because none of their other stupid ideas were ever going to work, that it was a trap. So the way I see it, I guess, playing out is arguments aren't going to work here. This is not an argument. We're so entrenched in our worlds now politically in America that arguments aren't really the thing that works. The thing that works is going to be building and doing. Telling people we can finance energy, nagging them, yelling at them. It's like with Bitcoin. You can do it till you're blue in the face, right? You can tell people you live in a cartel of the Federal Reserve and nobody cares. The way to win is to find new ways to make money and new ways that are beneficial to people. And in this case, it is energy. And so the only way for America to solve this problem right now is to really embrace, and you've heard the messaging from J.D. Vance, you're hearing it from Trump, it is the American system. It is the Henry Clay Hamiltonian American system, which has nothing to do with the free trade British capitalism. It's not the same system. The system that they're looking at is taking American capital and training it and targeting it on specific industries that will bring benefit to people. Weirdly, so I live in Vermont as well, but behind me here you see Montreal. Montreal and Quebec, probably going to separate from Canada shortly. Montreal and Quebec are examples of the system that Trump is trying to build. Montreal and Quebec have energy abundance. It's as energy rich as Texas. Simultaneous to that, they have a sovereign wealth fund in Quebec of about $600 or $700 billion. And that money gets used for public works all the time. So we pay about 6 cents a kilowatt hour for electricity here, which is fabulously cheap. Yeah. And then we go ahead and build, they just built 100 and something miles of new subway track. And it was all funded privately by the Sovereign Wealth Fund of Quebec. Canada does not have this Sovereign Wealth Fund. This is a Quebec thing. So this formula of sovereign wealth and directed investments in things that will be beneficial to all of your society, like we have in Quebec, is what Trump is trying to build in America. This is not the old Chamber of Commerce, Republicans, government spending has to be low. Trump is not doing the low government spending thing. He's going to inflate the dollar. He's going to print. But the printing is going to go towards the building. It's not just going to go to NGOs or to people who are writing essays or books or art or culture. It's going towards things that are practical and useful for people. And one of those is going to be cheap electricity. If Trump doesn't get electricity down, it doesn't matter how many people like him. It doesn't matter how many people hate him. He will not be president and his party will lose. So they have one thing they need to do, which is to create energy abundance in America, to make the cost of living cheaper. And that's the race right now. That is the entire race. And that's the point of what's going on. So this American system, this Hamiltonian, Henry Clay, Besant-led Treasury system that you're seeing in America, that's subordinated the Federal Reserve. That's the important distinction of this Trump administration from what we've seen before, is that Trump is subordinating the Federal Reserve to the Treasury. This is the reinstallation of the Republic system. This is America being revolutionary again. This is that, we've had 125 years of America as a revolutionary state. It lasted up until McKinley was assassinated, and then we start seeing the track towards the Federal Reserve and everything we've experienced since. So that was the American 125 years. Then we kind of got the London 125 years, and that was the Federal Reserve and everything that we got with fiat. We're at the end of that 250 years now. And so when I talked about the Hermes thing of the oscillation between revolutionary and imperial, here we are again. And this is the leverage. Bitcoin is the leverage that's going to be used, that is being used to turn America back into this revolutionary force, to turn America back into something that is guided by the Treasury and not the Federal Reserve. And so it's going to be guided by the Treasury. It's going to be making investments in Americans' quality of life, such as with energy and public works projects, Hoover Dam type stuff. And that's where we're headed.
Hey, do you know that instead of sending your tax money to the IRS, you could buy Bitcoin miners with it instead? Here's exactly how I do it. You see, mining hardware is 5-year property. And under bonus depreciation, which was dying, it was down to about 40% last year, and it was going to zero, the One Big Beautiful bill has reinstalled it back to 100% and made it permanent. So I can deduct the full cost of the machines in year 1. Now look, billionaires have run this play for over 40 years. They do it with real estate, oil and gas, rail cars, and it's the same provision in the code, but the only difference is what you own when it's done. So you see, I own the machines that produce the Bitcoin, but I don't have to do the work. Blockware does all that. Blockware sources the hardware, they secure the power, they run the sites, and my tax team, they structure it so the deduction actually works. You see, that's how I turn my taxes into Bitcoin. So if you want to try and do the same thing, check out Blockware today. To get started, just go to blockwaresolutions.com/market disruptors. Again, blockwaresolutions.com/market disruptors. Yeah, let's dig into that a little bit because it's something I've been talking about quite often, and I think it's extremely fascinating. When you think about making America great again, MAGA, and how polarizing that is, and what is making great again, and does that mean we're not great now, whatever. But to the point that you just said, like kind of going back to a previous era and not just like pre-whatever, 10 years ago or 20 years ago, pre-woke or whatever. No, all the way back to a completely different system, as you said, the Hamiltonian system. Now, you talk about the sovereign wealth funds. Obviously, throughout the Middle East, you can see how well that's worked for them. And you mentioned, Hoover Dam. You can see how well it worked for us in the past. So when we think about returning back to that type of a system, a Hamiltonian system where the Fed is subordinate to the Treasury, which I agree with that premise. I mean, they're certainly working together. The Fed is certainly accommodating what the government wants to do. But if we think about that, what does that mean, that Hamiltonian system, and then wanting to redirect it back into away from NGOs and back into building, turning credit creation back to the banks, as taking it away from the Federal Reserve? What does that look like?
Well, practically, starting with the first case study in this, or the first, let's say, hiring in this, it's the Fed chair himself, Kevin Warsh. Kevin Warsh doesn't come from the Jerome Powell world of I'm a lawyer, a compliance officer.
I'm an academic.
Janet Yellen. He's an allocator. He writes checks. And he's there. People can say, oh, Kevin Warsh is there to follow the president's rule and the president's orders. Not exactly. The president's orders happen to be what his specialty is, which is VC checks being cut for fundamental change, like energy. He's written AI data center checks. So the first beginning of this is you have a capital allocator, not a technocrat, a capital allocator as the Fed chair. And so he's there to run a mission. It's his own mission. He believes in it, but it happens to be what Trump wants him to do anyway. So what it looks like next is you start hearing the massive leverage of the American government being used for these types of projects. You start hearing about, Trump's got all these ideas about what he wants to do with Freedom Cities, a contest, creating new energy. He created that whole opt-in regime in America for the AI data centers folks, where they have to build energy out. They can't use the infrastructure that's already there. They're not allowed to use the public grid. They've got to add to the grid by adding more energy. And that's what it ends up looking like, is very simple. When you have government as the, when America decided to do its whole Triffin dilemma thing, get rid of the gold standard, go with the financialization, go with the London system. When you look at what happened in the 60s and 70s, manufacturing gone, there was no more impetus to build more energy. You go back and look at the hydro dams that they built in Michigan for Henry Ford. Henry Ford built the Red River, the River Rouge, or whatever they call the dam, to supply energy to Ford to build auto cars. Now, if you're not building, there's no one asking for this stuff to get done. So that's why the promise of Nixon, for example, the thousands of nuclear reactors we were supposed to have never got built, because you put it all into the hands of the government. The government was the only builder of electrical capacity after that. They were the client of all of the energy systems in the world, or in America anyway. And so because the motivating factor for energy build out was the government, they were the leader, they were terrible at it. And so we never got a nuclear reactor. We haven't had we had a reactor go critical 2 weeks ago or something. We haven't had a reactor go critical in decades. And so now that private industry is back and demanding more energy, they're going to figure out how to get it. And it's not being left up to me. Worst of all, the energy stuff was left up to municipal governments because it was sort of seen as a local thing. Wasn't even left up to state governments or federal governments. So worst of all, they picked the most backwards, incompetent level of bureaucracy in America to handle our energy build out. If there's anything more fiat than that, I can't think of it. Imagine we let the lowest tier fiat operators in the American system, the municipal people, the Mamdanis, the Karen Basses, they were in charge of electrical output or electrical grid increases. They're not going to do that. They don't know what they're doing. They shouldn't be asked to do that. They're not. They should be. It's the roads and shut up. So from there, that's what it starts to look like. It starts to look like a federal policy that is right now just voluntary, telling the AI data centers to build your own energy, but it's going to become mandatory eventually. As I said, I don't think Trump or any political party can survive expensive electrical bills right now.
Yeah. Well, I mean, a lot of people are against the data centers because, one, they use too much energy, two, they use too much water, and three, they drive electricity prices up. But neither of those, none of those three things are true. And sort of like Bitcoin mining, they actually help produce cheap, low-cost energy. But
unfortunately, big tech in America are still Democrat people. They're still going on their political shop talking points. China's going to do it. No one's buying that. No one's buying that we can't, if you don't do it, China's going to do it and stuff. It's not motivating anyone. So one of the problems that exists in America is that big tech remains unwilling to cut checks on narrative, let's say. And that's what AI needs. It needs a corporate narrative. Like you said, it doesn't have the story. It's just you're stealing our water, you're making our electricity go expensive. What they need to start being able to sell is a golden age. What do we get from abundant energy? What does abundant energy and cheap energy look like in America? No one's out there promising that. That's the answer. The answer is no. Build a data center because you're going to get cheaper energy. Once people start talking about the energy capacity being increased, we don't even want to hear about the data. Who cares about data centers after that? Their only mission, and they're gonna learn one way or the other that they have to get on that mission about energy abundance, because that is the actual way to get all of their AI data centers built in the end. They need to create more nuclear reactors, more solar battery type setups, more hydro dams. Wind sucks too bad to bother with this system, but there's plenty of options out there. You gas, coal, whatever you got, let's go, burn it.
So as a master communicator and master of narratives, someone who's worked at the Senate Banking Committee, you said we need to have a better narrative, a better story. I might argue that nobody cares about their electricity prices going down, and probably nobody knows what their kilowatt per hour is right now anyway. What is the master narrative that would sell this abundant future that you're talking about, this Hamiltonian abundant future?
I'll go back to what we saw with the SpaceX IPO. And don't forget, the SpaceX project down in Texas, right at the borderland type of thing, is also now a company town. It's like we used to have these in the old mining days, right? Company towns. And it used to be they paid you in their script, right? They paid you in their shit coins, and the mining times and the Wild West and all that stuff, the gold rush. But right there, once you see that he's been able to build a kind of breakaway society down in Starbase, Texas, and you're starting to see that as a kind of proto-Bitcoin citadel, if you will, you're going to start to see a lot of these communities gather around this energy abundance. And the people who don't want it, they're just going to live as Luddites, as you said. And so what we see down there in SpaceX, and of course, as you know, SpaceX, the whole thing was a narrative sale, right? They're not really going on fundamentals anymore. We're going on the narrative of what SpaceX is able to produce, what they will produce. And I'm with you. I don't know about living on Mars and any of that stuff. There's plenty of work here to do, but terraformation, so the thing they have to learn how to do, which is to settle inhospitable environments as other planetary bodies like the moon and and Mars would be, they got to learn how to do that. The only way to do that is to start replicating what we already did with Texas. Now, Texas, when they figured out Spindletop, nobody lived in Texas till the 1950s when they invented air conditioning. You lived in Texas as a kind of a penance. It was like a penalty to go there.
Yeah.
And spend time there and mine.
Have you ever been to Phoenix, Arizona?
It's hot. It's hot. It's hot. Yeah. These places don't exist without air conditioning. Singapore doesn't exist without air conditioning. None of these places exist without air conditioning. So the way forward is to start manipulating our environment more, but now in colder places, in places that are inhospitable, not for too much heat, but for too much cold or wind or whatever the problem is. Because there's stuff there, there's reasons why we want to be there. So uncovering more of Greenland, for example, is probably where this all heads, right? Going up to Greenland, remember the American system of colonization is to go and build, and then the people who build it get it. The British figured that out really quickly. They hired in the Revolutionary War, they hired some German soldiers to come over as sellswords to come and fight the stupid George Washington rebels. And when they landed in Long Island and they took one look at the average American's house on Long Island, they said, we can't fight these people. What are you talking about? This is how they live? They're this rich and you want us to kill them? We're not. We're joining this side. So right away, the king understood he had a major, major problem on his hands because the American system was so attractive to normal people because they could get get money out of it, that they had to stop it. A lot of people believe, and now when I said we're reinterpreting history, since I found that out, I've understood, Marie Antoinette never said, let them eat cake. That never happened. The French Revolution was because the French were going to the American system. They were going to go on the same system. You build it, you get it. You go and build Phoenix, Arizona, that's yours. You go and build Chicago, that's yours. You go and build whatever, it's yours. That's how the American system works. You build, you get. It's not some financialization, colonialization thing. So the British understood right then and there with the American Revolution that the only way for this little financialized island to stay in charge of the world was the divide and conquer mechanism. They invented it right then and there. They invented it for France. And that's where you see this manipulation go into the Napoleonic Wars. Famously, the Rothschilds, of course, owned both sides of the market and bet against, Napoleon and Wellington. And many people know what happened as a result. They gained control of the London market. That didn't stop. They kept going. They went after Andrew Jackson the same way. Then they went after the Civil War. The British funded that. They never stopped the divide and conquer system. And this divide and conquer system is to prevent an American system from taking root and rewarding the builders. It rewards the dividers, it rewards the financiers, it rewards that sort of imperialistic extraction system. And so we're at the culmination of this fight. As I said, America went 125 years as the American system, and then finally was subdued with the German World War I. They were on a gold standard. America joined the fiat British, collateralize our birth certificates, create the temporary income tax, buy war bonds. It was the greatest war finance mousetrap ever invented. Germans had no hope. And we whipped their ass. And from then on, we were in this British system because it worked. It made us rich, right? That's all that matters in the end, I guess, for people's decisions. And so now we're seeing with what Trump is doing in Greenland. Greenland is America now. All he has to do is put a couple nuclear reactors up there and it's America. Who cares about the town of Nuuk and their stupid dental plans paid for by the Danish? The rest of it is open for business and is open to American colonization. I think NATO's already confirmed it. I think the brains of these people just can't accept that it's already America, but you'll see the maps change soon enough.
Okay, so I got to tell you what I've been doing with my money lately. I moved my cash over to River, and before you ask, yes, I still pay all my bills in dollars. Everything works the same, but here's the real difference. You see, River pays me 3.3% on my cash, and they pay it in Bitcoin. So my money that was just sitting there doing nothing at all in the bank, it's now stacking Bitcoin while I sleep. And I started thinking, like, my bank takes my deposits, they loan those deposits out, they make 12, 17, 24%, and they pay me 0.04%. I mean, honestly, that's kind of a shakedown when you think about it. Now, River's FDIC insured, they use full reserve, they charge no fees. So I don't know why I didn't do this sooner. So click the link down below and get $100 in Bitcoin just for getting started. You talked about the divide and conquer, and you start looking at like the types of people in the world and dividing them in half, if you will, right? And it's like you have the creators, you have the consumers, and you have the fighters and you have the pacifists. And so like from a creator lens, someone who has built and sold companies, and with my fund, we fund private companies. I see the vision, I see the build plan, and I see the abundant future that creates. Unfortunately, on the other side, we have the takers. Elon Musk has been calling that out, right? The makers and the takers, the Bernie Sanders, who have never created a single dollar of economic growth in their life. All they want to do is take. My fear is that as optimistic as I am, and it sounds like you are as well, and I can see the path to this abundant future, the rise of the takers seemingly is rising pretty quickly around the world. I mean, you mentioned Mondami earlier, taking the crown jewel of the United States, if you will, and now quickly appointing many other people. The DSA party sort of taking over the Democrat Party pretty quickly here. So what do you think, how do you see that battle shaping up? And do you think the draw to abundance is going to be too powerful and overwhelm that? Or, what percentage chance do you give to these takers of stifling that?
Well, in most countries, I would say pretty high, but America is different. We've seen this stuff, maybe not so much before, but go back and remember the Weather Underground in the 1968 presidential election. Americans turned against that kind of violence. Now, it doesn't look like, things have gotten much worse this time around, if you will. So, and it is spreading quickly. A wealth tax 10 years ago to Americans would have seen 95% would have said it's communist. we're at like 60-40 now or something like that. So that's a big change, right? It's a very big change, mostly as a result of the
immigration,
the weapons grade psyops that are being unleashed on the American mind every day, right? On all sides, just the constant slamming, manipulation, nudging, urging, prompt engineering, right? That's in the end one of the things I've learned from AI. You know, people at the remember when AI came out and everyone's like, when is AI going to beat humans? We're so smart. And I was like, wait a minute, hold on. How smart are we? And now that I see how easy it is to prompt engineer people, if I say patterns 369, you can't stop yourself from finishing it. That's human nature. So all of us are susceptible to prompt engineering. Trump, that's all he is a prompt engineer of humans. One of the best we've ever seen. He's a prompt engineer of humans. He looks at a bunch of humans and types in the thing, and then they just do what he wants them to do. It's an remarkable skill. So everything is coming down to persuasion in the end. It is a persuasion game now. Money, you know, we've taught money for a long time in terms of math because there's numbers. There's not numbers really that are important. It's psychological. US dollar is a psychological commodity. Bitcoin is a psychological commodity. And so the type of world that psychological commodity is able to build is in itself attractive or not. I think we're in control of our own destiny here in the way that, you know, you hear about a baseball magic number to qualify for the playoffs or something. If we build, we win. If we don't build, we lose. And if we sit around arguing about Trump or this or the, you know, even the culture war stuff, like I don't care about Ulysses and he's got a black whatever her name is, and you know, like it's a waste of time. So no, I don't, you know, I'm indifferent to it, but wasting all of your energy on not building, wasting all of your energy on fighting wars that are going to be decided by wealth versus poverty anyway, not by arguments. We're not in a world where people are like, oh my God, now that you say that, I realize I'm wrong. No one thinks like that anymore. So you persuade by building, you persuade by, you know, you hear it a lot that politics are downstream of culture. Well, culture is downstream of money. And so if you fix the money, you can fix the culture, and that can fix the politics.
When you say fixing the money, does that mean like going back to Bitcoin, a Bitcoin standard, a sound money standard, or is that like way too far off? And so when you say fix the money, it's like, well, let's just fix the current Fed regime and push the money back through at least through private businesses and through private banking, and then eventually we get back to the sound money. Is that fixing
I don't think we can make a jump to a full Bitcoin standard. It's just too violent. It's too rough. It's too, I don't think many people have the stomach for what that means. That is a depopulation event, I think. And so the most humane way is a type of UBI for the sludge people who can't keep up. I don't want to kill anyone, right? But some of these people aren't going to be able to change their minds. Like, I don't want anyone to die. But how are you going to how are these journalists that are snickering at Elon Musk going to make it in the future? There's no job waiting for them. And so how do they make it? I mean, I do think we are headed to a type of the fiat money around the world asked to be one thing. It asked to be public policy money, government word money. And so they're going to get what they asked for. They're going to be public policy money. It's going to be designed not to pay bureaucrats anymore, but to fund the lifestyles and consumption habits of people who simply can't adapt to the change. And bimetallism, this dollar Bitcoin system, will last as long as that system lasts. Eventually, I do believe we'll be able to, I guess you could say, discipline markets and sort of purify markets in a sense. You know, we don't want the best and brightest to be on Wall Street anymore. That's something we absolutely need to change. That the main problem right now that I see with fiat is that the best and brightest will do whatever job pays the best. Doesn't matter what. And if you do 80 years of financial engineer as the highest paid job in your society, what are you going to get? You're going to get all the highest IQ people in one part of the room. And what did that do to everybody else? I don't care what the best and brightest do, but in this case, the consequences of them being in the markets have meant that every single other person has to keep up with their IQ. And that's asking too much of a blue collar guy. He should be able to save money and be good at his job. And putting all the high IQ people into one corner and telling them to work on Wall Street, because you'll get paid more, created this problem. So we still will have a Wall Street. It just has to be completely shrunken in size and importance. You need people who really understand the meticulous nature of yield and return on investment, not just this, can I get some cheap capital, throw it. Can I get more cheap capital, dump it there. That's the strategy we have now, and that's a fiat strategy. It's not going to work going forward. So this bimetallic system will focus on the builders by rewarding them, and will keep the sludge people and parasites alive to see how many of them can evolve, you know?
When you think about this path that you're talking about, fixing the money, and the problem of this financial engineering sort of left people out, and the fact that they can't save in their own money, which of course we think that sound money, Bitcoin can fix that. But in the meantime, how do we get from there to here to there? So the stock market has been that place for the average person to sort of just throw it in the stock market. The S&P 500 sort of rises with the rise of money, with the money supply, et cetera. One interesting thing that we're seeing, and I'm curious your take on that, because there's bills that were passed from the new Trump administration, the Genius Act, the Clarity Act that's being held up right now. But a lot of those were about stable coins, the digitization of money, and the ability to tokenize shares. And so I see this change happening where we can already see that public companies are dwindling. Like less and less companies are going public today. Sam Altman said that we'll now start seeing billion-dollar single-person businesses. So now we're starting to see the rise of these AI companies that are growing to be hundreds of millions, billions of dollars with small teams, 10, 20, 30, 40 people. And it's starting to happen much faster and faster today. Those companies don't appear to be going public. They're staying small private companies. And back to your point of attracting the best and brightest, and I see a lot of growth in that area. I see the public stock market already having less participation. I see the rise of these companies, and seemingly a lot of the best companies are staying private. Mm-hmm. Now, that leaves out the Joe Sludge people you were talking about, because they can't just chip their money into the stock market and participate in this growth, because now the companies are private. That leads to a problem that seemingly, potentially, some of these Genius Act, Clarity Acts could potentially solve if we could get some of this tokenization through, right? If these private companies could tokenize, and some of the assets that they own could be tokenized, would that bring the liquidity back for these Joe Sludge people that can't participate in this? I mean, are you looking at these bills as part of this transformative process?
Quick question. How much control do you have over your money right now? Technology's changed everything, and now it's changing how money works. Crypto started as a niche, but now it's going mainstream. It's faster payments, more control, fewer middlemen. This isn't hype, it's just where things are going. And getting started today, it's easier than you think. With a Rumble wallet, you can buy Bitcoin, you can hold dollar-backed stablecoins, you can even own digital gold backed by real gold, and it's all in one single place. It's a non-custodial crypto wallet, which means that not a bank, but you hold it. Not a bank, not a platform, you controlled access to your funds. The setup's super simple. It connects with MoonPay, so you can use your debit card, your credit card, your bank account, and you can be up and running in minutes. And for a limited time, you can start your wallet with $10 in US stable coins by downloading the Rumble wallet and entering my exclusive promo code MOS10 when you sign up right now. You can even use your Rumble wallet to support your favorite Rumble creators, maybe like me, directly. So do this right now. Scan the QR code on the screen, click the link in the description, or go to wallet.rumble.com/moss and download your Rumble wallet. Now from there, you can set up your wallet, enter promo code MOS10 to get $10 in US stablecoins. And this is a limited time offer, so you got to do it right now. But take control of your money. Get started with Rumble Wallet today. Of course, terms and conditions apply. See the description below or visit rumble.com/promo-official-rules for details.
Yeah, I think so, because even today, access is a problem. I mean, you go look at all those A16Z guys who get included in every round early. How are you going to beat them? Like, no one could compete with that. They get everything free instantly all the time. So I go back. You ever heard of this guy, Ronald Coase? Long dead now, but he won the Nobel Prize a couple of years ago in economics. He won the fake Nobel in economics. But he was a lawyer, actually, had nothing to do with economics at all. And I always anticipated he would be a big deal in Bitcoin. It hasn't quite happened. He lived like 100 and something years, like 110 or something, crazy. So he's known for this. It's called the theory of the firm. So why companies exist in the first place. How did this happen? What's going on here? And it comes from law. You take pure law. It's a noise complaint, right? You're making too much noise. I'm complaining about it. We go to a judge. The judge comes right down in the middle. He says, you, to me, don't worry about it if it's before 10 o'clock at night. You don't have a right to complain. He's going to go to you, shut up after 10. We're all going to walk away happy, right? So Coase theorem starts with that premise. That's the law. That's how it's supposed to work. What ended up happening was, and this is what, it was like a 7-page paper he won the Nobel Prize for too. It was called, basically the theory of the firm is transaction externalities create this situation where the company grows and exists. Now, what it does is instead of hiring a lawyer each time they have a noise complaint, they just have an in-house lawyer. They just hire a lawyer. And then that's easy. Anytime there's a noise complaint, send your lawyer. You don't even have to bother with it. And then, yeah, I'm even annoyed by having to send my lawyer. So why don't I hire a lobbyist? And the lobbyist is going to go change the laws. And then suddenly you see the imbalance. So his whole point was that the ability of the system to corrupt the system, the ability of the system to be corrupted is what helps grow these companies. More transaction externalities, more people getting involved in simple acts. So what I like about tokenization is it does exactly that. You don't need to use other people. You don't need to hire a professional to tokenize. You just hit a button and it goes. And so when you shrink and keep the company that small, you stop hiring the lobbyist, you stop hiring the lawyer, you stop hiring all these other things. And we've seen this trend over time. Like the biggest companies on the S&P 500 have shrunk every decade for 80 years now. The average people in the company, top 10, whatever. And as they said, you're going to get more. And indeed, I think you're right about that, because once you get rid of all these other people you have to take care of in the company, you can actually start now cultivating a relationship with your clients, with your customers, with people who really believe in you. You're shrinking the distance between you as a moral, a company is a person, because that's what he was arguing. Like, how do these people that are companies grow to be so powerful? Because that's what we call them, right? They're called moral people. In order to take obligations and responsibilities and be in a contract with a person, it has to be a person. Only people can be in contracts. So when you start limiting all of this corporate architecture and all this need for more externalities, theoretically you get to a point where the friction is gone and you can start having this synthesis that I don't think is IQ dependent. I mean, plenty of people can say and have ideas, that business is going to work, that business is going to be great. They just don't even know how to invest in it now. This is going to make that a lot simpler, I think.
Yeah, there's no access. And that changes the access. So as the market changes, bills like this become very important if Joe on the street is going to be able to continue to build that wealth until we get to the sound money phase. Of course, anyone can just buy sound money right now. You can buy gold or Bitcoin today. You don't have to wait for the whole system to change. That's a big piece of it. Yeah, all right. That's something I've been thinking about quite a bit, how that changes things. What's interesting is that I'm sure you're an avid user of AI. I mean, I'm in it all day, every day. I recently built up the Carpathy LLM wiki. I don't know if you saw that going around. So I built that up, and that was like this huge unlock. And now I'm running this Gary Tan G-Brain. Have you heard of that?
No, I haven't seen it yet.
Okay. So you mentioned prompt engineering, right? And so AI was all about prompt engineering. This is who I want you to be. This is what I'm trying to do. Here's the context around what I'm asking, right? And you're giving it this prompt. And the problem is the context, right? So if Joe Blow walked up off the street, and is like, hey, Nolan, should I sell my business? Like, you have no context to answer that question within, right? And so even if I give it a long 10-minute prompt, it's still not enough context. So now the new phase is like, how do I give the AI enough context? And so now when you create the second brain, so like the G brain is the one I'm running, and it is like the biggest unlock. I've been running for a couple weeks now.
I mean, it is like, because I'm struggling with that. Once you give them too many prompts, they become
okay.
So
forget the prompts. Prompts are done. So you could just look up the Carpathy, who was the founder, I think, of Claude, and now it's at OpenAI. But he created the LLM wiki. You can go on the GitHub, throw it in the Cloud Code, it'll set up for you. It's a 20-minute setup, easy. The G brain is a little bit more in depth, but it's way smarter. But the point is it has the context of everything. So all my Slack messages, my Notion, all my Zoom transcripts, all my email, like everything goes in there. It has context of everything. And then I can use any LLM I want. I can jump from Claude to ChatGPT, whatever, and it doesn't use that for the context. The context is in my brain. And now with the new models, the Fable on Claude and the Soul 5.6 on ChatGPT, because they have so much bigger context windows, tokens, and now they have all the context. What you're able to get out of these things is just mind blowing to where it was even just a few months ago. Like it is like a whole nother level. And anyway, the point to that is that like this is all happening so rapidly. And the AI agents piece specifically is blowing out. And I just referenced that because when we think back to the rise of AI and Bitcoin and stable coins as a way for AI agents to make payments and things like that, I think the average person isn't prepared for the explosion of growth there, because when we saw previous technologies like the internet, for example, old people were afraid to put their credit card in. Older people are tech adverse, right? So it's really hard, back to that diffusion of innovation, it's really hard to get people to start using it. But the demand for this stuff is coming from the AI itself. The AI agents are the ones demanding the stablecoins or the Bitcoin payment rails. They're the ones that are demanding the more energy, et cetera. And so that is going to grow things faster than we've ever seen. And so I think the rate of change that we're expecting to see is faster than most people can anticipate. And so when we think about that from a market perspective, well, both, as you said, the infrastructure build out the demand for the energy, but even going back into the Genius Act and the Token Act and things like that, like it's going to change pretty quickly. It's going to change faster than most people think. Like I said, where I'm at with what I'm doing on AI today compared to where I was even just a month ago is like a light year. I mean, it's insane. So
I'm not planning on, you know, the way I think about it is all of the, more or less what we think of as jobs, everything probably has another 3-4 years left maximum. I'm just guessing that seems like I'm being prudent. But I'm optimistic because when I look at what jobs are going to be next, you know, if all these jobs are all the laptop jobs, all the email jobs, everything, even Wall Street stuff, you know, the jobs that we're not good at anymore are still waiting to be filled. Mother, father, brother, sister, wife, husband. We're terrible at these jobs.
yeah,
We couldn't be worse. And these jobs are waiting to be filled. And this will go a long way towards solving the division in America. You know, just having a brother do his job really, or a sister do their job really. You know how many sludge people that could save? You know how many people in America just need one person to be like, hey, you know, this is all a bad idea.
Yeah.
Right?
Yeah. Well, Nolan, we have many times talked for hours and hours and hours. We can keep going, but let's wrap it up. Let me ask you one last question. You seem to be an optimist like I am. I appreciate that. I think Elon Musk said, I'd rather be an optimist, be wrong, than a pessimist and be right. And because the builders, you have to be optimistic or you don't build, right? But anyway, so what's one thing you're most optimistic about for Bitcoin and sort of this greater sort of tech build out over the next, call it 18 to 24 months?
I think that these citadels are going to come together, believe it or not. I look at the proto citadels that we have in America today. I think of those as the pub key. I think of those as the Bitcoin park. I think of Bitcoiners coming together to spend social time in a kind of breakaway society-ish thing. We see it at Bitcoin events a lot, but you know, the Bitcoin meetup culture was this from the beginning. I think that these Bitcoin proto citadels, you see what they're doing in Lugano with Plan B. You see what's going on in El Salvador. We got another one in Tokyo. You got one in Thailand. You got one in Singapore. San Francisco has Presidio, space in Denver. So that means, you know, we're at 8 or 9 in America. We're at, I don't know how many in the world. And then you mix in the SpaceX city, Starbase, and then you say to yourself, wait a minute here. You know, Trump's doing a Freedom City contest before he leaves office. He's been talking about this for a while, about building 10 cities on federal land. And you put all that together, and I think within the next 2 years, let's say, you're going to have the full articulation of the Bitcoin American golden age really put to people. You know, SpaceX is a bit of a company town. It's not quite there. It's not deliberately Bitcoin. I don't think you need to shoot rockets into space in order to have a Bitcoin citadel. But again, just this idea of building an energy system, paying for it because of the real estate type model, and then watching a kind of culture form around it of builders, of real builders. Again, go back to this explicit American system that I was talking about in Greenland and the Wild West. You know, you build it, you get it. That's not the British extraction system. You're not reporting back to the Home Office about your findings and returns on the colony. You're building the colony and it's yours. And so that ownership and that direction, and seeing Bitcoiners, you know, if we get the kind of step up that we imagine happens in the next cycle, you're going to have more than just Paolo who's going to be able to pay for his own Bitcoin city. And you got a Trump contest going on in America. We got a lot of land. We're not rebuilding Mamdani's New York. I mean, it's one of the disappointments I get. I lived in New York City during COVID and, you know, ran away because of the George Floyd thing. But I still remember, because I didn't care about COVID. I was walking around the city doing my thing and it was just empty. And I remember saying to myself, you know, this would be a great opportunity to fix New York City. You know, you listen to the Manhattan Bridge and the noise that comes off of that when the train crosses it. Like it's the loudest, stupidest outdoor industrial revolution, 1800s infrastructure you can imagine. New York City's a 19th century city in many ways. Forget about the skyscrapers. I said, maybe we take a break and rebuild New York. That was just before George Floyd. After George Floyd, I said, you know what? Maybe we're not rebuilding this thing. Maybe we're going to build new cities. And so I'm at that point now where I don't think the next thing in Bitcoin is an argument. I think the next thing in Bitcoin is someone building something that is so amazing that it actually lets people know what the future looks like more than any argument that could be made, any book that can be written. And it begins with farming and energy and family-oriented Bitcoiners breaking away from society and building something we haven't seen in over 100 years in America, a new city in a new place that was inhospitable and uninhabitable before, a reemergence of a kind of Texas or Arizona or something like that in a place that is inhospitable now.
Yeah.
And so maybe it's Greenland, maybe it's the desert. I don't know where it is, but Bitcoiners are going to build something that is the future. In the way that Starbase and SpaceX are the future today.
The sovereign individual thesis playing out in real life. Well, that's a good place to wrap it up, Nolan. Like I said, we could talk for hours. I love talking to you. And you talk every day, I think, right? You're still doing your morning show every day. Where can people go follow you? Where can they go follow your work and keep up with you?
I took a little break over the past month. We had a few changes. We've shut down most of Roxham TV. I don't know if you heard about that. But I was working with Roxham for the past little while, but we shut down most operations at the end of June. But big things coming. I'll let you know. We've got new show starting next week. I'll be on Simply Bitcoin next week. And one other big announcement coming, but I can't share it quite yet. But I know a little more about citadels than most people, put it that way.
Good. All right, we'll wrap it up with that. Thanks so much, Nolan. So something I've talked a lot about is these technological revolution cycles that repeat on like this 50-year time frame, and how we're in one right now. And I think that AI and Bitcoin are both forming that up. And it's interesting to see sort of what Bitcoin has gone through and now AI sort of going through the same thing. For example, there was a lot of noise, a lot of opponents of Bitcoin because Bitcoin mining uses too much energy. Now it's AI data centers use too much energy. Right? Too much water. Too much compared to what? So we're seeing sort of like the Bitcoin network and the AI network sort of going through these growing pains as they sort of move through, as all technology does from the Luddites' perspective. So how do you see those two things seemingly on opposite ends, but a lot of synergy between those things, and how that's sort of changing synergy? How are you tracking that?
Well, don't forget, a lot of the Bitcoiners are setting up these data centers because Bitcoiners were the first to really understand this kind of real estate model of energy build out, which is kind of like the anchor tenant argument, right? So if you're trying to build a strip mall and you get a grocery store that puts a 30-year lease in your hands, you're going to be able to build the strip mall. So Bitcoin was the first to get into that with energy systems, and it ended up being Bitcoiners when the AI data centers needed to be built. I mean, you go and talk to any of the guys building them out in the UAE or in Texas. Very often, Bitcoiners, you look at what they're doing at Crusoe, for example. This was a stranded energy play that is now a hyperscaler. This is the Chase Lockmiller organization, and he was a Bitcoiner from the beginning. So the synergy comes because it's the same business model. But I can even talk about it in terms of the let's call it consequential change. When Satoshi Nakamoto came out with cryptography, his Bitcoin version in 2008, 2009. This was the first time cryptographic keys had been put into people's hands, right? They invented public key cryptography in the 70s, but that ended up being just co-opted by corporations because you were too stupid to manage your keys. So they developed the PKI system, the public key infrastructure. And even, going back further than that, cryptography was really just a state actor operation. It was for war. It really wasn't for anything else besides that. So after World War II, when the original computers were invented, which were for cryptography, that's why we call them computers, right? They're not word processors. We don't call them that because they were used to compute big math and big numbers, and were used in cryptography like the Alan Turing, Enigma, Bletchley Park in the UK. So after World War II, that's why cryptography was counted as a munition. It was counted as a bomb or a missile, and it had, basically arms control around it around the world. So when Whitfield Diffie and Martin Hellman and Ralph Merkle came up with public key cryptography, it was the first civilian innovation in cryptography in hundreds of years since the Italian bankers. And what that ended up producing was a scenario where the companies then took over cryptography. So Bitcoin is the first instance where cryptography was put into individuals' hands. And this huge trickle down ended up creating Tether, and ended up creating USDT. It created all these instruments because now cryptographic keys could be a US dollar. You got to think about what the money actually is. Is it paper? Is it a coin? By making cryptographic keys actually money, you're giving people the power of that cryptography, almost like math. That's why you hear about wizards and things like that. Now go and see what that leverage created by Tether and Paolo gave to someone like Trump when he got debanked simply for questioning the 2020 election. It was a don't trust, verify argument that he was saying. If you can't audit the elections in 2020, did we have an election? It sounded like an Ethereum transaction election. So no one bought it. And you didn't need enough proof that the 2020 election was stolen, right? And it was just like, can I prove it wasn't? No, so it's stolen. As Bitcoiners, we don't need any more proof than that. And that's what made Bitcoiners so attractive to Trump in the 2024 election, is that we had a worldview that didn't listen to political talking heads about the election. We didn't, on either side, I didn't have to hear Sidney Powell and her Kraken argument for how the election was stolen from Trump. We were able to just see there was no auditability. The whole thing is a scam. Now, what that ended up producing was this leverage that was created by Paolo and Tether and USDT and the early Bitcoiners and the psychological space that Bitcoiners were in. It allowed Trump to tap into that and bring a whole constituency into the forefront of American politics, thereby confirming Michael Saylor's bet, because he had already been suffering from fiat leverage and fiat manipulations in the sideways action of MicroStrategy in the stock over 20-something years with the stock buybacks and the inefficient fiat degradation of Wall Street and capital allocation. So that's where the story comes together. The AI data center story comes together with Bitcoin in terms of capital allocation. And you can see the human capital that's come to Bitcoin really predicted this, right? The cryptographers were the first, the Paolos were the first. The political people were next. Trump came around in 2024, but they were coming already in the 2012 Ron Paul reject failure guys that came out there and said politics aren't going to work. And then Wall Street came a little bit later, but you're seeing this happen in waves as it comes here. It was cryptographers. They had the power of cryptography. It was shared with political minds, political people. And then the Wall Street people came to it because the Wall Street people started to understand that the way fiat had denuded and denigrated and degraded Wall Street was taking risk out of the game. They made Wall Street into a porno. They made Wall Street into masturbation. There was no real risk. But a guy like Arthur Hayes, his company was, yesterday shut down, but this was a guy who wanted to fuck for real. He wanted to risk. You had to win and not win.
Yeah.
And so Bitcoin attracted the real hardcore Wall Street people that wanted to really bet. They didn't want to whack off. They didn't want to watch porno. They wanted the real thing. And so when you put the politics together with the markets and the power of cryptography, you end up getting almost a sovereignty stack. You can see it in the Tesla and the SpaceX IPO. You're seeing what pieces went into that, and you're seeing why the narrative was really so powerful around the SpaceX IPO, because you see the decentralized communications there with the satellites. You see the Bitcoin on the balance sheet. You see all of these things in that company, and you can see this trickle down. You can see what happened. It went cryptography, it went to politics. Michael Saylor had his Wall Street bet confirmed now that politics had aligned with the cryptographers, with this new elite class, and now you're seeing it manifesting in the most exciting company and narrative in the world. So that's where they come together. It comes together in fixing capital allocation in order to train investment on the energy build-out, which is what Bitcoin wants, which is what AI wants, which is not what the fiat Wall Street wants, but that's why Saylor made the bet.
I'll say with no specific evidence behind this, it definitely feels like the hedge fund world is coming together directly against some of these digital asset treasury companies all at the same time right now. And you're seeing it in their prices, you're seeing it in the prices of the preferreds, in the put buying in MicroStrategy yesterday morning, into the lawsuits that seem to be very coordinated. To reframe something I said earlier, we just had this period of massive productivity growth and interest rates being pushed upward from geopolitical risks. You know, these are store value assets without productivity growth and without an interest rate, without some good engineering on top of it. So I think this has kind of been the perfect storm against these store value assets. And I find that the financial advisor space is the have and have nots with crypto. There's just a very few select groups that are willing to have over a 2% allocation of their client books. And I think I initially expected that the rest of the marketplace would, like dominoes, so okay, I'm a Morgan Stanley advisor, we just launched our own Bitcoin ETF, there's gonna be a wave of slow adoption, but I think you're gonna really have to see that next price leg up before you start seeing the FOMO from the financial advisor community that's on the sideline right now. But I think that's what can really make it exacerbated, and it seems like the ultimate bearish moment in Bitcoin right now. So knock on wood, hopefully there's not much else that can make it worse.
Rich don't avoid taxes, they get the IRS to fund the assets that make them richer. Now, you've been told the opposite your whole life, right? That taxes are just the bill that you have to pay for earning money. And that the wealthy, they have some sort of like loopholes or something that they do to get out of it that you don't have. That's not it. They don't have a different tax code. It's the same one. They just read it differently. They've been doing what they were taught, and you've been doing what you were taught. Because buried in over 7,000 pages of tax code, you'll see that it's full of ways that the government will literally pay you to own all kinds of assets. But there's 3 signs that tell you when one of these is sitting right in front of you or not. Now, if you learn how to spot those, then the tax code stops looking like a bill and it starts looking like a shopping list instead. Now, real quick, so you know how you should listen to me on this topic, I've built and sold multiple tech companies. I've invested through every single boom and bust cycle for the last 20 years. And today I'm a partner at a top Bitcoin venture fund. I advise public tech companies on how they hold their money, and I've coached over 500 high net worth individuals on building a wealth operating system, just like the one I'm about to talk to you. And this is just one small piece of that. But here's really the part that matters for this video right here. Everything I'm about to show you, I've done myself, right? This is how I've built most of my own balance sheet. So this is not theory, this is from actual practice. It's not something that I read in a book, right? The actual moves I've used to take money that was headed to the IRS and turn it into assets that I still own today. So when I say the government will pay you to own the right things, I'm not guessing about this, okay? I've cashed the checks and I want to show you. And stick with me to the end because I'm going to show you how to find your own number, the exact amount the government is set to take from you this year, and what that same number could turn into if you kept it instead. Now that part alone is worth the next few minutes on its own, so let's go. Here's how I'm going to break this down. All right, first, I'm going to show you who the tax code was actually written for, because it wasn't written for you. And once you see that, then you'll understand how all this works. All right. Then I want to give you the 3 signs, the 3 things that will tell you when the government is about to pay you to own something. All right. Then I want to show you what happens when you stop spending the money you save and you start running it back through the system instead. And by the end of all this, you're going to look at your tax bill completely differently, right? You're going to stop seeing a bill that you owe, and you'll start seeing a list of things the government wants to fund for you. Does that sound good? Now, first, let me show you the trap first, okay? The trap is that almost everybody is in it. They don't realize it, right? They don't realize it because there's just 2 ways to move through the money system. And most people only know about one of those. Now, the first one is the track that you were put on as a kid, right? Your whole life you were raised for this one. Go to school, get the job, earn a paycheck, and the second that paycheck hits, then the government takes its cut off the top, right? So you get taxed first. And then you live on what's left over. And then, hopefully you try to save a little bit of that at the end. And then you hope that it's enough. Okay. That's what we call the consumer track, right? The tax code doesn't just ignore that track. It punishes it. It doesn't want you on that track. If you earn your money from a paycheck, you get taxed at the highest rates there are. You get taxed first. Before you even get to get a dollar, before you even get to spend a single dollar. Now, if you're a high earner, by the time you add up federal, state, payroll, the rest, more than half of what you make can be taken from you before you even get to build anything. Now, I'm guessing anybody watching this video probably has a CPA or some sort of tax professional that helps you. And you probably like your CPA, right? You think he does a good job for you. But understand what a CPA actually is. A CPA is a historian, right? They'll tell you what happened, right? I bring them all my stuff at the end of the year. They look through it and they go, well, here's what happened. They add up what you earned last year. They might maybe suggest a couple things that you could do after the fact, like, hey, put a little bit in the IRA to defer some taxes. And then they tell you what you owe, right? So they're looking in the rear view mirror. They're telling you what happened, you see? But nobody taught you the other track, right? Your school didn't teach it to you. Your job doesn't teach it to you. The historian doing your taxes, they don't teach it to you. And that's not your fault. It's not their fault, right? That's not their job. And you've been doing exactly what they taught you to do, right? But the tax code was never written for the person earning the paycheck, the consumer. The tax code was written for the person who owns the assets, right? That's the whole secret here. The code rewards owners. So the entire game, the only move that actually changes your taxes is to become one. Now, before you turn this video off, guess what? You don't have to quit your job to do that. You don't have to already be rich, right? You can earn a W-2 paycheck and still cross over to the owner's side of the column on the same income, right? What happens is you have to start putting it to work the way an owner does. The paycheck doesn't disappear. You just stop being only a consumer of it and you become an owner with it. That's the difference. That's the switch. That's the switch this whole video is about. Getting you onto the other side of the code that was actually written for you, not against you. It was written for you to use, all right? Because the tax code, it's thousands of pages long, and almost none of it is about what you owe. The tiny part, that's the bill. The rest of it all, that's instructions. It's the government telling you in writing exactly what it'll pay you to build. Now, almost nobody reads that part, but the owners do. How do owners read it? What are they seeing that you don't see? Well, first of all, they read it, you don't. But if we read it, there's 3 signs. When all 3 show up together, you're looking at one, okay? Something the government will pay you to own. Now, I call these 3 signatures of a wealth subsidy, Learn them once, and then you'll start to see them everywhere. Okay, so sign number 1, what you're looking for. The government needs something built that it can't build itself. All right, what does that mean? Well, the government doesn't build anything. The government doesn't build houses. It doesn't build power plants. It doesn't build data centers. It doesn't invent technology. It doesn't drill wells. It doesn't build factories. It can't do any of that. The government doesn't produce. You do. Companies do. Investors do. But the government needs all of it, right? Like, look at what the country is racing to build out right now. It's racing to build out AI data centers right now, right? They're trying to build out data centers the size of small cities. and they need the power to run those data centers. It's trying to pull manufacturing back onshore. So that means building, new factories, automation. They're trying to bring chips back, right? They want to make chips here in America instead of overseas. It's pushing to produce more energy at home for all that, right? The government can't build a single one of those things, but it needs all of them, right? And it needs them fast. It needs jobs from all of those. So it does the only thing it can do. It rewrites the rules to pay whoever shows up to build them. Faster approvals, better tax treatment, and all that makes the math work out. Money left on the table for the people who deploy capital into exactly these things, the things the government wants. Not because it's generous, because it's desperate, right? That's sign number one. Find the thing the country needs built and can't build itself, because that's where the checks are. That's where the checks come in. Sign number two, the instructions are published in the open. Okay. So again, this is not a loophole, right? It's not a scam or a gimmick. It's not a loophole. It's not a gray area. It's not some trick that your, rich uncle's attorney knows. Hear me clearly on this part. It's written down. It's published policy. It's been sitting in the tax code in plain English for decades. Now, the reason why it feels like a secret is that almost nobody reads it, right? The consumer sees a bill and they look away. But the owner sees the same page and they read the instructions. The owner sees the incentives. The same document, but two completely different things, depending on who's holding it. All right, so that's sign number two. Sign number three, it pays the owner who deploys the capital, not the worker who owns the paycheck. Go back to the two tracks, all right? The worker earns and gets taxed first, but the owner deploys capital into the thing that the government wants, and it gets paid for it. Same dollars, moving through the system, but completely different treatment of those dollars. Now, here's how the payment actually comes. It's not a check in the mail. It comes through depreciation. It comes through tax credits. Now, the mechanics have names, and the names don't really matter for right now. But what matters is the shape. You see, you put capital into the asset that the government wants you to, and it lets you keep money that you would have handed over, right? So it credits you for that. You own the asset now, and you keep the money, both. Now, the deepest version of sign number three is the one that I set up earlier. The system rewards the balance sheet, not the paycheck, right? It rewards the person who owns assets and issues credit against them over the person who earns income and gets taxed on it. That's what crossing over to the owner side actually means. Once you're there, the whole code flips into your favor, all right? So there it is. The government needs it built. The instructions are published in advance, and it pays the owner, not the earner. Now, when all three of those things line up at the same time, you found one. You found something the government will pay you to own. Now, a quick thing, before I show you what this looks like with real numbers, I'm going to put some behind that. What you just learned is just one engine. Like recognizing a wealth subsidy, there's a full system that this sits around, that this sits inside of. How do you actually deploy these? How do you stack them so one asset funds the next? How do you do it without blowing yourself up? Well, I walk through the whole thing live on a free workshop. It's live, so you can ask me any questions that you have. Make sure you understand how to apply all this. I'm going to put a link in the description down below. We'll put a QR code here on the screen if you want to come check it out. But let's get into the shape, okay? Let's get into the shape right now. I got to try to keep this simple. It's a short video. So we're not going to go through like tax forms, no jargon right here. Just the shape of what happens. So let's start with an easy one. Right now, today, the country needs energy built. It needs factories. It needs chips built, right? You can't build those. So when you put the capital into those things it needs, it pays you to do it. Again, that's not a number yet. That's just the deal, right? You build what it needs. It pays you to build it. And then you hold that. Now let's put a number on it. So let's say that you have $70,000 this year that you're going to pay to the government on your taxes. Okay, so that's the bill. That's what you normally just hand over, $70,000 gone. But I don't know if I want to give it up. I'd rather have an asset that compounds. So I read the code like an owner does instead. And I figure out that same $70,000, that 70 grand becomes the down payment on an asset the government wanted built anyway. The money that was leaving my life forever, now I can put it inside something that I can own forever. That asset's still yours. The taxes that you were going to pay, you keep it working because you did the thing the government was trying to pay people to do. Now, let's break down what we're actually trying to do here, right? I'm not trying to tell you how to structure it. I'm not trying to tell you what to buy or how the financing works, okay? That's part of it, right? But that part takes real precision. It's very specific. It's the part where people get it wrong and could get into trouble, okay? It's not like a quick YouTube video. That's the part you need help with. But what I do want to do is tell you a few of the moves that I actually use. I want to give you the one thing that makes each one work. So let's look at a couple. So real estate, for example. Real estate's great, short-term rentals specifically. The unlock is that if you materially participate, which short-term rentals you do, then the depreciation can hit your active income. So if you're a W-2, this works for you instead of being trapped where most people have it trapped. Also energy, so like oil and gas. When you fund a drilling project, a big chunk of it counts as intangible drilling costs, and those come off in year one. Also clean energy, solar. You get two things at once. You get a tax credit and you get depreciation on the same system. So I can write off like a credit against my taxes, but then an actual credit against the money that I owe. Now the credits, that's the rare one because it comes off your taxes dollar for dollar. Also, one of my favorites I talk about quite often is Bitcoin mining. The machines, their equipment, at least in the eyes of the tax code. So they qualify for the first year depreciation. And then the asset, it produces Bitcoin for me every year. Okay, that's four different things the government's literally paying people to invest, paying people to build out right now. And these are all things that I've put my own money into. Now, I'm not going to break all of them down into greater detail here, but I did make an entire video where I go deep into each one. I talked about my real experience there. I talked about the good, the bad, how you can run the numbers yourself. I'm going to link to that video in the description down below if you want to go watch it after this video. But what I'm showing you here is the shape. The 70 grand, it doesn't have to leave. It can become something that you own, right? That's the whole move here. So watch what that one move does over time. Now, don't use my number, use your own number. Whatever you paid the government last year, think about that. How much did you pay last year? That's your number. Hold it in your head. I'll run my own number, but maybe write your own down, okay? Let's say that's 70 grand that I kept instead of handing it over. Now, I let that 70 grand sit in an asset, and it compounds. Let's say that it compounds at 10% a year. Call it what the market's done over the long run, okay? Now that 70 grand turns into roughly 180,000 in 10 years. Leave it at 20 years, it's now $470,000 from 1 year's tax bill. 170,000 decision. The person who handed it over to the government got nothing. The person who kept it working got almost $500,000. That's doing it once. Now do what owners actually do. They don't do this one time. They do it every single year. If you've got that 70 grand of tax on the table every year, and every year you route it, just like I talked about, into assets instead of handing it over, then in 10 years, you've moved 700 grand off the government's table and into your own assets. Money that would have otherwise just been gone. And now you have 700 grand in assets that's compounding, right? Now that's 700 grand before we even count a single dollar of growth stacking on top of it. Now go back to your number. However many years you've been working and handing that number over, that's the version of this that already happened to you. That's the cost of reading the code like a consumer. But the good news is the next 10 years haven't been written yet. So you can take the same income the whole time, right? Two people, same paycheck, same life. One hands the tax over every year. One lives on what's left. The other routes it into things that they own and they let it stack up. So run that out. And the two of them, they're not living the same life anymore, right? They made the same amount of money, but one spent a decade feeding the government. The other spent a decade building a balance sheet. And nothing about that required earning a single dollar more. You see, that's the key part here. It's not about working harder. It's not about earning more. It's about making your money work harder and earn more. It's two people with the same income, just a different approach. They stopped being a consumer of the money and became an owner with the money, okay? Now, at the beginning of the video, I told you that I'd show you how to find your own number. So here it is. This is the one thing that I want you to actually do from this video, right? Whether you ever watch another video of mine or not, let's just do this. If you want, grab a pen and paper, pause this right now. I'll wait. Open up your phone, pull up last year's tax return, maybe an email from your accountant, or just make your best guess, whatever you've got, okay? Find the number that you sent to the government. Get the real figure. Try to get it as close as possible, even if you have to guess, but try to get as close as possible. Got it? Okay, good. Okay, that number is not a bill anymore. You know what it actually is now? That's your budget. That's the capital you have every single year. And you can use that capital to redirect in any asset that the government at least will pay you to own. Now, most people never realize that they have that budget because they hand it over before they even see it. But now you saw it. Now, here's the part that should hopefully this bothers you. Hopefully this makes you a little bit angry. The number isn't once, it's every year. Again, do nothing different, right? Don't have to work any harder. Don't do anything different, but write that same check again next year and the year after. The same money gone on repeat for the rest of your working life. Now, run it through the 3 signs. 1, the government needs it built. 2, the instructions are published. 3, it pays the owner, not the earner. Now, take that one number and just ask a different question. Not, how do I pay less tax? The question you want to ask is, what does the government want built badly enough they'll pay me to own it? It's that question, the way you ask the question, that puts you ahead of almost everybody else that you know, and it's yours to keep free starting right now. So let's look at what you have, right? And what you don't. What you have now is the eyes. You have the framework, right? You know how to ask the question. You can read the code like an owner. You can spot the 3 signs. You've got your number. Hopefully you'll never look at the tax bill the same way. And most people watching this video will never even get that far. Here's what you don't have yet. What you don't have yet is the deployment, right? Knowing a wealth subsidy exists, that's one thing. That's the first thing. How? Capturing one without hurting yourself, that's another. Like, which asset? How do I structure it so the tax treatment actually holds? How do I finance it so I'm not out of pocket on this, right? Those are things that I want to think about. The part that almost nobody seems to get right is, how do I stack them so the first asset helps fund the second, and the second funds the third? You see, that's where this goes from good to great, to having a machine, to having a system. That's the part I can't hand you here in a short YouTube video, because doing it wrong is how people blow themselves up. But if you'd like me to walk you through the math live with your own number, I run a free live event where I do exactly that. We'll run your number together. We'll figure this out. We'll look at several other wealth building strategies, exercises that we'll do all live together. I'll run you through 3 engines, how to deploy them, how to stack them. And because it's live, I answer all your questions right there on the spot. So I'll put a link in the description down below. There's a QR code right here if you want to come join me. And if you just want more of this, reading the code the way the owners read it, instead of the way that you were taught, subscribe to the channel before you go real quick. Right? I put these videos out regularly to show you what the rules actually say about building wealth, not what your historian CPA does. So now you know the code was written for owners, and now you know how to read it like one. Now, if you want to go deeper into these tax plays, the depreciation plays, you might want to go watch this video right here, and I'll see you over there.
It does feel inevitable. It does feel like it's coming. I think the only question is whether that pace that we get there is linear or exponential.
And to kick us off, I first wanted to start with the question of, there's kind of 3 different pieces here. There's the asset manager, there's the investment bank, there's the custody provider. And for the past, I don't know how many years, I think ever since I've been in Bitcoin, people have been saying the institutions are coming, the institutions are coming. And it feels like the 3 of you represent the institutional stack of Bitcoin. So my first question would be, what are the institutions waiting on at this point in time in order to enter our market and our industry?
I'll go first. So I'm Chen. I'm the Chief Revenue Officer at BitGo. We are one of the world's largest infra companies for everything digital assets related. Been with the company for about 6.5 years, so seeing a lot. In terms of answering your question, I think it hinges a lot on the passing of Clarity. Clarity Act needs to go through. We have midterms coming up in November. Who knows what's going to happen after November? So we have only a few months between now and then before Congress goes into recess, and that thing needs to be passed. We are obviously in conversations with many, many banks all around the world, here in the US, and most areas around the world. And here in the US specifically, there's a number of banks that has a bunch of folks queued up. They have a plan ready to go, do a lot of tokenization work on chain. It hinges on Clarity. Around the world, what's interesting is the regulators, especially in the larger tier 1 countries, they look up to the US for guidance. Whatever we do here in the US will get propagated around the world. And if we're able to get Clarity through before the midterms, it's going to unlock a lot of business around the world as well. The last thing I have to say is Brian Armstrong, man, like it was going to go through a couple months back. It's all public information. And the guy and his army of lobbyists in Washington, D.C. did not like the couple of lines that they had in that version of the act, and pulled the strings and pulled it off. So I'm very disappointed at what happened a few months back. Hopefully we can regroup and get this thing through as soon as possible.
So maybe I'll jump in here. Definitely agree with those comments. I would say from our side in investment banking and bringing new product to market, new issue, it's certainly supply. Like, we need more supply. We need more people in the good parts of the environment being innovative and hitting the scale that's required for those institutions to be able to buy into that, both on the common equity side as well as digital credit. The easiest way to play that, if you didn't have scale previously, were converts. And we've seen a lot of people do that, including yourselves, right? But I think that the superior product is certainly digital credit and the perpetual preferred product, because it's better asset liability matching. It just has the carry trade that's affiliated with it. It makes sense, right? And it's defensible in terms of your balance sheet over time. There's a lot of debate about that right now, and certainly strategy, having a mixed balance sheet, is clouding the dialogue around that specific situation. I would say if you think about, okay, well, what's holding institutions back besides availability of investable issuers, right? Which is a real, there's not enough, right? Strategy, we did 5 prefs in 1 year effectively for them. And a lot of institutions got excited about it. Institutions were there and looked at the first one, maybe turned it down, came into the second one because it was so successful. And we kind of built on that success over time leading up to Stretch. There's still fundamental constraints, though, that exist, like lack of ratings. Lack of ratings takes a ton of institutions off the table. People talk about like huge pockets of capital in insurance and asset managers. Well, they're still antiquated with respect to how they look at their investment thresholds. And if you can be put into buckets that mean love it, understand it, but can't do it because you don't have a rating. And we tried to work with SAYLOR and team and everyone else to break down that wall back in 2005, but it was just not possible. So I think there's some structural constraints that still exist within these asset managers, both in terms of accepting Bitcoin as an asset class, as true collateral. There are things like ratings and other areas where we're working hard. The regulators, I mean, that's the one thing that's moved in our favor, absolutely. So that's been extremely helpful.
Great comments. I would just add, and I think it's really interesting that we got grouped by the first letter of our company names, because I actually think that introduces like a nice little mix of perspectives to the dialogue. But obviously, BlackRock's a large asset manager. We manage $0 of digital assets for clients as recently as 2-3 years ago, and now we manage 130. Maybe it's lower. Got to check the screens. Right, but the largest product that we have is, of course, the iShares Bitcoin Trust IBIT, which was launched in early 2024. When it was launched, the rough demand was roughly 80% retail and 20% institutional. And over time, if you think about it, coming to today, it's become roughly 50-50. So I would say the institutional adoption has actually been increasing. It's great progress. Obviously, we're in the early top of the first inning. There's a lot more work to do. And some of that is a combination of regulatory clarity as well as infrastructure build out. And they're kind of hand in hand, right? To echo Chen's comments, I think more regulatory clarity is going to be what drives the progress from linear to exponential. Even with a delay to that, which would not be good, I think the adoption rate and the growth continues, just at a more linear-like rate. Because a lot of things need to be built in terms of custody, in terms of wallets, right? A lot of people use IBIT because the ETF wrapper is actually easier and more familiar and more plug and play. But all the folks that we speak with in the ecosystem, whether they're crypto native or TradFi, are increasingly building for this future. So it does feel inevitable. It does feel like it's coming. I think the only question is whether that pace that we get there is linear or exponential.
So I want to start with the first question for you, Will. You just launched a new ETF. Congratulations on that. There is some level of competition between, let's say, the role that Treasury companies and DATs play in the capital markets ecosystem, and what their options chains play, and et cetera, and the products that you are launching. How do you all think about the interplay between launching new wrappers and competing with the treasury companies that are out there in the ecosystem versus working cooperatively with them?
Yeah, absolutely. Thank you for bringing that up. So we launched our BitA ETF, which is a Bitcoin covered rights option ETF last week. Anything that BlackRock launches, we do because of client feedback. We're a very client-centric, client-led firm. And one of the things that clients have articulated is, I am interested in Bitcoin, but I sure would love some way to generate income, and I would like some sort of downside protection. And we can wrap it into one for me, that would be great, right? So I would say completely different products and completely different lanes than what a lot of the DATs have been issuing. Also, BitA, I think we have seen a lot of success in its first week. We're sitting at $30 million of AUM, right? So if we can ever even get close to some of the other credit products, we'll be very proud of that. But again, I think it's just an evolution in the market structure for Bitcoin, right? From the very early days where it had no derivatives to then obviously the early days of perps, and then cleared options, and then the perps really adopting, and then all the ETPs launching in early 24, and then the options, and now having these other maturing things are just ways where that market structure gets more mature and gives you more options, right, for others to come in and build different types of product. Volatility on Bitcoin used to be habitually above 100% realized. And today it's kind of down to this kind of 40 to 60, hovering around 50% range. And I see that as progress, right? I see that as a sign that the ecosystem is maturing and allowing the traditional institutions to come and say, okay, this is an asset that we can work with and create more products and create more creative ways to give clients what they want.
So I want to come back to that topic in a minute, but Lee, I wanted to talk to you about STRC, and I think that that's like the topic du jour of the moment. You know, you worked with Strategy to help design that product. You know, we had a discussion last night about it. You know, now that we're getting into what I would call the edge cases of the product, like the product in, you know, the non-normal circumstances, how would you conceptualize or think about the key mechanics of that product and what matters to the market? And what would be your advice to treasury companies, several of whom are here that I know are working on pref products, whether or not they've been announced, on how to navigate the uncertainty of the current moment?
Thanks for the easy question.
Yeah, it's a softball.
Okay, so I've got my own opinions. Listen, I do think it's a groundbreaking product. It is an iPhone moment. I've talked about it before. I know SAYLOR is passionate about the product, but as with all new products, you just don't know what to expect as the product matures. And that is not a mature product. Let's be totally clear. I mean, it's, you know, maturity in financial markets takes time. And you need to go through these events. You need to be tested. I would tell you that we do stay in very close communication with them and Strive. We also help with SATA. We felt really good coming out of the Iran conflict that both of those securities did exactly what we would hope them to do. They were a safe haven, they were yield, they went to par above the ATMs issuing, et cetera. You know, and the yields made sense, I think, just still given the early nature of the issuers, less so Strategy, obviously. But, you know, I think that Strive is a good example because you can look at the leverage and amplification on a smaller company like that and still see it hold in nicely. That's working. So it was working. What we've seen here is there are other structural factors that are playing into why it's trading down below 80. I mean, look, in the mid 80s, I mean, we IPO'd these things at 80, 85, 90, whatever it might be. So could it go back down to the original IPO price? Of course. I mean, IPOs do that all the time. I mean, we're seeing SpaceX broke, right? So there are factors that could lead you down. But I think, unfortunately, we've hit so many people so quickly had put leverage on the instruments, and or you got retail buying it on margin. And I don't think retail fully understands the product. So we've got some other issues that are forcing us to go below 80, and it's you know, it's unfortunate, but it's a learning experience from my standpoint. And I do think that, you know, we're all hopeful that Michael and his team will come out pretty soon. They'll have an 8K on Monday with a very strong message about, you know, confidence. I mean, this is not a credit problem, and we talked about this last night. This is not a credit problem. And by the way, taking the yield to 15% or 16% also is not going to get it to trade to par. This is just a structural trade-off and test the security. And everyone needs to take a deep breath and sit down, and Michael needs to come up and say, listen, this is not a credit problem. We have a fortress balance sheet, right? Sure, the converts are coming due, but I'm here to tell you as Barclays, we can refinance those converts tomorrow. I mean, our hedge fund clients that technically priced converts would love to come in at $85 on the stock price right now and restrike a convert. That's not a problem. The put, all that kind of stuff's not an issue. You can refi all the convert debt, and Michael can come out and say all of this. He could choose to do other things too, right? I mean, he's raising cash. You saw in the last 8K last week that he actually sold equity. He could, who knows what he's doing? We'll find out on Monday. He could be selling cash. He could be doing other things, right? And he could raise cash. And they could also, look, the concept of a buyback is a very common concept in all other areas and products. It's just for perpetual stock, because it's such a novel new product, has not been rolled out. And so, a buyback is also a very logical way to support a security like this. By the way, it's not a bad financial trade to be buying it back at 75 when you issued it at 100 and then reissue it at 100 3 months from now, right? But I think specifically, I don't think it's buybacks that way as opportunistic and financial engineering. I just think you're supporting a new security that's out there, and it's going to experience some bumps in the road. And you need to know as a Treasury, when is it moving in a zone where we could hit a leverage trigger? Don't want to go there. We went there. So I think that we should take this experience and say, this is not a problem. There's structural dynamics at play. And I think the learning experience going forward is, do you have other tools in your toolkit as the issuer, Strive or Strategy or future issuers, that will allow you to structurally support that security in these periods of uncertainty?
If there's one great thing you can count on from the crypto market, is that if you design any product and you draw a line of do not cross this line, guarantee that
we're going to cross it.
Right.
We're going to definitely cross it.
So Chin, I want to ask you in a different direction. Y'all have been custodying Bitcoin for a long time. Y'all are dealing not only with the wrappers of Bitcoin like Blackrock or different ETFs, but you're dealing directly with the corporate treasury teams that are holding Bitcoin directly with you. What has had more success in terms of corporate adoption, going through wrappers or holding it directly? And what's the biggest hurdle you see with getting someone to actually squeeze the trigger and put 2, 3, 5% of their treasury into Bitcoin?
We have a very diverse set of clients. We do work with a lot of DATs. We do work with ETFs, and we do work with a number of OG Bitcoin hodlers. We're talking like 2010, 2011, 2012 folks that have kept Bitcoin with us for a very, very long time. There's also this cohort of people, the wealthiest family offices in a lot of the major countries around the world. They're waking up to this asset class and they're looking at options. I have to say, one of our competitors actually is IBIT. There's a number of folks thinking about, what they can do with the Bitcoin they currently have at BitGo. And to be very frank, we had some customers go the other way, meaning they're taking it out of BitGo, they're moving it over into his product, and it's unfortunately going to Coinbase, I believe, underneath. The thing I want to stress about this entire thing is fundamentally, Bitcoin is a bearer asset. You lose the keys, you're done. And maybe I shouldn't say this on stage, but having Coinbase have, 60, 70, 80% of all the Bitcoin floating around in the traditional financial space is frankly dangerous and not responsible. So you should look at other custodians. There's plenty of other custodians floating around, and diversify where all the Bitcoin is currently being held. If Coinbase messes up, we're done. And we cannot have that fundamentally.
We're all friends. A powerful statement. I mean, to BitGo's kudos. I don't know of another custodian that's been around as long as y'all and Coinbase that has the track record y'all have. So Well, I want to kind of end on this question, which is probably the number one question I get as a non-capital markets person. I'm a Bitcoiner, you know, putting on a costume of a suit to go to an institutional finance event. But you know, the everyday Bitcoiner tells me Blackrock, Barclays, maybe less so BitGo, but you know, these are the firms that Bitcoin, you know, was created to destroy. We don't want these, you know, traditional financial firms entering into the Bitcoin market. They are domesticating Bitcoin. What would be your response to that?
Yeah, I'll just say a few things, right? I think number one, you know, we repeat this with every opportunity we get, just to set the record straight that we don't own the Bitcoins, right? We are a provider of a wrapper so that folks who, you know, frankly, can't even open like OpenAI or adopt any of this new technology can have exposure to something that they have been educated on and are excited to participate in. So we kind of see our role as being able to bring more people into the philosophy, the belief, the asset, the growth of Bitcoin, right? Now, the fact that they're all concentrated into a single wrapper is one question, but again, if you look at the number of holders on IBIT, there's more than 1,300 that report on the 13F, right? And for many of them, they represent thousands of other individual holders. When a retirement or a pension or a foundation holds IBIT, they're holding that exposure on behalf of a lot of people. So we kind of view it as an opportunity to allow more people to come into the ecosystem, and we don't view our role as someone that's kind of trying to centralize what that represents, right? I do think there are certain instances where if you look, for example, at the quantum risk, right, which a lot of people talk about today, you know, there's an educational process that we can be a part of, right? We're not going to be influencing or controlling whatever the outcome is, but there are ways to coordinate and to help other people see how we can kind of come together and solve that problem. So there are ways to work together. I think at the end of the day, we're all on the same team, right? We want to see this asset thrive. We want to see it become more important and more relevant in the world as it has been for the last 15 years, and we're part of that journey.
I have heard some cool stories about Larry Fink and his journey into Bitcoin, and I've been impressed by how y'all have done it so far.
I think we all know that he used to call it pirate money, but I think the mental flexibility to look at the facts and come around is something that we should all applaud and commend.
100%. Lee, what's your take on that question?
Yeah, I'm not going to answer it directly as asked. I'm going to ask it in terms of what Barclays, you know, as an investment bank is doing in the context of that question. And at our heart, we are trying to continue the mission of Bitcoiners, right, in the corporate sense. We are helping new and existing issuers that want to go acquire Bitcoin have access to the institutional bid and bridge that gap, because there's a language barrier in many cases, okay?
Huge language barrier.
Yeah. And so we're believers and we're on your side. And what we're trying to do is we're trying to crystallize the bid in a way that works for everybody, right? And so that's effectively what we're doing. And I'll just to put it in perspective, because there was a panel a couple before this, and someone was like, well, Stretch is 80% retail and 20% institutional. Actually, no. Every single one of these IPOs is 80% institutional and 20% retail. It's why? Because retail needs the validation, particularly of these new products, but they need the validation of the management team, that we've done the diligence and everything else. And then retail will come over the top, just like it's a SpaceX IPO, right? And smother that instrument and take it to where it needs to go. But the institutions are the starter fluid and the validation factor. So they're super important in that regard, because their due diligence and their structuring and their one-on-ones that we do, you know, we don't just roll the product out to the public. We wall cross Blackrock. We wall cross 10 to 15 of our top accounts, okay? And have very deep conversations around what you want as the issuer. We've already got it all written on paper, like this is what we really want, okay? But we know there's going to be some level of concession. Maybe the cash reserve. That came out of one-on-ones with Strive. Cash reserve was not on the table in the beginning. Didn't want to give it up, not interested. You know what? At the end of the day, it was the right thing for both people. And look at it now. Strategy put the cash reserve in after their Stretch IPO. And it's one of the main factors of supporting that security today. But that came out of the institutional due diligence and the banker and the issuer all coming together in the beginning, and then retail, and then further adoption and success and everything else. And that's pretty much how the model works from our perspective. Yeah.
Chen? I'll be quick. I mined my first Satoshi December of 2012. I was part of one of the Seattle Bitcoin communities way back when. We met at a coffee shop every weekend to talk about Bitcoin. Those were the good old days. And when I first showed up, I worked at Microsoft. I had a tucked in collar shirt, and all the libertarians in the room were looking at me funny. It's like, who are you? Oh, the big corporate is here. We've come a long way from those days. And I would say you have to pass the institutional hurdle for this to be truly adopted by the world. I would also say, on top of the institutional demand, there is demand from actual governments around the world. We're talking about the US Strategic Bitcoin Reserve. We're talking about basically the El Salvador playbook smeared across as many countries as possible. BitGo, we do a bunch of hardcore technology for securing Bitcoin. We're working with a number of these countries right, as we speak to help them set up what effectively is their own version of a digital Fort Knox. The infrastructure needs to be there, both at the institutional level and at the government level, for us to truly take this to the next level. It's been many, many years since '09. We have many, many decades to go to get this propagated around the world.
You know, not to answer my own question, but you know, I always take the view that Bitcoin's the same Bitcoin before any of the people up here bought it.
That's right.
It'll be the same Bitcoin tomorrow. But I think Blackrock, after buying Bitcoin, or Barclays after buying Bitcoin, is a little bit different of an organization than they were beforehand. So it's like unleashed capitalism. So anyway, I thank you everyone for being on this panel. Give them a round of applause.
Hello, everyone, and good evening. I'm CJ, Head of Investor Relations at Strategy. I'm excited to moderate Strategy's second quarter 2026 earnings webinar for you. We will start the call with a 60-minute presentation, starting with Andrew Kang, followed by Fong Lee, and then Michael SAYLOR. This will be followed by a 30-minute interactive Q&A session with 4 Wall Street equity analysts and 4 Bitcoin analysts. Before we proceed, I will read the safe harbor statement. Some of the information we provide in this presentation regarding our future expectations, plans, and prospects may constitute forward-looking statements. Actual results may differ materially from these forward-looking statements due to various important factors, including fluctuations in the price of Bitcoin and the risk factors discussed under the caption Risk Factors in Strategy's quarterly report on Form 10-Q filed with the SEC on May 6, 2026, and the risks described in other filings that Strategy may make with the SEC. We assume no obligation to update these forward-looking statements, which speak only as of today. With that, I will turn the call over to Andrew Kang, CFO of Strategy.
Thank you, CJ, and thank you all for joining our call today. Moving on to the first slide, we now hold 843,775,000 Bitcoin, representing approximately 4% of all Bitcoin that will ever exist. Bitcoin per share is currently 203,683 sats, which remains one of the cleanest measures of how we create long-term value for our shareholders. Our market cap is approximately $38 billion, and year to date, we have raised $17 billion of capital across common equity and digital credit. That capital gives us the strength to continue building our overall Bitcoin holdings, manage our capital structure, meet our dividend and interest obligations, and support the growth of our digital credit platform. On this slide, we show that we adopted Bitcoin as a treasury asset beginning in Q3 of 2020. We have accumulated more Bitcoin in every single quarter across 113 acquisitions. And today we hold, again, 843,775 Bitcoin with a Bitcoin reserve value of approximately $55 billion. Our total acquisition cost is approximately $64 billion, and our average purchase price is roughly $75,000 per Bitcoin. Strategy is now the largest institutional holder of Bitcoin in the world. Our holdings are larger than the largest Bitcoin ETFs shown here. They're larger than the estimated holdings of any nation state and larger than the major DeFi custody balances. That scale matters, and it reinforces Strategy's unique position in the digital assets market. We are not just participating in institutional Bitcoin adoption, we are leading it. Doing so as an operating company with access to the capital markets, a growing digital credit platform, and a long-term objective of increasing Bitcoin per share for our shareholders. Now turning to the balance sheet. Q2 reflected active execution across all of our operations and our capital structure. Digital assets ended the quarter at $49.7 billion, having acquired a net 83,901 Bitcoin during the quarter, with the total balance sheet holdings now slightly lower due to the lower price of Bitcoin as of the end of Q2. Cash and short-term investments increased to $2.4 billion as of the quarter end, and now even further to $3.75 billion current quarter to date. And now we hold over 2 years of dividend and interest coverage, and also reflect our goal of continuing to replenish the USD reserve to support our digital credit instruments. Long-term debt declined from $8.2 billion to $6.7 billion, driven by the $1.5 billion repurchase of convertible debt, which we executed at an 8% discount in Q2. And preferred equity increased from $9 billion to $14.4 billion, driven by the strong issuance of STRC during Q2. We began the quarter with just over 762,000 Bitcoin with a market value of $51.6 billion. During that quarter, we accumulated more Bitcoin, adding a net 83,901 Bitcoin and an average price of approximately $75,500. At quarter end, we held 846,000 Bitcoin, and the quarter end Bitcoin price was approximately $58,700, resulting in a Q2 unrealized fair value loss of approximately $8.3 billion. After quarter end, we have seen a recovery in the market value of our Bitcoin holdings. Quarter to date through July 27th, we did sell 2,225 Bitcoin for approximately $135 million. And with Bitcoin price increasing to approximately $65,000 per Bitcoin, we currently would reflect an estimated fair value gain of about $5.2 billion on our total holdings. And our digital assets balance sheet will have increased to approximately $54.8 billion. As of July 27th, our total reserve, which includes our BTC reserve and our US dollar cash reserve, was $58.5 billion, with a net reserve of approximately $36.3 billion, which nets out our out-of-the-money convertible debt and preferred equity balances. Here, amplification, calculated as our BTC reserve of approximately $58 billion divided by net reserves of $36 billion is over 1.5 times. Amplification represents our total Bitcoin as a multiple of reserves remaining after taking into account our debt and preferred claims. We have $15.4 billion of preferred equity outstanding and $6.7 billion of convertible debt outstanding, and a low net leverage of 5.4%, which reflects our debt less our cash reserves divided by our BTC reserve. At a current Bitcoin price of roughly $65,000, our approximately $55 billion of Bitcoin reserves provides an 18.5x BTC rating, against our net debt of about $3 billion. In an extreme stress case, as you can see here in the middle of the slide, even with a 95% Bitcoin price decline to roughly $4,000 per Bitcoin, our converts would remain fully covered at a 1.0x BTC rating. Over time, our plan remains to equitize, repay, or refinance existing convertible debt while continuing to maintain strong collateral coverage. And as we demonstrated in Q2, we believe the market remains open to all of these options. We plan to remain patient, monitor the market conditions, and continue to focus on the overall liability management of our outstanding debt. Turning to the Q2 financial results, we reported an operating loss of $8.3 billion, a net loss of $8.6 billion, and an EPS of negative $24.45 per share. These results were driven by the quarter-end non-cash fair value mark-to-market of our Bitcoin holdings. Our focus remains on the long-term drivers we can control, which include capital allocation, balance sheet strength, the strengthening of our digital credit instruments, and increasing Bitcoin per share over the long term. And I mentioned earlier, quarter to date, with Bitcoin price having increased to closer to $65,000, our current fair value mark to market of our holdings would reflect about a $5.2 billion gain. Turning to our Bitcoin KPIs, as of July 26th, Bitcoin per share was 203,683 sats compared to about 191,904 sats in July of 2025, which is an increase of about 6% year over year. Year-to-date BTC yield is currently 4.5% compared to about 22.8% for the full year 2025. BTC gain is approximately 30,000 Bitcoin year-to-date, which is about 30% of last year's full year gain. And in dollar terms, BTC dollar gain is approximately $2 billion year-to-date compared to about $8.9 billion for the full year 2025. Despite the significant drawdown in BTC price year over year, we continue to execute positive performance across all of our core KPIs. Since 2020, our Bitcoin per share has increased from approximately 46,000 sats to 203,000 sats, which is more than a 4x increase over that period. And in 2006, we have delivered, as I mentioned, 4.5% BTC yield year to date. As you can see here, historical annual BTC yield performance does move sort of in conjunction with Bitcoin price. In Bitcoin bear markets like we saw in 22 and 23, BTC yield was lower than the bull market years of 24 and 25. That being said, BTC yield this year does have the potential to outperform the prior bear market if BTC price improves and through the support and strengthening of our digital credit instruments. On this slide, we show here in Q2, within Q2, Bitcoin per share increased approximately 201,170 sats at the end of Q1 to approximately 210,824 sats at the end of Q2. Despite the lower price of Bitcoin and the overall market volatility in Q2, the quarter's BTC yield of 5% outperformed the Q1 BTC yield of 3.2%. So we are continuing to make good progress. And lastly, I will end with a quick snapshot on the most recent view from our equity analysts. We added 2 new covering analysts from Barclays and Siebert for a total coverage of now 16. Across the firms shown here, the average analyst Bitcoin price target for those that have one is approximately $98,000. The average MSTR price target is approximately $296, and all with corresponding buy ratings. While we do not endorse any third-party forecasts, it's important to note that the banks are increasing their engagement with Bitcoin, with digital capital, and with a focus on Strategy's role within that market. I think the growth also reflects the deep and growing demand from investors as well for independent institutional views on Bitcoin strategy and digital credit. And it helps deepen investor understanding of our business model, our capital structure, and the long-term value we are pursuing for our shareholders. So with that, I thank you all for your time, and I will turn it over to Phong for his remarks.
Thank you, Andrew. Thank you, everyone, for joining us this evening. I'm going to provide an update on our capital market strategy and our capital markets programs. And before I go into some of those details, I do also want to recap Q2 2026. We acknowledge that it was an up and down quarter for Bitcoin, and our common equity and our preferred have gone down in that period of time. But if I look at the key metrics that we look at for performance and health of the business, things are generally speaking positive. Our Bitcoin holdings over the course of the quarter increased 11%. From 762,099 Bitcoin to 846,000 Bitcoin. We reduced our debt outstanding from $8.2 billion to $6.7 billion. And on a net debt basis, we reduced it even more. This was down 18%. Our US dollar reserve is up from $2.1 billion to $2.4 billion at the end of Q2. And as Andrew noted, we're now at $3.75 billion. That's a 12% increase quarter over quarter. And our Bitcoin per share, potentially our most important of our metrics, went from 201,170 Satoshis to 210,824 Satoshis, so a 5% increase. So many of these metrics show health in the overall business. How were we able to do that? 3 months ago in our earnings call, we said that we were adding engines to the strategy playbook, if you will. We went from one-way capital issuance, buying Bitcoin through active issuance of MSTR, of our preferreds and our convertibles, to what we call active capital management. We're able to sell MSTR to buy Bitcoin, US dollars, debt, prefs. We're able to sell our prefs to buy Bitcoin, US dollars, debt, MSTR. And we're also able to sell our Bitcoin to buy US dollars, buy debt, buy prefs, buy MSTR. And we're able to use those US dollars to pay off dividends and to strengthen our balance sheet. We continue to be net buyers of Bitcoin and net issuers of Stretch. We want to be the largest buyer of Bitcoin in the world and the biggest issuer of digital credit in the world. And year to date, 2026, we have proven to be just that. We bought 174,895 Bitcoin year to date 2026. We sold 3,620 Bitcoin during that same period of time. We bought 48x more Bitcoin than we sold, and we increased our Bitcoin 25% since the beginning of 2026 until now. When it comes to digital credit and Stretch, we issued $7.52 billion of digital credit. We repurchased year-to-date $25 million. We issued 300x more digital credit than we repurchased, and we increased Stretch's notional 250% since the beginning of the year. So I think we are carrying through on our stated objective to be the largest net buyer of Bitcoin in the world and the largest issuer, net issuer of digital credit in the world. Another way to think about our robust access to the capital markets is to look at what we've done year to date 2026. So through 7 months in 2026, we've now issued $17 billion of capital. As you can see here, that's approaching what we did in 2025, primarily used to buy Bitcoin. And you'll also see the percentage of capital that we issued that was digital credit, specifically primarily Stretch, was 44% of the total capital we issued versus 28% last year. If you look at this same information on a quarter-to-quarter basis, Q2, we issued more capital than we did in Q1 of last year, Q1 of this year, and also we issued more capital in Q2 2026 than we did, or we raised more capital in 2026 than we did in any quarter of last year. So $8.4 billion total, of which $5.5 billion is digital credit. Q3 2026, right? So this is the month of July of this year. We've issued about $1.3 billion primarily of common equity. And of course, we want to see preferred equity added to that stack too. And so I'll talk a little bit more about why that's important. We've talked about the flywheel in the past, right? Our overall objective is to double Bitcoin per share in 7 years through digital credit. And why is this important? We want digital credit to work because we're able to sell digital credit to buy Bitcoin. That generates amplification to the company. That would increase our Bitcoin per share for the company, especially as Bitcoin increases. And it allows the company ultimately to do what we have been doing and what we intend to do, which is to outperform Bitcoin. Right? What are the inputs that can help us flex these levers, decreasing our cost of credit? And we'll talk about that in a little bit. Higher digital credit sales. This is selling more stretch, and a higher MNAV through accretion of our equity, our common equity, MSTR. So let me talk about the digital credit capital framework and how do we get this flywheel working even better than it has in the past. I'll start with our corporate objective. It's for Stretch to trade at $99 to $100 over time. And we recognize that that has not occurred over the course of the last month. Stretch is now trading at about $89.50. Our goal is to get this back to $99 to $100 because that helps our digital credit engine work and it helps us increase Bitcoin per share and ultimately accrue value to our common shareholders. So about a month ago, we issued 5 pillars that are going to strengthen Stretch and strengthen digital credit. The first major pillar is the US dollar reserve. We recognize the importance of the US dollar reserve to our digital credit shareholders. We had decreased that over time in the month of June, and we realized that it's important to keep it strong. And so we've increased it now to $3.75 billion, which is about 2.1 years worth of dividend coverage, dividend and interest coverage. And we're going to keep 1 year a minimum. And I'll talk a little bit more about that in a minute. Bitcoin monetization, selling Bitcoin for 3 purposes. 1, to fund US dollar reserves. 2, to fund dividends and interest expenses. And 3, to support our repurchase programs. And those are our third and our fourth pillar. The ability to repurchase digital credit up to $1 billion. We've repurchased $25 million so far year to date. And to repurchase MSTR up to $1 billion. And the fifth and last pillar is to manage our Stretch dividend in a way that it's thoughtful and supports the price of Stretch while also reducing our dividend burden. And we can review that monthly. The good news is we've built now an all-time high US dollar reserve, right? So we started at the beginning of the year in January at $2.25 billion. We drew that down to pay down $1.5 billion notional of our 2029 converts to $871 million. We recognize that that was not the right level to support Stretch and to support our digital credit. And therefore, in a pretty short order, we built it up in about 2 months back to $3.75 billion. 2 things I'll note. 1 is that is the highest our US dollar reserve has ever been. And 2, that on a duration basis, which is how many years of dividend and interest expense coverage we have, our high in January is 2.7 years, our low end of May was 0.5 years. We're now back to 2.1 years, and our target is to be somewhere between 2 and 3 years. I talked about our Bitcoin monetization program, right? Our intent is to sell Bitcoin for 3 reasons when we think it's appropriate for the company. 1, fund the US dollar reserve up to $1.25 billion. That would take our US dollar reserve up to $5 billion if we were to do that fully using Bitcoin, which would take us up close to 3 years. 2, fund dividend interest payments of $1.76 billion currently annually. And we've used Bitcoin sales to fund some dividend payments in the last month or so. And 3 is to fund up to $2 billion in our repurchase programs. So let's talk a little bit more about Bitcoin monetization and Bitcoin sales. This is a subject of much discussion during the month of May and June, so I thought I would provide some more clarity onto why we did it and what we believe the result to Bitcoin was when we did this. First, our first Bitcoin sale in the week ending May 31st was 32 Bitcoin. That was 0.004% of all of our Bitcoin holdings. And why did we do it? We did it to inoculate the market and test our processes. The average cost basis of that Bitcoin is $125,464, which came to a $4 million total cost basis with the proceeds of $2 million and the average sale price of $77,135. We took about a $1 million realized loss in that, and that gives us a potential tax asset, assuming a 29% corporate tax rate of about $400,000. Our second Bitcoin sale was about a month later, in the week ending July 5th. We sold 3,588 Bitcoin, about 0.4% of our Bitcoin holdings, so about 100x more than what we sold the month before. Why did we do that? We did that to fund our pref dividends that were due June 30th of 2026. The average cost basis of that Bitcoin, $116,000, which came to $418 million. The sale price was $60,000. And so our proceeds are $216 million, which we used again to fund our dividends on our preferreds at the end of June. And we took a realized loss of $203 million, which allowed us to potentially book a tax loss of $59 million. If you see here, we have 843,000 Bitcoin, and you can see the size of the bars of our Bitcoin sales are almost not noticeable compared to our total Bitcoin holdings. Of course, then the question is, so the next topic I'll get into is what is our overall potential tax benefit? We showed this slide last quarter. Of all of our Bitcoin, we have about $18.5 billion in unrealized losses, which equals a potential benefit of $5.4 billion on our taxes. So selling high cost basis Bitcoin at a low price gives us the potential to take tax losses that can then offset future capital gains. So did our Bitcoin sales have an effect on Bitcoin price? Right? We have two data points, so I don't think we can make a definitive statement, but I thought it'd be useful to look at these two data points in a little bit more detail. Our 32 Bitcoin sale was about $2 million that week. And what happened after we sold the $2 million of Bitcoin? Well, in the week that we sold the $2 million, Bitcoin price went down 4%. The week after we announced the $2 million sale, Bitcoin went down 11%. And as a reminder, that was 0.001% of the liquidity of Bitcoin that week. So we were 0.001% of the Bitcoin trading volume when we made those sales. Right? 1 month later, we sold about 100x more Bitcoin. And the week that we sold 100x more Bitcoin, Bitcoin price went up 6%. The week after we announced it, Bitcoin price went down 1%, and we were 0.104% of the liquidity of Bitcoin in the week we sold. Did we have an impact on the price? Based on the liquidity, I would think not. Based on sentiment, perhaps. We'll continue to study this, but we thought it would be useful to share a couple of the data points. Another way to look at this, the bigger question we sometimes ask is strategy propping up Bitcoin price with our purchases? Is strategy moving down Bitcoin price with our sales? Does Bitcoin need strategy? And I think we've said many times, strategy needs Bitcoin. So how would I look at this? As an example, average Bitcoin liquidity has been about $26 billion of trading on a daily basis. If we look at the week where we bought the most Bitcoin in the history of the company, our average daily purchase was $363 million. That's the max, right? In that particular week, we were 1.42% of the trading volume of Bitcoin. If you look at the last 12 months, we would average about $56 million of Bitcoin purchases a day, which sounds like a lot. It is a lot. But as a percentage of the $26 billion of daily liquidity, we were 0.22% of the trading volume of Bitcoin. Bitcoin is extremely liquid. We are a large purchaser, but looking at these numbers, I would say we were not a material purchaser of Bitcoin. What about when we sell? Right, the most we've sold so far is $19 million a day. And in that particular week, that would mean that we were 0.08% of the trading volume of Bitcoin. And that's a pretty small number. And if we were to sell to satisfy our $1.7 billion of dividend obligations, that would average to about $5 million a day. And that would be 0.02% of Bitcoin liquidity. All right, so my takeaway from this is, look, we are a heavy participant in the Bitcoin market when we buy, but still not a material amount of the overall Bitcoin market. And we are a very, very small participant in the Bitcoin market when we sell. Back to the other pillars, so repurchasing up to $2 billion of our securities. All right, so this is $1 billion of our digital securities. We have a repurchase program now authorized. $13 billion is our market cap right now of our digital credit. $1 billion has been authorized. We said we'll prioritize Stretch right now. When would we buy Stretch? When it's trading at a discount to par. How much of a discount? That's subject to management discretion. Why might we buy it? We might buy it to reduce our annual dividend. Right? We might buy it to strengthen the quality of digital credit, and we might buy it to capture net BPS accretion. Right? On MSTR, it's about $38 billion in market cap. We have an authorization to buy back up to $1 billion. We have not used it yet. Why might we buy it, or when might we buy it? We might buy it when it's trading at a discount to net Bitcoin per share, which we have not seen that occur on a sustained basis yet this year. Why might we do it? Because we think it would create long-term value by capturing net BPS accretion. How would we do this? We could buy in the open market. We could buy via block trades, tenders, exchange offers. And what's the time frame that we might do this? We have no obligation, no expiration. We can modify, suspend, or terminate this program at any point in time. So how do we get Stretch back to par? Right, that is the focus of the company. That's the focus of the leadership and the management team. Right. To climb Stretch back to $99 to $100, we can adjust the US dollar reserve. You've seen us actively do that. We can maintain the Stretch rate. We're not planning on decreasing the Stretch rate to bring it back to par. And we found that increasing the Stretch rate is not really an effective way to bring it back to par. So our current plan is to keep the rate right at 12%. And of course, we can buy back Stretch, which we've seen us start to do. When we get back to par, we've learned a lot. We learned a lot about how Stretch trades. We learned a lot about the types of people buying Stretch. We learned a lot about the overall characteristics of digital credit, leverage, what layer 2 players do on top of it. So what would we do? We could manage the ATM issuance, right? We could not issue necessarily as much as we have in the past. We could adjust the Stretch rate, in this case down, right? If we see billions of dollars of demand for Stretch and we don't want to grow digital credit too quickly, we could adjust the rate down from 12% to 11% to 10% or whatever we see fit. We can manage the BTC reserve, meaning we could decide how much of our Stretch proceeds we put into Bitcoin. Historically, we put it all into Bitcoin, but we don't necessarily need to do that. We could put some of it into increasing the US dollar reserve. And of course, we can manage our overall capital structure. We can manage our convertible bonds. We can manage what else is in that capital structure. And then we can manage some of the policies, including the one that I've discussed. The Stretch rate is adjusted by observing multiple signals, right? We have a 12% annualized dividend rate right now. And when we return to par, we'll look at things like trading levels, market yields, the Bitcoin market, the US dollar reserve coverage, and the capital structure to determine what the right rate is. And I want to reiterate our capital markets principles that we've shared in the past, and there's 6 of them. 1, we're going to continue to create long-term value for MSTR. That's the most important of our principles, and we're going to do that primarily by increasing Bitcoin per share. How do we increase Bitcoin per share? We're going to do that by growing demand for Stretch, getting it back to par, and observe the trading characteristics and learning from that. We're going to responsibly reduce the convertible market debt based on market conditions. We did that in Q2, right? And we would consider doing that on a go-forward basis. We'll monitor Stretch demand and credit risk to determine the size of the US dollar reserve. I think we've learned from Q2 that keeping a robust 2 to 3 year US dollar reserve makes sense, and our minimum will be 1 year. We'll adjust the amplification based on market conditions. The price of Bitcoin is a big factor to the amplification. And we'll sell Bitcoin when it's advantageous to the company, which we've started to do, and you could expect that we may do that on a go-forward basis too. So with that, I'll pass it over to Michael Saylor.
Thank you, Peng. I want to spend a moment talking about our credit products and our business model. So let's start with digital capital. We use Bitcoin as digital capital, and we just upgraded our website, and we're making available a whole set of metrics for Bitcoin investors to track Bitcoin as the investment. So what you'll see here is on our website, we're now tracking the real-time Bitcoin price and the market cap, but we've also added the 200-week moving average. We view that as being something akin to the basis in Bitcoin or the book value of Bitcoin, and a lot of Bitcoin movements are anchored to it one way or the other. You'll see that we're actually calculating the premium to the 200-week moving average in real time on our website. And we've also added a pretty neat metric, time above. And what you'll see on our website is that Bitcoin right now, it's trading at a very slight premium to the 200-week moving average. And for about 91% of the history of the network, it is traded at a higher premium than that. And so I'd encourage anyone to go check out this website. It's pretty useful. We've got other metrics like Bitcoin dominance and hash rate, the fear and greed index. You can also see the net ETF flows. They were as high as minus $5 billion or so about a month ago. Now they're coming in. And so this is for people that really want to gauge the status of our capital base, BTC. Now, let's go to the next slide. And what you see here is that that we're, in a phase of weakness. We're sitting now resting right around the 200-week moving average. If you're a capital investor, I say you have to take a 4-year time horizon. So the right price signal to look at is the 200-week moving average, and you see it's a pretty up and to the right message and signal, but you can see the periods of exuberance around late 2021. There was a massive premium. Then you could see in the crypto winter, we fell to a slight discount, and then you can see we traded back to a premium. Right now, we're sitting right on that moving average. Now, if we ask the question, what are the headwinds holding back Bitcoin? We really think there are 5. There's an AI capital expansion, $1 trillion or more of capital that are flowing into the data center build out, the AI center build outs, it's with the SpaceX, the Google, the Meta, the Anthropic, the OpenAI. And then of course, you're probably familiar with all of the Bitcoin miners, and they're building out their data centers for AI, and they're extremely capital intensive. That's created capital suction in the equity capital markets, and also an attraction in the private credit markets where massive amounts of credit capital has been flowing. So that's a headwind. We think at some point we'll get through the biggest phase of that build out, and we'll settle into an equilibrium, and that headwind will become neutral, attacking wind, or it'll subside. We also see trade tensions have been weighing on Bitcoin, all the foreign tariff wars and trade wars and uncertainty. The Gulf War disruption is a macro headwind. It's and it revs up and subsides, and things escalate. The Fed policy has tilted to becoming more restrictive over the past 9 months. And we could see even as of yesterday, there were rumors that the Fed might raise rates, and 3 of the Fed directors or governors actually voted to raise rates. So that restrictive monetary policy from the Federal Reserve has been a headwind. And then delays in regulatory clarity. The clarity bill has not moved as quickly as people have expected, and there's substantial uncertainty about when that will be resolved. So those are the headwinds that we face right now. We also think any one of them could become a tailwind or a catalyst. And we think generally Bitcoin has done pretty well in the face of those headwinds. And as we get good news in any of those areas, I think that'll be very positive for the entire Bitcoin market. You can see that sentiment is near a cycle low, and this is the fear greed index. And we track this on our website now, and you can click through and you can see it. So that sentiment reflects itself in a number of ways in our equity price and our credit prices and in the Bitcoin price. But there are many, many positive factors in the Bitcoin ecosystem right now in the industry that I'd like to highlight. One of them is the BTC dominance has been consistently growing since the 2021 low. It's expanded about 20%. And now if you look at Bitcoin's market cap as a percentage of all the market caps of the crypto tokens, not including stable coins, Bitcoin is a bit more than 2/3. And we think this is an incredibly bullish sign. So when I refer to the fact that Bitcoin has won the race to be the dominant digital capital network and the dominant digital monetary network in the world, I think this metric is one of the key signals that shows that it's won. There really is no serious discussion of a flippening. No one thinks that Solana or Ethereum or any other crypto network is going to flip Bitcoin. Bitcoin is the winner. And that's incredibly clarifying insight, because if Bitcoin is the digital capital network for the next decade, it's more likely than not that it's the capital network for the next 100 years. And we are building our credit structures and our equity structures on top of it. So this is the biggest uncertainty taken off the table over the past 4 years, underappreciated by many people. But perhaps it's more important than any other, week by week, month by month, year by year development in the entire digital asset space. We keep track of banking adoption in this space, and I've noted that the real drivers of Bitcoin price are going to be the formation of credit networks, either digital credit or banking credit. And of course, the banks have the ability to create incredible amounts of credit. So if the banks create credit on top of real estate values increase. And as banks create credit on top of digital capital, on top of Bitcoin, then the value of Bitcoin will increase. By our own Bitcoin Banking Adoption Index, which we just rolled out, and it looks at the top 25 leading global banks, you can see that we've advanced from 9% to 14% to 24% to 32%. And so we think this is just incredibly bullish. We will keep track of this adoption index each quarter, and on our quarterly calls, we'll report back to you as to how things are developing. Another great development this quarter is the formation of the Bitcoin Security Consortium. We worked in conjunction with all of the major Bitcoin investing and custody and trading institutions in the United States in order to form this consortium. And this is in response to a lot of investor requests, a very broad-based sentiment across institutional investors that they have clarity about how the Bitcoin network will address future security concerns. The most well-known one that's been talked about the most over the past 6 months has been quantum computer risk. And lots of investors wonder, how would the network react to a quantum threat should it materialize? And we have joined forces with all of these other institutions to make sure we stay coordinated on that. There are a lot of people doing really good work in the space. The point of the consortium is to support any work that is pro Bitcoin security related. We all want Bitcoin to be a secure network for the next 100 years. And so I personally have had a lot of enthusiasm for supporting security related work with regard to Bitcoin. I supported security efforts starting about 2020 with my own personal funds. And so this is really the natural evolution of institutional investment in the security of Bitcoin. The intent of the consortium is not really to drive the protocol or protocol changes, but really just to fund investments committed to security and stability of the protocol. And each of the various institutions involved is going to make their own decisions. However, institutional investors would like a common voice and they would like a coordinated response. And so it will be helpful for the entire institutional community and for banking adoption, investor adoption, and to get positive regulatory adoption and nation state adoption of Bitcoin, for us to be able to coordinate and to communicate the work that's going on, and then make sure that we're ready for any security threat that may develop in the future. So a few words on digital credit. Stretch, STRC, is our flagship digital credit product, and we're laser focused on Stretch. Our goal with Stretch is we want to increase the liquidity, we want to decrease the volatility, and we want to build an ecosystem of market participants. We want people that are willing to trade it. We want people that are willing to short it. We want people that are willing to go long and hold it forever. I'm not terribly bothered by the fact that someone might buy it at $88 and sell it at $95. We would love for that to happen. We'd love for another group of people that buy it at 95 and hold it till it goes to 98, and other investors that will buy it whenever it falls below 99 and write it back to 100. And if they don't want to hold it at 100, that's okay. They'll be creating liquidity for other buyers at 100, and that stabilizes STRC. So we welcome derivatives traders, long traders, short traders, anyone that has any particular view, it's fine. If someone wanted to sell $1 billion of STRC short, they would be paying the 12% dividend, and so they would be paying $120 million a year in order to create $1 billion of liquidity to the benefit of our digital credit. So again, we don't really worry about it. We would like to return to par with the broadest, most diverse ecosystem of market participants that we can possibly develop. And so that means sometimes instead of doing things immediately, like we could, return STRC to par very quickly using our own capital, but that would exclude many of these other ecosystem participants, and we would be getting ahead of our equity investors, our credit investors, Bitcoin investors, and the like. So we will move progressively and deliberately with the thought that we want the deepest, richest derivatives market, the deepest, richest credit markets, the deepest, richest equity markets, the most clarity, the most liquidity, and the broadest reach with regard to STRC we can possibly create, and that will be best for everybody involved. You can see our progress toward this here. STRC has grown from 2.8 billion in notional value to 3 at the end of Q4, and then to 5.3 billion at the end of Q1, and then to 10.5 billion at the end of Q2. It's growing quite rapidly, and we're sort of in a hyper growth phase. If we go to the next slide, you can see why it's growing. Simply put, it's the highest effective, the highest tax equivalent yield and the highest effective yield of any major class of credit in the world. And right now we see STRC as competing against private credit and bank preferreds and junk bonds for the most part, those three categories. But we think over time it will begin to compete against investment grade credit, mortgage-backed credit as well. The effective yield is 13.6% right now, but the tax equivalent yield is 21.6%. We think that digital credit is going to be the best credit, is the strongest credit, because it's based upon the strongest capital asset, BTC, and because it's based upon the strongest business model. The digital treasury company business model based on digital capital has lots of advantages in creating the highest tax equivalent yield. And so simply put, we think we've created one of the world's great business models for creating one of the world's great products, the product being digital credit. Now, of course, I would think that, but the real question is, what does everybody else think in the world? Well, I think the most sophisticated preferred stock investors in the world could reasonably be considered to be those running the Blackrock PFF fund, the Virtus InfraCap PFFA fund, and the Van Eck PFXF funds. Those are the three largest preferred credit indexes that are publicly traded, and they're custodians of billions of dollars of capital. One thing that you'll note here in the past 12 weeks is that STRC is now the number one holding at all three, right? So it's not a fluke. We used to be the number 3 holding. We crawled up, past everybody in the market to be number 2 or number 3 in a hurry. But in the past few months, we've emerged as the number 1 holding, and it's not a fluke. It's universal across all 3 indexes. So we think this is incredibly bullish because you can develop all sorts of theories about what retail investors like and don't like, but I don't think anybody disputes that a professional money manager who's in the business of managing preferred equities and has been doing it for a long, long time is pretty good at it. And they've got a lot of skin in the game, and they're responsible to the most sophisticated institutional investors that are their investors. And you can see here on this table that we're the security of choice for all 3 and the number 1 security. And that we've got a lot of momentum here, right? When other people were selling, they're actually buying STRC, and I think that's very positive. Who's digital credit for? It's for every investor class, right? We're going to continue to refine it, and we're going to offer it to retail investors, to institutional credit investors, to corporate treasuries, to hybrid hybrid hedge funds and equity investors, and to digital money and crypto native investors. And we think that all 5 of these groups are just incredible growth opportunities for us. If we look at a snapshot over the past 3 months or so, you can see that 78% of STRC was held by retail and 22% by institutional March 17th. But as of the 1st of July, the institutional holdings had grown from 1.1 billion to 3.1 billion, so tripled, and they're now 29% of STRC outstanding. On the other hand, retail investments had not quite doubled. They were still very strong, but now they're 71%. So we think that the trend toward more institutional adoption is great for the stability of STRC. You can see on the right side of the slide that the average retail account grew from $44,000 to $48,000 over that period, and the average institutional holding went from 1.7 million to 3.5 million over that period. These are very, very bullish metrics, and they speak to the seasoning and the maturation of the asset. When we came public with STRC, it took us about 70 trading days to reach par. And some people forget this, but when we did the IPO, we IPO'd at 90. It took us 70 days to get to par. And if we trace the period since STRC fell below our trading range of 99 to 100, and where we are today, it's been 40 trading days. So if we were to trace forward 70 trading days from when STRC fell out of our trading range, that would put us around September 8th. So we're keeping track of that date, and we're keeping track of our progress. We will focus upon returning STRC to health. And we think that if we did it in 70 days after the IPO, then it's reasonable to target 70 days after it fell off our trading range from May 28th. We have the means to return STRC to par. Right now, you can see the market cap is 9.2 billion, and the notional is 10.5. So there's about a $1.2 billion dislocation. We have allocated $1 billion to buy back STRC, about 2% of our BTC reserve. We still have $975 million of that program available to us. And so the first place we look is to use that buyback program to cure the dislocation. But I would remind everybody that the company has total reserves of 58.5 billion. I've shown the bar on the right, and what you can see is that if the $975 million doesn't cure the problem, we have ample additional capital in order to cure the dislocation. We're currently in a discovery process to figure out how much capital it will be required on our part in order to return STRC to par. We're certain that we will return STRC to par. That is the goal, right? So there's no question about whether or not success is returning it to par. It is returning it to par. The big question mark is, how extensive will the buyback be, and how rapid will the buyback take place? And then what will be the exact open market execution strategy of the buyback? We are calibrating day by day, and sometimes multiple times a day, as we learn from the market. And of course, we have a lot of market signal every minute of the day, every day of the week. We also are getting signal back each week as we put out a new announcement about our status. We think this is one of those things where we want to do it not too slow, but not too fast. And we want to allow other investors, our credit investors, our equity investors, and the Bitcoin community to participate with us. But especially we want our other credit investors to join us on this journey. We can go to the next slide. We updated our credit tab on our website, and I would encourage anyone to go check out that tab. One thing you'll see is the BTC ratings of all of our credit instruments, and you can see that the senior bond has got 122x over collateralization. You can see that STRF is now 12.9 BTC rated. So the BTC ratings of the instruments are improving as we build a US dollar reserve. We think this is obviously good for credit investors. You can calculate the BTC fair credit spread based upon your assumptions about forward volatility and forward Bitcoin ARR. We've added a new metric, the BTC floor rate. And the floor rate is the rate the Bitcoin would have to fall on an annualized basis in order for these credit instruments to be collateralized 1-for-1 at the end of their duration. And so how do you get to a BTC rating of 1 for STRF? Bitcoin would have to fall 21% a year, more than 21.6% a year forever, in order for STRF to be under collateralized at the end of its duration. So this gives you a sense of how fragile or robust any given credit instrument is. And you can see, for example, with the senior bonds, Bitcoin has to almost, go to zero in a hurry in order for those bonds to be under collateralized. But you can see even with STRD, the floor rate is 10.8%. And the floor rate across all of these things, all of our credit instruments, is 11.8%. And we're starting to publish that on our website. We think that that's pretty useful for our credit investor. We can go to the next. I've got our credit model here, and it's a little bit more detailed. And I guess I'll just make a few points. If you're a skeptic, and if you think that Bitcoin's going up 0% a year forever, it's basically not going to perform, then the BTC credit spread that the model would spit out is for STRF is 86 basis points. So STRF would still be investment grade, even if your view of Bitcoin was it's not going to perform forever. The other instruments, STRC, E, and K, they start to look somewhere in the intermediate level as high yield, and STRD kind of falls into distressed debt levels. But having said all that, all of those publicly traded credit instruments have a spread premium over over that theoretical BTC credit spread, right? Because the market is pricing them much weaker than that. So even if you're a skeptic, they've all got very, very large 474 basis point to 670 basis point spread premiums. Now, what does it take for all of those credit instruments to be investment grade? Let's go to the next slide. Right, the BTC investment grade rate is a little bit more than 12%. So you can see at 12.5%, all of the credit instruments publicly trading, STRF, C, E, K, and D, they all have credit spreads, theoretical credit spreads, less than 150 basis points. And so, if you think the Bitcoin is going to perform like the S&P index, gold's been about 12% for the past 6 years. The S&P has been a bit more than that. But if you have an optimistic view toward Bitcoin as it's a legitimate capital asset, you can see that the credit spreads all look investment grade. The spread premiums, are anywhere from 550 basis points to 1,048 basis points. If you're a long duration credit investor and you don't need your money back for 4 years or more, and you just want to make a long duration credit bet and you believe in the company, then you buy STRD and you get paid 1,048 basis points of spread premium and effective yield in the 16% range. The company's not going to suspend its dividends because we're going to protect the digital credit business. If we were to suspend the dividend, then that would destroy the credibility of the company and digital credit. It would be devastating for the asset class. So if you believe the company's business plan and if you believe in digital credit, you can see that STRD is a high effective yield and a massive spread premium. If you semi-trust the company and you just want a lot of investor protections, but you're a long-term credit investor and you don't need your money for 4 years, STRF is showing a BTC rating north of 12 right now. So what you can see is the senior $1 billion in the credit stack out of 15 billion. It's got penalties, dividend penalties. It's got dividend stoppers, right? And on the other hand, you're collecting an effective yield of 10.5%, and you're getting a extraordinary spread premium. And the company doesn't have any discretion to lower that dividend. So if you're a professional credit investor and you don't need your money in 4 years or longer, then if you trust the company, you buy STRD. If you semi-trust the company, you buy STRF. But on the other hand, if you're a short duration credit investor and you're going to want the money back in the next year or 3 months or 6 months, well, then you just don't want the volatility. You don't want to wait. And that's what STRC was built for. It was built for the shorter duration credit investor. I guess we would say at this point, if you think you need the money back, in less than 3 months, you're probably a money market investor. If you need the money back in 90 days, you're probably a money market investor. You're going to put your money in a money market. But if you could wait 4 months to 4 years, anywhere in that duration, then you're a short duration credit investor, like a stretch investor. And if you don't need the money for more than 4 years and you're a credit investor, you might want to look at some of the other preferreds. And of course, if you don't need the money for more than 4 years and you're a capital investor, you should buy Bitcoin. And if you don't need the money in less than 4 years and you're an equity capital markets investor and you want to amplify Bitcoin, you buy MSTR. But I think these models illustrate this pretty effectively. And that takes me to my next point. We think digital credit is the best kind of credit. We think that we're uniquely positioned to create digital credit. And the best form of digital credit, the one that's in the greatest demand, is going to be Stretch, STRC. It's going to have the greatest liquidity. It's going to have the largest AUM. It's the shortest duration. And in all of our discussions with credit investors, plus our view of the market, we've seen that what the market wants is they want the shortest duration, lowest volatility, highest liquidity, most stable, highest AUM, most broadly distributed credit. And STRC is already the most liquid and largest preferred stock in the world. So we expect to keep laser focus on it. We're going to do everything we can to make it the most appealing credit in the entire digital credit space. And we think that if we do that, it'll be incredibly compelling credit for people that might otherwise invest in private credit or junk credit or corporate credit. A few words about our equity. We now publish the hurdle rate, the break-even rate, and the floor rate on our website. The hurdle rate represents our blended current cost of credit. And so if Bitcoin outperforms the hurdle rate, then in our view, our BTC gain, when we sell $10 billion of credit and we book a BTC gain of X billions of dollars, let's say it is 10 billion, then if Bitcoin outperforms the hurdle rate, we're never paying back the credit, which means that the $10 billion is $10 billion of net income. So the company becomes incredibly profitable on a BTC gain basis when Bitcoin is outperforming the hurdle rate. And you could think of this as 4 simple zones. If you think Bitcoin's going to outperform the hurdle rate and you're an equity investor, then our equity will capture the positive spread over the credit. We're borrowing money at the hurdle rate. We're investing it at something that might be 15 or 20%, some premium to it. And so it's an incredibly good business. We capture the spread, and then we can cover the cost of the credit with the capital appreciation. And so the equity will thrive. But of course, the credit will also thrive because we're making a wise investment. So in that zone, equity and credit both thrive. If you expect Bitcoin to appreciate between the break even and the hurdle rate, The equity might underperform. It may not. We have a lot of tools at our disposal. We may actually benefit from the float and the volatility, and we can do a lot of things that may be good for the equity, but it's a bit harder for us. We have to work at that. So there's uncertainty around the equity. The dividends are still covered because we're substantially north of the break even. As long as Bitcoin's at the break even rate, we can pay the dividends indefinitely, and we can do it without even selling a share of equity or without any other capital or recapitalization. So you're in a pretty safe zone, a very healthy zone for the credit. And for the equity, we're in an operating zone. We have to think hard about how we can still perform, but it's harder than when we're substantially above the hurdle rate. Now, if Bitcoin underperforms the break-even rate, that's challenging for the equity. The equity will probably underperform. And the credit, for the credit, we have to do things over the long term. Like, we've got at 0%, we've got like 33 years. Right? That's the duration of the company. So it's not like we don't have time, but sometime in 33 years, we're going to have to do something if Bitcoin performs 0% a year. So we start thinking about what we might do if Bitcoin falls below the break-even rate. Below the floor rate, that's when we start to think that's a challenge for the equity. The equity is definitely going to underperform, but the credit's going to be impaired. And so that means we have to think about restructuring, the credit. We refinance debt, we roll it forward. We would have to become creative. But you can see here just how bad things have to get before you get in that zone. So the beauty of a Bitcoin Treasury company is there's transparency every 15 seconds to this, and you can create all of your own models, statistical models, to figure out what you think's likely. You can plug in your own assumptions, and then you can figure out whether or not you're long equity, short the equity, long the credit, short the credit if you want to hedge these things. There's so many different ways to be long, short, straddle, or take risk off the table. And we welcome it and we encourage it. That's one of the reasons why our derivatives markets are so healthy and why the equity has so much liquidity. But what I would say to anybody is check out the website, look at these rates, and come to your own opinion about what you think Bitcoin's going to do. Now, the history is Bitcoin's been appreciating 33% a year for the past 6 years. And if you go to our website, you'll find we've got the 10-year rate as well. So you're not without resources here. Where are we right now? The markets right now are pricing fear. It's a very muted market, very skeptical market. Bitcoin's trading at a very slight premium to its 200-week moving average. As you can see, our credit is paying an 870 basis point premium above the BTC credit spread you would predict. If you plugged in Bitcoin appreciating 12.5% a year and staying as volatile as it is right now, then the credit would be fairly valued at 870 basis points less than it currently pays. And so you can see the credit markets are fairly skeptical. The capital markets are fairly skeptical. They've traded with a premium north of where we are 90% of the history of Bitcoin. And the equity markets are fairly skeptical. MSTR is trading at a 5.5% premium to our net assets. And you can see this illustrated a bit more on the next slide. Right, if the MSTR price implies a near zero value for the digital credit business. In essence, if you look at the market cap of the company compared to our net reserves, if we were to pay off all of our liabilities at face value, we still have $36.3 billion of net reserves. And the market cap is $2 billion in excess of that. So the real issue is, what is the operating business worth? And so our view is, if we can sell $5 billion of digital credit a year, and if Bitcoin outperforms the hurdle rate, then that looks like $5 billion of net income to us, and the business ought to be valued at some multiple of that, depending upon robustness and growth. If we can sell $10 billion of digital credit a year, then you could imagine the business being at some point, we show the market we can do it. We show the market we can grow from there. You could put a 10 P to E on that. And so what you can see is our view is the digital credit business is dramatically undervalued. It should be worth something substantially more than $2 billion. The market is pretty much skeptical that there is a operating business there. As the market begins to realize that we have a digital credit franchise, then I think that they'll put a bigger P to E on that. And as we show that we can stabilize STRC and we can grow it in a stable, steady fashion, then I think that we'll see those multiples expand and the value of the digital credit business will expand as well. And I think that's very bullish for the equity. MSTR is built to outperform Bitcoin over the long term. And one way to see that is looking at these statistics. If you're a short duration investor, if you're just trading on a daily basis or weekly or monthly basis or even quarterly basis, it's pretty much a coin flip whether MSTR will outperform BTC. But as your duration stretches to 1 year, you get a substantial advantage. When you go to 2 years, it's 64% likely. When you get to 3 years, it's 87% likely. And in 495 windows of 4 years or longer, MSTR has outperformed Bitcoin 100% of the time. So if you're a 4-year investor, you've got a long time horizon, you can see that as the time horizon extends, the laws of statistics start to work in our favor, and we begin to outperform. And you can see it reflected here in the last 6 years, from August 10th of 2020 to today. Bitcoin's up 32%, MSTR is up 42%. The Mag 7's up 23, the S&P's up 14, gold's up 12, real estate's up 8, money markets give you 3, and bonds are a minus 4% loser. So our strategy is fairly straightforward. The stats seem to be telling a very clear story. We believe that we can continue to outperform Bitcoin, and the engine for doing it is the digital credit engine. Why do we believe in the franchise? Well, let's look at these 4 factors, right? We're sitting on an incredible capital stack. We have $55 billion of Bitcoin, $3.75 billion of US dollars, and we're a well-known seasoned issuer. That gives us a big capital advantage. We also have a technology advantage. We've been in the business for a long time, 35 years, but also we invented a lot of these credit instruments. We've been trading them in the markets. We've learned a lot about how they trade. And we think that understanding how digital credit works and how digital equity works is a big tech advantage. A third pillar of our franchise is the brand. We have millions and millions of followers. They know who we are. We're well known everywhere in the world, in every major capital market. This is a big advantage. And then finally, there's a network effect. Millions and millions of investors, tens of thousands of institutions, deep pools of liquidity. We've got the highest ratio of open interest to market cap in the S&P universe. We've got a very deep, I think one of the most liquid stocks in that S&P 500 universe. So deep equity liquidity, deep derivatives liquidity. We've got the most liquid preferred stock, so deep credit liquidity. Lots of people trading these things. Lots of people making a market in them, all of the hedge funds. And we pride ourselves on creating lots and lots of trading pairs. So there are a lot of ways that people can be long, short, hedged, straddled, in equity or credit or derivatives. And that's a very, very large financial advantage and a large brand advantage for MSTR. And we think that we will be able to grow that. So simply put, what is the goal of the company? What's our ambition? We want to be the world's largest company. That's our ambition. Well, largest in what terms? Not the most employees, not the most products. We want to be the largest in terms of market cap, the most valuable company in the world. And what's our plan to do it? It's very simple. Own the most capital. BTC is capital. We're going to own the most. Our strategy is own the most capital. Who else would say they want to own capital? Berkshire Hathaway in the 20th century. I don't think they're as ambitious right now as they used to be, since most of their capital is sitting in T-bills or, sovereign credit. But in essence, Berkshire Hathaway had a strategy to hold a bunch of capital. We have a strategy to hold a bunch of capital. Most other successful companies don't have that strategy. The second prong, after we own the most capital, we're going to issue the strongest credit. If we have the world's best capital, the best performing capital asset, BTC, we should be able to create the strongest credit, STRC. And we think for every dollar of capital, we can sell 10 to 20 cents of credit per year. And so the more capital, the more credit, the more liquidity, the more stability, the stronger the brand, the lower the volatility, etc. And then by issuing the strongest credit, we think we'll create the best equity, MSTR. And that just becomes a virtuous cycle, acquire capital, issue credit, create equity, rinse and repeat. And, we have done that. We've gone from a $600 million enterprise value 6 years ago to 60 billion. So by a factor of 100. And we think we're just getting started. Now we're getting the engine tuned and the credit turbine is beginning to spin up again. I will end by thanking everybody for your support, reiterate our principles. They haven't changed. And with that, we'll be happy to answer questions from the panel.
Thank you, Michael. We'll now start the live Q&A session. I'd like to welcome all our Q&A guests and invite them to turn on their video. We look forward to your questions. We'll go one at a time. I'll call out your names and you can direct your questions to the management team. For the first question, we have Mark Palmer. Please go ahead.
Yes, thank you and good evening. Earlier in the call, Peng noted that management has learned a great deal about the investors in Stretch and how they think. And one thing that we've seen is that the size of Strategy's USD reserve is important to retail investors in particular, and more important than the amount of obligations ahead of Stretch in the company's capital structure, such as the convertible bonds. With that said, would you consider borrowing against Strategy's Bitcoin holdings, specifically with a bank with a fortress balance sheet as your counterparty, and use the borrowed funds to increase the USD reserve to a size that would put to rest any concerns about dividend coverage, and presumably drive the price of Stretch back up to par, at which point the company could resume buying Bitcoin?
Peng, do you want to take that question initially?
Yeah, I can start. I think the feedback is that something between 2 to 3 years from our institutional investors is that level that we need to get the Bitcoin reserve to. We're at 2.1 years. We're continuing to grow. We're doing it primarily through issuing equity at a premium to net asset value. We have considered and talked to many counterparties about borrowing against our Bitcoin. And I would say that the market is not as big and not priced as well as you would think it would be at the size we want. So it's not something we've considered doing. The other thing we have to consider is the counterparty risk, the terms, et cetera. So it's not something we've really looked too hard into. I think we have better ways to build up the US dollar reserve.
Yeah, so I think the short of it is it's not on the table right now. The company has the option, right, in the future if we ever needed to use Bitcoin, but we think that right now it would be more complicated than it's worth, and we have more straightforward ways to build the USD reserve up that will create fewer questions or counterparty risks or uncertainties. And so our goal, I think, is we would like to eschew debt. We would like the existing amount of debt to be the maximum we have. We would like it to be progressively whittled down in a responsible way over time. And we would like to avoid any kind of appearance of a margin debt or mark-to-market loan on the balance sheet, just because it tends to be an attack surface and an attack narrative for short sellers. And we don't want to create anything that creates those uncertainties if we don't need to. And I don't think we're going to need to.
Thanks, Mark. Next, I'd like to invite Matt Hogan.
Great. Thanks for having me. Michael, Andrew, Fong, thanks for a great call and good execution on a difficult quarter. I have a two-part question. So watching the business evolve, you've periodically added new tools to the toolkit, first equity issuance, then convertibles, then preferreds, then perpetual preferreds. The first part is, are we at the end of that series of innovations, or are there more instruments coming down the road? And then the second is a variant of that. Through the BTC monetization program, you have effectively found a way to sell volatility and sell the volatility of investor sentiment at the securities layer. Wondering if you've considered, or there are reasons why you wouldn't also consider selling volatility at the derivatives layer as another tool in the toolkit to navigate always changing market environments.
I'll start with that, and then you guys can chime in if you like. Right now we have 6 bonds and 5 other credit instruments. So we have 11 credit instruments. We could issue 6 more tomorrow. We could do 1 a week every week, and we could blow out to 18 or 24 or 36 or 48 credit instruments. We could go, but we're actually, it's not hard to issue a credit instrument when you have 55 or 60 billion of unencumbered capital. We're going the opposite direction. We're laser focused on consolidation. So, I rather like the business model of like the Strives. If you look at Strive, they've got 1 equity, ASST, they've got 1 credit instrument, SATA, and that's it. And it's just a question of how big will the market cap of the equity get, and how big will the market AUM or the market cap of the credit get. And, I think you probably should expect that we won't have more, we'll probably have less. So I think our 11 credit instruments will be whittled down. Our explicit plan is to whittle them down over time. I'm certain that we'll keep STRC. STRC is the flagship. All the focus is STRC. We think that the other prefs that publicly traded are option value if they were fairly valued. Right now, they're not fairly valued. They're way undervalued. So, like, my message is, if you get this, you ought to go buy STRF or you ought to buy STRD. They're incredibly compelling institutional opportunities for a long-term credit investor. They're so good that I won't sell it to you. Right? Like that's how good they are. The bonds we don't see as strategic. We think that we had to do the 5. If I could do it again, Matt, I would do no bonds I would just sell STRC. I would go directly to, don't stop anywhere else. Just go to the winner if I could do it again. And I tell people generally, like if you're sitting on $5 billion of capital and you're a Bitcoin treasury company, don't sell convertible bonds, don't sell long duration credit, don't sell convertible, don't sell a product like Strike or Stride or Strife or Stream. Just create something which is short duration credit like STRC or SATA, because we know there's 50x to 100x the demand. So if there is 100x the demand, we don't really need to create any new credit instrument to grow. And in fact, that, it's like I say, just because you can do a thing, doesn't mean you should do a thing. I actually think this is one of those examples where don't just do something, stand there, right? Like the more you do, the worse it is, because every new credit instrument robs liquidity from the one that really matters. So we're interested in combining liquidity or building liquidity. So it's more likely that we would offer you a swap to swap into STRC and pull liquidity than we would ever bifurcate it. And it is true. I can imagine 100 cool things to do. Like I can imagine digital money in yen or Swiss francs or pounds or euros. I can imagine a 10 vol credit instrument in euros, pounds, or francs. I can imagine a 0 vol money instrument in those things. We're just not going to do it. That's what I would say for everybody else. Every one of our partners, they're great ideas. You should do it. But for us, they would be a distraction and they would dilute our focus and they would dilute liquidity. It's like, rather than even if I could issue, for example, Stretch in euros, I would rather issue Stretch in dollars and have someone else create Stretch in euros and buy the currency hedge and get paid 200 basis points and they make a lot of money off that business than for us to do it. So we feel like we've got kerosene. We're not going to design the jet airplanes, the trains, the planes. Everybody else can build every refined version of it that they want. So I don't think it's constructive for us to be over inventing product right now. It's kind of demonstrative when you think at Apple. They're still making all the money off the iPhone. And it's like, I'm not against magical revolutionary product, but let me put it as a hurdle as this. If you came up with an idea where the demand was $100 billion or the market opportunities between $100 billion and $1 trillion, you might get my attention and we would talk about it. But if you gave me a $10 billion idea, I would say that's a distraction. And the only ideas I can think of that are $100 billion ideas are things built on top of STRC by someone else. And I hope someone else does build a $100 billion thing on top of STRC. Good for them. I hope they make billions and billions a year off of it and everybody lives happily ever after. But I'm reasonably sure that we're more likely to commit a foul by creating other things rather than by focusing on the one thing and making the one thing. Because the one thing is short duration, low volatility, high liquidity, stable credit. And that's $1 trillion opportunity for us. And if that's all we do, if that's all I do in the rest of my life, then that will have been greater than I could have ever hoped for. So that's what I think of with regard to that. Now, the second part of your question, selling volatility. We could go and we could sell volatility. We could sell tranched, we could sell out of the money. We could sell out of the money call options on Bitcoin. We could sell volatility against the commodity or the capital asset, BTC. We could also sell volatility against the equity. We could actually sell warrants on MSTR. And it's not lost upon us, right, that we could sell a warrant on an MSTR. By the way, when we sell convertible bonds, we were selling a bond with a warrant. So I could go and sell a $200 strike on MSTR, or I could tie it into a convertible bond. But as you know, we don't want to sell bonds because bonds are senior to stretch. So that's a non-starter. Now, if I were to sell the warrant, I'm selling volatility, but I'm stripping volatility. I'm clipping it off of the common stock. And so the point really is we are selling volatility right now, Matt. And the way we're selling volatility right now is we're selling MSTR. And so when we sell MSTR, MSTR has a 90 vol or 80 vol. And the reason people want to buy it from us is because it's got vol. So if I turned around and I sold $1 billion of volatility on top of MSTR, I changed the convexity of the instrument and I strip the volatility from the equity and I transfer it to the other security. So this is kind of like I can sell 5 credit instruments senior to STRC, but they undermine my best idea, STRC. And I could sell 5 warrants. I could sell a warrant at 150, 200, 250, 300, 350, 400. But I'm stripping the vol and the value off of the underlying security. And what I'm doing is fragmenting all the liquidity and I'm creating complexity. And this is something that, a professional options trader at Susquehanna or Millennium or Citadel or Soros, they could do all day long. And my view is they're better than us. And so there's two thoughts. One is, I don't want to steal an opportunity from a credit investor or an equity investor or a derivative investor. I don't want to steal it from them. I want to leave it for them. I want them to say, oh, these goofball guys, they could sell the volatility, but they don't, so I can. It's like you can. That's why people that we never met, that I've never had a meeting with the derivatives traders that create the options market and our stock, and yet they just spend this stuff up for us, right? That's the reason they do it, because that's what they do. So I don't want to steal their opportunity and I don't want to make their job harder. I want them to have complete transparency and line of sight for 5 years, right? For as long as possible so they can create all these things. But the second thing is, there's a general principle that we're a publicly traded company. We should do things that we are uniquely able to do that they can't do. So a guy with $100 million in a Bloomberg cannot create STRC, and they can't they can't do what we're doing. They can't issue it, right? And they can't improve it. And they also can't create MSTR. So we're creating securities. We can create publicly traded liquid securities globally, and they can't do that. But what they can do is they can interrun all those trades. So all of those other trades, whether it's like strip the vol, convert the currency, change the duration, butterfly between 1 year and 3 year, amplify it up, damp it down, structure it. They can do it. They should do it. I welcome them to come do it. And our representation to them, our promise is we won't compete with you and we won't change the convexity. Like how would you feel if I put out a press release saying I just sold BTC call options at $75,000 a coin against $50 billion of Bitcoin? How do you think about the equity then? They're like, well, he just stole the upside on the equity, you see? And so the equity investor, and then how do you feel about the derivative, the call option guy? It's like, wait a minute, I just created that market and they just distorted the market in derivatives and they're mucking with it. And now you've got all this issue of derivatives guidance. And so we're not trying to make the company more complicated. We're trying to make the company simpler. And it's such a good idea. My view is, yeah, it is a good idea. So I leave it for someone else to do. And it's not that we're not selling the vol. We're selling the vol, right? We sold billions and billions of dollars of equity. And it's like, to a certain extent, the people that bought it from us were buying it for the volatility and for the upside. And when we start selling the vol, we're stripping their upside away from them. And ultimately there'll be a price to pay. So I think it's one of those things where it's easy to do. I could raise $1 billion in 2 days by selling the warrant. I could raise $1 billion in 2 days by selling the convertible bond. I could raise $1 billion in 2 days selling a junk bond. And it's easy come, but there would be a bad hangover, and the hangover would be it would change the characteristics of the other securities, and it would fragment liquidity, and also it would undermine trust, right? And the trust is like, I'm not going to do that, and so you can take advantage of that knowledge to put in whatever trade, trade against me or trade with me, and it's more important for us that we make the biggest possible market in the equity MSTR and in the credit STRC, right? Than that we pursue every cool idea. One more point I'll make. We could generate billions and billions of dollars of revenue by selling volatility against BTC right now. We would also generate a multi-billion-dollar tax liability. And then the equity investors absorb the tax hit, and then we pass it through to the credit investors. So MSTR equity investors currently have a business model where they've got a deferred tax on capital gains, and the credit investors have a deferred tax on the credit dividend. And so we have a very tax efficient business model. And if we start to get cute by doing all this, we create lots of complications. You're like, well, maybe they don't care about deferring tax on the credit. Well, actually, it's not just that. It also eliminates the withholding tax for foreign investors. So you might get a 30% withholding tax. So this has so many complications to the tax efficiency of the credit or to the tax efficiency of the company, and introduces counterparty risk. And all of those are micro reason to do it. But to tell you the truth, the real reason that we don't do it is because I want some dude with a Bloomberg to get up in the morning and lay a $500 million bet, taking advantage of what he knows about volatility, or she knows. And I want them to know that they can put that trade in, and we're not going to rug pull them and, by counter trading or trading against them. Because the most important thing, the thing that's made us successful, is a very good partnership with the Citadels and the Millenniums and the Susquehannas, right? And the Soroses of the world, and the capital investors of the world, and capital groups, and then all those credit investors, and all of them, they've got their own models. And the last thing in the world they need is to have to guess how we will decide to trade in the next 12 weeks. It just breaks their models. And what'll happen is they'll take their money and they'll go home, or they'll cut their allocation of capital. And so instead of investing with us, they're like, well, I can't, the company's too opaque. It's a black box. It's like, that's just not the right way to build a network. And we could do it. I could generate $1 billion like this, but we're not playing for $1 billion, Matt. We're playing for $1 trillion. We want to create $1 trillion company and $1 trillion asset class. And that requires that we think very long-term strategically, and we can't do it alone. We need people with more money than us to trust us.
That's super clarifying. Thanks, Michael.
Thank you, Matt. Next, we have Ramsey El-Assal from Cantor. Ramsey, go ahead, please.
Thanks for taking my question this evening. I think it was Andrew that mentioned in the prepared remarks plans to either equitize, repay, or refinance the existing convertible debt. Can you all collectively help us think through the scenarios where you would opt to or be compelled to deploy these different approaches, and also comment on the general timing of your actions when it comes to addressing the upcoming convertible debt maturities? Thank you.
I can start. I would say, Ramsey, the simple answer is that we have all of those options available to us, right? And so In terms of monitoring the market, being able to understand what the right action is at the right time, I think all of the options are open. In terms of timing, I don't think there's any prescribed rush right now. I think we're continuing to be very disciplined in how we think about it. I think the activity in Q2 showed that we're able to go out and repurchase the debt, and there is an active convert market that's very active right now. But really, it's just about waiting and seeing when the right time is. Right now, our priority is to get Stretch back to par, as we've said. And so I think the broader message is simply that liability management options remain open. There is no set timeline. We will be disciplined in how we think about it, and we'll move forward in that manner.
I can give you an example, Ramsey. Our next convertible debt put date is September of next year. It's our 2028 converts with a conversion price of $183. My expectation is that in September of next year, we'll be north of that conversion price. We won't get put, and then a year later, we'll equitize it because we'll be north of $183. Let's say a year from now, we're not north of $183, we get put, then our options are either to sell MSTR at a premium to pay it down, our options are to sell Bitcoin to pay it down, or we could just refinance it, right? The terms of convertible notes right now, we get asked every single week by a bank, are we willing to do a 0 up $44 billion 8-year convert? The terms are actually better now than they were when we entered into most of these converts in the last 5 years. So there's a lot of options, and that's the next one that comes up, and that's how we would think about it.
Thanks.
Thank you, Ramsey. Next, we have Samson Mo.
Okay. Hi, thanks guys for having me on. It's great to be here with this lovely big Bitcoin group of heavyweight intellectuals. So I have a compound question. I hope you don't mind. It's a bit of a follow-on to Matt's question. So I understand you want to keep things simple. You don't want to be trading against the guy with the Bloomberg terminal and 500 million. But do you think there is any benefit in this sort of new shift to an active capital management strategy to do things like sell covered calls? Because there is now a price point at which, Fong, you said, is advantageous to sell Bitcoin. So you could deploy some capital in those markets just to optimize your acquisition, or possibly create like a side pocket for selling cash secured puts to buy Bitcoin cheaper at times too. Do you view that as conflicting with the current strategy of keeping it simple, or is there room for optimization in there for the Bitcoin accumulation? Because it's a hard market, especially when Bitcoin is roaring.
I'll give you a quick answer on that, Samson, which is just right now, that's not part of the plan. We just think it would generate counterparty risk, complications, change the convexity of the equity, change the tax characteristics of the company, change the tax characteristics, or it might create a tax complication for the credit. And our view is the single most lucrative thing we can do with a stack of Bitcoin is sell credit against it, not sell volatility against it. So anybody with $1 billion of Bitcoin can sell $100 million or $500 million of coverage of covered calls and the like. Anybody can do that. A private citizen could do it. There's only 2 companies in the world right now that have shown that they can actually sell digital credit against Bitcoin, us and Strive. And there's only 1 company in the world that can sell credit at our scale, and that's us. And I don't know why we couldn't sell. We were selling $2 billion a month of it. We could sell $1 billion a month of it. So our focus is get the digital credit reactor up and running, and don't do anything to confuse the matter, and don't do anything to create opacity. And again, they're all options. Like in the future, if I had to do it, right? If I had to do it for some reason, I would do it. But right now, we think the best business in the world is selling STRC, and the most useful thing we can do, that the path to become a $1 trillion company, that the path to become the world's most valuable company is not selling call options on Bitcoin. The path to becoming the world's most valuable company is creating the credit money on top of Bitcoin. And everything we do that is complication to the credit that makes it confusing. It's like, that undermines the credit worthiness of STRC and it distracts the management team. So it's not on the table right now, and we're just going to focus on returning Stretch to health. Did you have a second part to your question?
Yeah, sort of related to Stretch. So just a disclaimer, I'm a big believer. I think Stretch is a brilliant product. We try to do the same structuring instruments for nation states like Stretch. But there is marketing around Stretch saying, we make Bitcoin money. And in the Bitcoin space, there are people that are kind of wondering, what is your view? Is Bitcoin an asset? Is it digital property? Is it digital Manhattan? Or is it money? And do you feel these instruments like the preferred squeeze out people from discovering real bearer Bitcoin? And I think it'd be cathartic for people to hear what your view is on that.
Yeah, it's a good point. I think the thing to keep in mind is our marketing is to the 99% of the people that don't own Bitcoin, that don't want to buy it. Right. So when when we say when we talk about Bitcoin and what we're going to do with it, we're selling products, credit products, to people that would never ever in a million years buy the Bitcoin. They just won't buy it. Either they won't buy it because it's illegal for them to buy it. They don't buy it because it's against their mandate to buy it. They don't buy it because they don't want to hold it. They don't buy it because they literally can't, that they don't have the ability to punch the button and buy it. So it's either technically impossible or it's just, impossible. So we're creating a product for them. And when we create a product for them, we need to market it in a package that they can buy. I think that the issue with money is the Austrian perspective on money and the JP Morgan perspective on money is a non-sovereign store of value bearer instrument is money. So gold is money, everything else is credit. A famous JP Morgan quote from more than 100 years ago in a congressional hearing. And I've said Bitcoin is money, everything else is credit. If you're an Austrian economist and if you're a Bitcoiner, then you would understand that resonates with you, and you would be 1% of the money in the world, or 1% of the opinion. The rest of the world doesn't agree with us, right? The 99% of the world, they think that money is a zero vol pegged to a fiat currency. It's a money market, or it's actually a stack of dollars. They think of money as the most saleable good, as a medium exchange unit account, store of value, but in the fiat frame of reference. And it's not hard to point toward that. There's $30 trillion in money markets, and it's literally a regulated term. Like, for example, it's illegal to market your thing as a money market, right? Because it's a regulated banking term. And so the rest of the world has defined money as an asset pegged to a fiat currency in yen, euros, dollars, francs, pounds. That's how the rest of the world is. Okay, so when you're creating marketing, there's no point in marketing to people that are 100% invested in Bitcoin that they should buy Bitcoin, because they don't have any additional money to buy Bitcoin with, number one. And number two, they don't need to hear that, right? Like, no one that's 100% invested in Bitcoin needs to hear from me that they should buy Bitcoin. They would say, I already did that. So when we're marketing to the people that wanted to buy equity, or wanted to buy credit, or wanted to be invested in something different. So to the conventional institutional investor, we would position Bitcoin as digital capital, because it's capital asset and it competes with real estate and equity portfolios and credit portfolios. other liquid instruments like that. So they think of it as a capital asset. And then they would recognize STRC as a credit instrument. And there'll be a little bit of, some people think, well, it's preferred, that's not credit. Well, the truth is it is credit. It's just not a bond. And so they would view a preferred equity as a credit instrument, and we would deliver that. Now, in the fiat frame of reference, gold is capital. A gold-backed bond would be credit. And a instrument that was pegged to the US dollar, right, a note would be currency or would be money in a fiat frame of reference. And that's the world for the last 100 years, and that's just the way it operates. So when we think about how you grow the business, if you're going to grow Bitcoin from $1 trillion to $100 trillion, you can't just convince all the people that have invested everything in Bitcoin that they should keep investing in Bitcoin, because you're going to get a trickle of cash flows. You're going to have to go find $99 trillion of other money or monetary value. And sort of by definition, it's somewhere else. It's invested in real estate, it's invested in bonds, it's invested in the equity capital markets. And that's like a $1,000 trillion stack of capital, and we're 1 trillion. That makes us 10 basis points, like we're 0.1%. So when you go get that money, you're either going to create a Bitcoin-backed credit instrument like STRC, or you're going to create a Bitcoin-backed equity instrument like MSTR, or you're going to create a wrapped Bitcoin-backed fund like IBIT. And all of those are channeling capital into the Bitcoin ecosystem that they could not contractually, maybe they could not legally, they could not technically, they could not ethically, they would not economically buy the underlying crypto asset. They just wouldn't. And the irony is always seeing people that are Bitcoin maximalists that get angry that we're actually that BlackRock is selling wrapped Bitcoin to sovereign wealth funds, or that we're selling amplified Bitcoin to an equity investor, or we're selling digital credit, credit instruments backed by Bitcoin to a credit investor. But I guarantee you, there's no one that buys those instruments that sold Bitcoin to buy the instruments because they didn't want to. It's like all the demand is coming from people that they say, I have a pool of money and I can't put it in the 40 vol crypto asset. And so their choice is put it in a money market or put it in a diversified credit fund. So we see the expansion as digital credit will allow us to tap into the multi-$100 trillion credit market. And then if you can take that credit and create an instrument pegged to a fiat currency, if you can peg it to the yen or the Swiss franc or the euro or the pound or the dollar, and you can offer a spread higher than the risk-free rate, the conventional rate, then you will start to divert capital from the money market instruments. And we talk about digital money. What is digital money? Digital money is a Swiss franc that pays you 4% in a world where the fiat money is a Swiss franc that pays you 0 or negative, right? And we can debate semantics in the crypto community, but it's kind of irrelevant because all the money is not in the crypto community. The money is in the fiat community. So if there's $1 trillion invested in Swiss francs that yield 0, and you want $100 billion of it, you have to offer them a Swiss franc that yields 4%, backed by a digital credit instrument backed by Bitcoin. So, when we use the phrase digital money, we're creating a product to sell to the people that have the hundreds of trillions of dollars of fiat-backed securities or money instruments or credit instruments, because that's what they understand. and we use the word digital credit. We're creating a product to sell to people that have credit that is fiat based, that they understand. And what is Bitcoin? Well, yeah, it is money. It's digital gold. As much as gold was metallic money, Bitcoin is crypto money or digital money. But it's also digital property. It's also digital capital. It's also digital energy. It's also, trust, digital trust. If you want to establish or authenticate digitally, how do you prove your identity without a trusted third party? It's one thing to transfer money without a trusted third party. It's another thing to prove that you're Satoshi without a trusted third party. The answer with both of those is using a public-private key combination. I mean, that's Nostr approach this, and I think public-private key cryptography is a critical thing. But even with public-private key cryptography, the ability to anchor it into the most energetic, most secure global blockchain is important. So I think that Bitcoin is important to understand as a trust network, a monetary network, a capital network, an information network, right? And what is the highest best use? I think the market has clearly spoken that the highest best use is as for store of value or as a capital network. We have proven without a shadow of doubt that Bitcoin functions if you want to store your monetary energy for 4 years or longer. And the way we've shown it is we're moving $50 million a day. You're selling $1 billion a week of something, right? So clearly that's a killer app, but there are other applications, right? Medium exchange applications and authentication applications and the like. They're not nearly as valuable right now, and it'll be whatever it'll be. But our view is we'd like Bitcoin to become 100 times bigger than it is, and that means we need 100 times more money. And it's other people that have the money. And right now they're invested in fiat denominated credit, equity, and monetary instruments. And we need to create products that appeal to them, and we need to market them with words that they understand. And the most important thing is get the money.
Awesome. I think people will be happy hearing us talking about Bitcoin as money for 10 minutes. Thanks.
Thank you, Samson. Next, we have Nick Cremo from Barclays.
Thanks, CJ. And hi, team. Thanks for having me on this call and taking my questions. The first, I just wanted to ask on STRC. It's good to see the dividend coverage is over 2 years now, well ahead of the 12-month minimum and the USD reserve from your digital credit capital framework. Just wanted to ask if you would consider raising the minimum number of months of coverage to say maybe 18 or 24 months, just as a mechanism to get STRC closer to par if later this year it's kind of still trading in this high 80s range.
I think we'd consider it, Nick. I think the best thing to get it to trade to par is our commitment to a US dollar reserve and increasing the actual number, not necessarily increasing the minimum. I think the other thing we can do to get traded back to par is a steady repurchase program, which you've seen. And another thing is just Bitcoin price going up. I think those are some of the levers. Would we increase the minimum US dollar reserve? Maybe at some point, but I think a year is a good spot. Really, how much we have in the US dollar reserve, I think, matters even more, and our commitment only to use it for dividends and interest.
Thank you, Nick.
Got it.
Thanks, Nick. Next, we have Lynn Alden.
Thank you for having me. My question is, do you have current guidance on kind of a target level of overall amplification or leverage for the company as part of the capital structure? And kind of a related question is the counter cyclicality or pro cyclicality of capital issuance. And so, for example, when STRC has a lot of demand, which tend to happen along with the other instruments during bull markets, there's a choice when it starts to go above par, either to issue more STRC or to potentially ratchet down the dividend. So far, the choice has been made to issue more, accumulate more Bitcoin. Historically, at these kind of pro-cyclical prices when they happen, as most treasury companies do. Going forward, do you have kind of just overall guidance of what you think that kind of the ideal amplification structure is, or like level is? And then do you plan on trying to find ways to, now that you have a kind of a multiple different levers to pull, to be somewhat more counter-cyclical in your approach, or take a view on whether Bitcoin is maybe oversold or overbought and therefore leaning in or leaning out of? Or is that not really how you view what you're offering to investors? Thank you.
I guess I can start, and then Fong, you probably have some comments. You notice on our website we added those Bitcoin metrics, and one of the metrics we added is the 200-week moving average, and then we added the premium to the 200-week moving average, and we started tracking it, and we started tracking the percentage of the time Bitcoin is above that number. And so I think traditionally we've always wanted to be long Bitcoin, but I think we underestimated the value of US dollars. And now I think we've developed an appreciation for actively managing the mixture between USD and BTC. And obviously we have more US dollars today than we've ever had in the history of the company. And we saw that when we went 98% or 99% BTC, 1% USD, the Bitcoin investors didn't like it, the equity investors didn't like it, the credit investors didn't like it. So it actually was counterproductive to be too BTC focused. So I think you could expect that, we're going to be staring at metrics like the premium to the 200-week moving average. And I think that although in the past we've had 100% allocation to BTC, I don't think it'll be 100% in the future. I think it'll be a mix. And to your point, if you're sitting at 100% premium to the 200-week moving average, then the likelihood that Bitcoin's going to trade the opposite way goes up, right? And so I think that when we're sitting at premiums, we probably will, be counter-cyclical and err more toward dollars. And we're sitting at discounts, or we're sitting, at very small premiums, we would be more bullish on BTC. And the reason that we publish that on our website is we wanted people to see the metric that we're staring at. So so that's a long-winded answer to your question, which is sort of, we are going to actively manage it. And one aspect is, what is the credit coverage, and the other aspect is, what is the mix between USD and BTC? Do we have 10% of our reserves in USD, irregardless of credit obligation? And do we have 36 months or 24 months of dividends, right? So they're both interesting factors to be managed. I'm of the opinion with the credit, if you want strong credit, like creating chromium steel or stainless steel, you want 20% to 30% chromium and iron and just a smudge of carbon. But is it 20% or is it 30%? That's the question of, do you have 24 months or 36 months of dividends? So we want to actively manage to create the strongest possible credit, and we're trying to figure out exactly what that alloy is. But the other piece is, irregardless, is the company better if we're sitting on 55 billion of Bitcoin and 5 billion in cash? And if we had 100 billion of Bitcoin, do we want to be sitting on $10 billion of cash, even without thinking about the credit? I think the answer to the question of how much cash is probably going to be driven by market sentiment and the market premium. And I don't want to simplify it down to it's as simple as just looking at the premium to the 200-week moving average, because a lot of people will come up with a few other metrics. You may have a number of your own metrics, right? And there's debate in the community about what's the best way to calculate whether Bitcoin is at the top of a cycle or at the, at the bottom of a cycle. But I think we're going to start to look at those signals, and that will drive the allocation of cash flow. If we sell $1 billion of credit, I don't think you'll see 100% BTC, 0 USD as the norm. I think it'll be a ratio, and and what the ratio is, well, it'll be a function of the equity capital markets, the Bitcoin markets, the credit markets, and what are people telling us? If the credit investors, still want more cash, then we'll probably lean toward dollars because the credit markets want it, regardless of where BTC is. But if the credit is strong and there's no issue there and it's stable, then it will be a function of where is Bitcoin in the cycle and what are the forward yield curves or the forward vol curves look like, and that will vary. Fong, do you have anything to add on the subject or any thoughts?
Yeah, I think we're at the 1-year birthday of Stretch, which is a brand new asset class, digital credit. At about 9 months, we learned the hard way that we shouldn't let our left-brained Bitcoin bulls say that everything we can issue, we just pour into Bitcoin. And I think we've learned that holding US dollars makes a lot more sense. We also have learned a lot more about our investor base, the retail versus institutional base, the leverage they take on, what is important to them. And so we've talked to a lot of them to figure this out. I think reducing the rate when we see, a strong Bitcoin price, a strong, premium to the 200-week moving average makes sense, right? So I think that's something we consider doing too. So yes, I think we agree with all your points, Lynn, that we need to look at the cyclicality, we need to look at the demand, we need to look at the price, the interest rate, how much US dollars we hold. We'll be a lot more thoughtful and methodical this time around about growing the digital credit base. I'm excited to see Stretch get back to par so we can exercise all that we have learned.
Great, I appreciate the guidance.
It's worth noting, that with credit, we've noted that the market would probably rather pay us a lower dividend rate with more currency backing it than a higher dividend rate with more Bitcoin backing it. And so there's this circularity there, which is you don't want to carry dollars because they underperform BTC, but you do want to carry dollars because otherwise you have to overpay to issue the credit. And so to find the sweet spot of, how do you create strong credit that has a dividend that's somewhat better than junk bonds, that's compelling enough to have a high demand, but is lower? Like we could see people don't want the thing paying 14% if they don't feel secure, right? But on the other hand, a lot of our credit investors told us, I'd be happy to be paying you 9% if I just didn't have any anxiety. So, finding our way to the right balance is all about, all consistent with a dynamic equilibrium, because if you find the right credit point, then that lowers the cost of capital, that lowers the hurdle rate, which is better for the equity. So the equity benefits if we issue the most efficient credit, and the credit benefits. And we know for sure that it's this balance of dollars and BTC. And we know that we have been underweighted dollars before. Now we're in this discovery, and we're talking to our investors every week, right? Like every day we're talking to them, but every week there's a new announcement. And so every single time we make an adjustment in the capital structure, we watch to see how the credit settles. Then we go and we talk to our investors to see how they feel about it. And of course, we have other moving parts, like the Bitcoin price is a massive moving part of it. If it falls $20,000 or rises 30%, but also SOFR and, the federal, the monetary policy of the Fed is a second moving part. And then the private credit markets and the equity capital markets. So I think it's a moving target, but what we've learned over the past 12 weeks is we need to actively manage those ratios, and we need to be humble, and maybe, and this is a hard thing for a lot of people to understand, maybe the best way to buy the most Bitcoin is not to buy the most Bitcoin. like if it was an 80-20 split or a 90-10 split, we'll actually get more Bitcoin over the long term because it's all about sustainable growth. And of course, it's very difficult to explain this on X because people want you, they don't like nuance of I'm going to sell 1 and buy 10. They want to hear that you're going to sell none and buy 11 and do it with money you conjured from a genie, under the desk. And we don't quite have that.
Thank you, Lynn. Next, we have Lance Vitanza from TD Cowen.
Thanks. That's a great segue to my question. Over the years, investors have come to associate strategy with a number of principles that at one point seemed absolute, but later proved more flexible in practice. Bitcoin monetization, obviously one example. Today, management has been clear that it does not intend to issue stretch below par. My question is, under what circumstances would you reconsider that position? More broadly, how should investors distinguish between principles that are foundational to the model and those that are contingent on market conditions?
I think we learned that the market they don't want volatility in their credit. They want lots of liquidity, low volatility, short duration, stability. They want to buy it around par. They want to sell it around par. They want to collect the dividend. That's what they want. And that's what they expect us to give them. And if we do that, then they make a decision in 10 seconds. I'm just going to buy $1 million or I'm going to sell $1 million. If we allow it to flex plus or minus $1, that order becomes a 3-day process. Like I placed a limit order. We've allowed it to flex 40 cents in the past. People put in limit orders and they they put in the order on Wednesday and they're waiting on Friday and the order isn't filled. And what would have been a 5-second decision became a 3-day decision. But if you let it flex plus or minus $5, we have an example like STRF. STRF is objectively a better credit instrument. Like it's 12x over collateralized. It's got super dividend stoppers and it's got non-payment penalties. And if you're a credit investor, in theory, it's 10x better. And yet it trades with 1/20th or 1/30th the liquidity. And I scratch my head. I'm like, why is it nobody wants this thing? And so whenever people say, why don't you just let STRC float up $2 or float down $2? I think, well, because I've already got that. It's called STRF or STRD, and it's got 1/30th or 1/50th of liquidity. And so the answer to the question is, we're never gonna, if it trades, if you offered me $10 billion to sell you the instrument at $99.99 and take 1 penny off, I wouldn't give you the penny, Lance. I would not knock off a penny if you put $10 billion in front of my face, because it's a matter of principle and credibility. If we can't create it such that it trades at par and we can't sell it at par, we're not going to sell it at all. Our backup is we just do nothing. The Hippocratic Oath, do no harm, right? And if we can't, like, we're not going to sell Stride, we're not selling Strike, we're not selling Strife, we're not selling Stream, and we're not selling Stretch right now, and that's okay. At some point, Stretch will return to par. And the only question is, how much money or time will we have to exert to get it to par? But I guess I would say it's not worth doing if we can't do it right. It's like come back to kerosene. It's like the reason Standard Oil was successful was because it was standard and it didn't blow up in the engine and it didn't burn you to death. It didn't start a fire. It used to be that people created oils and they were impure. Like if you ever put bad diesel or bad oil in your fuel tank of a boat or a plane, like it like destroys the engine. So the impurities render the product useless. So here's my analogy to you, which is if it's a little bit bad, I can either say, okay, well, here's some kerosene. You should test it in your own factory or in your own chem lab before you put it in the engine because it might blow up. And I put the disclaimer on it. Or I could just not sell it to you. And my point really is if you can't create this stuff so it's pure, like it's got to be pure and it's got to be what the market wants, or just sell nothing at all. And if we can't create pure short duration credit at par, we'd rather just sell nothing at all until we get it right. Because the demand is, in my opinion, it's 100x more for short duration credit, 100x more, and maybe the ultimate market is 100x bigger. And so it's like we're just playing to win here. And it would be very easy to, it's like, oh, I could let it float between, I could sell it at 98 or 97 some days or 99. What would happen would be the market would shrink by a factor of 100. And you would basically turn people from, it's like, what if your bank took a 1% commission every time you deposited money? Or they didn't, and it was random and it came and it went and you weren't quite sure. Or what if the trading fee, it changed from 5 basis points to 5% randomly from week to week? You know, it's like I put my hand on the light switch and sometimes I get a shock and sometimes I don't get a shock. And it's like, you don't want to touch the switch. And so that's how we feel about this thing. It's like, you would be so angry at me, you know, if it's like you bought it at 100, you sold it at 100, but you could have sold it at 105, or you bought it at 100, but then you could have bought it at 98. It's like that kind of thing. It just destroys the product. And we've inadvertently tripped over what we think is the magic product, the greatest product in the world. The marketplace wants us to strip the volatility off it. They want it to trade at par. They want it to be liquid. That's our job. If we punt, if we abrogate on our responsibility, it's just like someone shipping you beer and saying, well, here's a 6-pack. One of them is spoiled, but the other 5 are good. Just check before you drink. It's not acceptable, right? It's a failure, right? To create it. We're creating a failed, flawed product, and we're lowering our standards and telling ourselves it's okay. It's not okay. It needs to trade at par. We won't sell it below par. Right? If we have to spend an extra $1 billion to get it to par, it's an extra $1 billion. If it took an extra $2 billion, an extra $2 billion. If it took an extra $4 billion, spend $4 billion. It's like, how much is it worth spending to make the airplane that flies across the Atlantic without crashing on the way? It's like, just make the thing work, right? And that's what we've discovered. We've got a thing, everybody wants it, we need to make it work. I can't guarantee you exactly how many dollars it takes for me to get it to work or how many days it takes me to get it to work. But what I can say is that it is so clear in our mind that this is what the market wants and this is what we can create. And this is the thing that will make the company worth hundreds of billions and then trillions of dollars, that there's nothing else worth considering. Everything else is a distraction, a waste of time. We just need this thing to work as designed.
Thank you, Lance. Last but not the least, James Van Straten. Please go ahead.
Thank you for having me on, guys. I love seeing the 200-week moving average on the dashboard, and it'd be great to see also like on-chain metrics that are complementary, like the realized price and true market mean. I think it gives a much greater indicator of support levels. But I've got kind of a two-pronged question. So like looking back over the cycle, this is your guys' second cycle. what assumption about like the capital markets proved you guys wrong or least certain that you expected? And then as capital markets start to move on chain, do you think this can create new opportunities for strategy, whether through tokenized securities, which would obviously reach a broader global investor base, or even issue a strategy stablecoin in the future? Is this something that you guys think about?
Hey, Fong, do you want to start?
Yeah, I can cover the first one. Maybe Mike, you'll cover the second one. In our first bear cycle in 2022, some might recall, we had secured debt that had covenants on it that were quite restrictive to the company. And we had a Bitcoin-backed loan that had a margin requirement on it. And our biggest lesson learned from 2022 was don't do either of those. And so here we sit in 2026 and we're fully convertible notes and preferred. And so that was a big lesson from 2022. And I think we upgraded our capital structure as a result. The biggest lesson so far from 2026 is the importance of holding liquid US dollars to fund our dividend and to overfund our dividend so people have confidence in the preferred dividends. And I think we thought that liquid Bitcoin would be important, but what Mike mentioned earlier is the people who are holding these prefers don't look at Bitcoin the way they look at US dollars. So that was a major lesson learned. And we did a lot of things in May, June that, you know, I think looking back at that, we can execute things better. So we learned a lot. And so the next bear market 4 years from now, wherever it is, we'll learn from that too.
Yeah, and I would add, I think, yeah, in the capital markets, sometimes the equity capital markets correlate with Bitcoin and they trade in lockstep, but sometimes the correlation is broken. With the AI bubble forming, equity capital markets diverged from the digital capital market. And so they will converge and diverge, and generally things that are good for risk assets are good for all of us, but sometimes they'll get a boost from the demand for AI, and then sometimes we'll get a boost as a very pro Bitcoin dynamics evolve. So I think as a company, we've realized that we're straddling the equity markets. When the equity capital markets are rallying, that's generally good for our equity, but it's not necessarily good for our capital asset BTC. And so we're also straddling the credit markets. And sometimes there are things that are credit positive or credit negative, the way the yield curve moves and so forth. And then sentiment in private credit or other sorts of corporate credit, they have their own dynamic. And then there's the digital capital markets, and that's Bitcoin, and it has its own dynamic and drivers. And what we need to do is just be in a position to exploit and arbitrage the various opportunities. And when one market is mispriced, you know, we're buying the cheap one, selling the well-valued one. And then occasionally we just have to put the engine in reverse and go the opposite direction. And I think that 2-3 years ago, we had a much simpler business model. And now we realize sometimes you sell credit, sometimes you buy credit, sometimes you sell capital, sometimes you buy capital, sometimes you sell equity, sometimes you buy equity. And the more nimble you are with regard to that, then the more shareholder value you can create. With regard to the issue of tokenization, I think the killer security to tokenize is digital credit. If you look at what's going on right now, people have been tokenizing money market funds, and they're yielding 3.5%. And they put them in a looping protocols, and everybody wants yield, and yield drives the entire DeFi economy. But if you can plug a 10% yielding instrument into a tokenized asset instead of a 3% yielding instrument, there's so much more energy that you can do a lot more with it. So ultimately, I think that the real interesting killer application is going to be looping digital credit, either stepping it up 2x, 3x, 4x, or stepping it down, stripping the vol. And if you tokenize STRC and then you step it down and transform it, Yeah, there's a market for 4% yielding yen, as a yield coin, or 5% yielding euros, or 4% yielding Swiss franc, or 6% yielding dollars. And the way you're going to get to that is you can't create that with money markets. You can't take a 1% yielding yen money market and step it up to 3% with any kind of economic responsibility or rationale. It's crazy. But you can take a 10% yielding or 12% yielding digital credit instrument, and you can transform it into any currency, stabilize it, step it down, provide liquidity, give it daily liquidity or hourly liquidity, and you can stream a yield and strip the vol off it. So I actually think that the more tokenized securities we see and the more money flows into that, the better that's going to be for digital credit. And I think that, what does the world want? The world wants probably the world wants $1 trillion worth of stable coin that pays 6%. And what the world has right now is $250 billion of stable coin that yields nothing. Right? And then they jump through hoops trying to make the stable coin that yields nothing yield something. But and so how are you going to actually create $1 trillion of stable tokens that yield something that's more than SOFR? You're going to do it with digital credit. So I think that that's really the killer thing. With regard to all the other tokenized securities, the killer idea of tokenization is creating a free market in custody and credit. Like, if I have $1 million of Apple stock, can I actually transfer it to a custodian that will pay me 4% yield on it? Because right now I don't get yield on it. And if I have $1 million of Apple stock and my bank will give me a 40% advance ratio and charge me 8%, will someone give me an 80% advance ratio and charge me 4%? So in theory, you could see those markets form. In practice, I don't see them happening in the US right now. And there's still a lot of obscurity. There's a lack of clarity about what kind of tokenized use cases will be allowed for securities. But one thing is clear. Stable coins are going to be crippled in their ability to generate yield. So the path to generating yield and fixed income is going to be through tokenized securities, not through tokenized currency or the like. And I think we're really well positioned for that. And I think ultimately it's the one thing that they're really good at in DeFi is they're really good at looping something 2x, 3x, 4x, or they're good at tranching risk and stripping it down to zero vol. So that's financial engineering tokenized. And the one thing you want to engineer is, if I give you a 10 vol, 10% dividend yielding asset in dollars, then in DeFi, in theory, you can create any currency, any monetary instrument pegged to any currency, and you can step it up and step it down with transparency. And so I really see as something like STRC is like the universal fuel source for the digital asset economy. And that's really an opportunity for us should that economy become material. To be clear right now, it's only 1.1% of the money is in DeFi. So 99.9% of the money is TradFi. And so we don't need it. And it won't. And the truth is 100x more money is solving this problem in the credit markets and the equity capital markets. But I do think that DeFi and digital assets and tokenization is interesting because the people involved are more progressive, more innovative. They move much faster. They're much more creative. They'll take risk. They're not so crippled with tradition and custom and incumbency that they fear to do something which is an obvious thing to do. And so all of the really cool, innovative products will probably come out of the digital asset space first. And then it becomes a regulatory struggle and a political struggle to see whether you can get approval to sell a compliant version of that thing in the capital market where you're operating. And you know, we don't have any time to go into that. That's a podcast in and of itself. But that's what I think.
Thank you. And just sorry, I have a quick question as well. On the 26th of June, when Stretch traded down to $70, is there any insight you had on that? Is that forced liquidations from the DeFi, or was it something else?
Tell me, I didn't hear the first part of your question because you cut out on the 26th of June when what?
On
happened?
26th of June, when Stretch traded down to, I think, $70, is there any insight you can give on that day? Was it forced liquidations or, yeah?
You know, what I think happened is that there are a number of broker dealers, unnamed, and we can't even identify them all, that were actually creating credit, 3x or 4x credit against STRC under very favorable terms. So they were giving very high, like a 70% advance ratio or an 80% advance ratio against STRC based upon its previous trading dynamic. And then when it traded down and the vol spiked, I think that those entities they dial back their credit lines from an 80% advance ratio to a 20% advance ratio, or they pull those credit lines and they created, in essence, the equivalent of a margin call or a liquidation event. But see, to call it a margin call would be misleading. It's not like someone got over levered and margin called. It was a second order thing. The credit lines creating the leverage got withdrawn. And one of the lessons we learned is it's important for us to offer the instrument in such a stable way so that the second order and third order credit lines backing the investor that took on the trade don't get pulled away from the investor, right? And that was kind of it was an unexpected thing that we learned. So it wasn't DeFi, by the way. The simplistic notion would be, oh yeah, some retail guys overborrowed or some DeFi degenerates like took on too much leverage. That's not what happened. Some TradFi organization said, well, we'll give an 80% advance ratio when it's trading with a vol of less than 10. And then when the vol spiked to 20, they changed the advance ratio and it created this second order and third order rippling effect where you then had someone sell or liquidate, and that created a downdraft in the price, which created another liquidation. And so it was a second order, third order reflexive contraction in credit in this system, we believe, that caused it to trade into the 70s. And that created, when it got into the 70s, that created anxiety for first order investors that then reacted to it. So it's kind of like an amplified reflexivity through a lot of different parts of the market, all working at the same time on a novel asset.
Thank you, James.
Thank you.
I'll turn the call over to Peng for any closing remarks. That brings an end to our
Thanks to the analyst, both on the Bitcoin side and the banking side, for joining us. Thank you, everyone, for joining us for our earnings call, and looking forward to seeing you all again in 3 months.
I think commitments to not sell Bitcoin is absolutely not valuable. It has negative value. You have this option, now you've, by your own actions, decided, okay, I no longer have this option. You're kind of cutting off some of your own moves, cutting off your own resources.
Welcome to the Bitcoin for Corporations show. I'm your host, Pierre Rochard, and today we're joined by Allard Peng, research analyst at Bitcoin for Corporations. Welcome to the show, Allard. Good to have you back on. All right, so you put out a research report recently. We want to get into that and kind of get your observations on what is currently going on in the capital markets and kind of the macro environment in which we find ourselves, and of course, Bitcoin's price action. So, yeah, you want to kick it off by kind of diving into the research report you put out and kind of what your motivation was for putting that together and what your findings were.
Yeah, sure. So the report went out like end of June. It's called Quant Framework for Digital Credit Risk. The main thing I was trying to do was kind of educate the space on how to think about digital credit risk from a quantitative perspective. I think there's a lot of frameworks out there for looking at these assets, and they're obviously a very new asset class as well. So just being able to like quantify that risk using objective metrics, I think, is an important contribution to the discourse. So just to kind of get into it, like the main thing I'm starting off from is the concept of BTC rating, right? So this is something that I think has been introduced for should be about a year now, since like Strike came around and Strife, and then Strategy came out with the BTC rating and a bunch of other frameworks, right? They have their credit dashboard that kind of goes from BTC rating into BTC risk and BTC credit. So starting off from that, and I think the unique approach that I'm taking towards this is I'm saying that like the BTC rating could be thought of as a starting point for measuring the Bitcoin risk. And then from there, you can actually use the Bitcoin, or rather specifically for this paper, the Bitcoin ETF option markets to quantify that risk. So this is largely what the paper goes through, the methodology behind doing that, and behind like chopping up the risk premium that these digital credit instruments pay you into the different risks that you're exposed to. So like that would be what you're compensated for, right? Like the type of risk that you're compensated for, and that becomes your return. So that's kind of what the paper does. And yeah, it's just meant for, it could be allocators, it could be investors, it could be just anyone who's interested in digital credit, in Bitcoin-backed credit markets, to just give a quantitative framework for looking at it objectively.
Yeah, it's really interesting. We've seen in the discourse a lot of, among the critics of Bitcoin Treasury companies, suggesting that the equity should trade at a discount because of all the risks associated with that equity position in the common stock. Do you agree, kind of on a not on a day-to-day basis, but from a valuation kind of theoretical perspective, should the common stock be trading at a discount or a premium for a company that's amplified Bitcoin?
Yeah, I think in general, like if we were to look at it from just raw valuation, if it got to a discount, I would say like you have a bit of a margin of safety there. And if it got to a premium, then I would say like this is probably, like I think some premium is more likely to be fair value. That being said, like the way I view the common equity of, I'll just call them pure play Bitcoin Treasury companies that like don't really have a meaningful operating business, but they actively engage with the capital markets to grow Bitcoin per share. Let's call that like the core goal. So I think if you were to look at the common equity of this type of enterprise, you should think of the common equity as a call option on the underlying Bitcoin stack, right? And I think so it's kind of like a Bitcoin call option that is perpetual in its duration. And if we were to think a step further about how one would value such a call option, or how one would think through abstractly what the features of this call option is, well, a call gives you convexity, right, towards the upside, and you actually pay a cost. You might have heard of the term like theta, which is the time decay. But in reality, theta is not exactly time decay. It's actually the cost for gaining convex exposure to the underlying asset. So theta is actually the cost of gamma, Vanna, and Volga. So those are three sets of higher order Greeks. So they're like second order derivatives of the first derivatives. And these are all convex exposures to volatility, to price, and to the volatility and price like cross, the cross derivative of those, that would be Vanna, right? So basically, theta is paid for you to gain exposure to those three higher order Greeks. And in the case of this common equity, your theta is your perpetual preferred stock dividends. That's what's being paid, right? So like the common equity is constantly bleeding in order to pay that theta off to maintain that convex exposure. And so I think that's really the right way to value this. If we were to go from like Graham and Dodd style, like securities analysis from the, the core classics of investment valuation, yeah, like you could probably use a framework like SEEB, common equity Bitcoin exposure, right? You take the Bitcoin stack, you subtract out the notional value of your prefs and your debt and all of the credit instruments, everything that's not common equity, and then you say like, oh wait, this would be the common equities Bitcoin exposure, right? Now, I think that's a fair way to do it. If we were to tie it back to options, that would be kind of like the intrinsic value of that option, right? That would be like if the option was in the money and you're saying like, okay, this is how much is in the money, and everything above it, your quote unquote premium, that would be your extrinsic value of that option. So I think that would be like the framework that I would use. And frankly, for this digital credit report, it kind of lays the foundation for starting to think along those lines. And I will have a part 2 and probably part 3 that kind of elaborates on these like quantitative valuation methods.
So in Bitcoin bull markets, we've seen, for example, Strategy's MNAV expanded, I think, to like 3.5x. So within that framework, is that just reflecting the amount of volatility, the forward expectations on upside convexity, or was that like really a bubble that was overvaluing Strategy?
Yeah, I mean, I think both those things can certainly be true. The way I think I would interpret it in hindsight is probably it was more bubbly than it was the other things that you mentioned. But, like both of those things can absolutely be true, just because in a bull market and in these events where price is ripping to the upside, obviously the price of convexity goes higher, right? And obviously the implied volatility of these of all underlying instruments within this stack, right? If we're claiming that the common equity is a call option on the underlying Bitcoin, then there is necessarily an implied volatility attached to that asset base. And the common equity's premium to its net asset value reflects that implied volatility. So the market has a view on that implied volatility and the convexity that the common equity can give you, and it can place a pretty high bid under that, right? And I think I would say, like, speaking along this line is like, this will not be within my decision making anyway, but like for a treasury company to take advantage of these situations, like when their management team views that the securities that they have are let's say priced above fair value, then they absolutely should issue into the market, and that would be an accretive transaction.
And wouldn't that reflect kind of the supply and demand for amplified returns on Bitcoin, that these vehicles will grow their balance sheets when there's a lot of demand? Do you think that the balance sheets will shrink in bear markets, or is it really just about paying the dividends, as we saw most recently Strategy sold? fairly small percentage of their stack, just to prove out kind of their business model. Is that do you think that's going to continue, or is that kind of a one-off just to prove that they can?
Yeah, I think in the future, like, this is absolutely something that we could see more of, just because if you're looking at it from the perspective of I want to maximize the value generated to the common shareholder, right? Then the name of the game is to sell stuff that is overvalued or relatively overvalued, and then buy stuff that is undervalued or relatively undervalued. That's it. Like, if you can consistently do that, everything else will kind of like work itself out, and then value will accrue to the common stock. Okay, like that's it. Now, obviously, all of this is somewhat contingent. All of this is contingent on Bitcoin like actually outperforming, right? Like, it's all contingent on that. Everything's downstream from that. But assuming that is the long-term case, then yeah, everything else from then on really is just about selling stuff when it is relatively overvalued and buying it when it is relatively undervalued. So from the perspective of Bitcoin versus the common stock versus all the other preferred stocks versus the cash reserve, amongst that set of assets, amongst that like Rolodex of assets, there's always going to be something that's relatively overvalued, and then there's always going to be something else that's relatively undervalued. As long as you can make the trades properly, then the value will eventually accrue towards the common equity.
And to that point, I think that as strategy kind of discovered this menu of options over time, because they didn't start with all the options on the table, even though obviously in theory they were there. They were kind of going through the idea maze, and now that I think that they have made clear that they can buy or sell any of these different assets or equity instruments, it seems to have caused like a perception that they are not holding to promises that they would have made in the past, right? Of, say, not selling your Bitcoin. But obviously it seems rational for them to say that all options are on the table. And that's kind of how maybe you keep the short sellers away. It's how you keep demand for the preferreds coming in, that you have that full optionality. Is that the same way you see it? Or do you think that commitments to, for example, not sell Bitcoin are valuable?
Yeah, I mean, I would say I would actually take the opposite stance of what you said last. Like, I think commitments to not sell Bitcoin is actually not valuable. It has negative value because it is a short option, right? Like, you are now short an option, and now, like, if you had this option, now you've like by your own actions decided, okay, I no longer have this option. Like, you're kind of cutting off some of your own limbs, right? Cutting off your own resources. So that's how I see it. Like, I think ultimately it just comes down to what is in the best interest of the common stock, right? Like, that is what every company exists to do, is to accrue value to the common shareholder. And yeah, like that's the bottom line. So it doesn't matter about anything else really. I mean, obviously we'd like to see more companies buying more Bitcoin, and we'd like to see we'd probably rather not see more companies selling Bitcoin. But at the end of the day, like, the companies, like, they're beholden to their shareholders and beholden to value creation, not beholden to, some random idea saying like, oh, we cannot sell ever. Like, that's just not good and not how you do business.
And if we look outside of kind of the Bitcoin Treasury space and we look at other companies, it's pretty common for them to be buying and selling assets depending on what the valuations are of those assets, whether they're doing stock buybacks or issuing more stock, and doing M&A and spin-offs, etc. So this is kind of the new phase of active capital management that we're entering into. Do you think that another possibility for, let's call it, ideological flexibility would be on the question of using derivatives? We have not so far seen SAYLOR or Strategy implement derivative strategies like we might have seen with Metaplanet, for example. Do you think that's going to enter into their menu, or is that would that create too much noise for them?
Yeah, I mean, I think right now the company has a lot of like an identity crisis of sorts. Like, maybe it's not that way to management. Like, maybe they have an idea of what they want to do. But I think in public perception, there is that identity crisis. I think anything can really be on the table. To the point about derivatives, right? Like, obviously, SAYLOR has made it clear, like, he probably wouldn't want to put more structures on top of it that, potentially generate like income on the Bitcoin via derivative strategies or staking or whatnot, right? And that's very reasonable. He doesn't want to make the investment case more complicated. But that being said, like, here's one easy example for where derivatives could be a value add, right? Imagine if they have, so obviously they have a bunch of prefs, right? But imagine if they set aside some Bitcoin, they hedged that Bitcoin that was set aside for the prefs. I think that would probably like instill more confidence in the backing behind the prefs. Like, if they set aside, so right now there's about $10 billion notional of stretch, right? And so they're like, okay, we know there's $10 billion notional for stretch. We're going to set aside $10 billion of Bitcoin, and we're going to hedge that with puts, right? So they pay money for these puts, and if that Bitcoin that is set aside for stretch, again, it's not like encumbered necessarily, but it is set aside, like, at least nominally. Like, the company does say, like, this much Bitcoin has been set aside, and we're going to put a hedge on it to make sure that its USD value doesn't fall below a certain point. Like, would that be positive or negative for the digital credit? I think it would be fairly positive. It probably would be viewed like something akin to a cash reserve. Functionally, it's kind of like a cash reserve if you're saying that, it's not going to go below this point. So the flip side of that is, if you buy a protective put on some Bitcoin, that is logically equivalent to just buying a call option at that same strike, right? It's the same return profile. So if you've justified, okay, we're going to set aside this money for this Bitcoin and protect it with puts, now you've obviously also justified, like, we'll set aside this cash reserve, but then we'll use call options to have Bitcoin upside exposure. And so now you can clearly see, like, simple derivative strategies certainly can make total sense, right? What I probably would not see happening is something where they're like, okay, we're going to do a sophisticated options market making kind of deal and then use our Bitcoin as marginable collateral to open these trades. Like, I don't think we're going to see that. But, again, I think anything could be on the table.
Yeah, that makes sense. You mentioned on kind of the protective put side, they already have these cash reserves for future dividends. That is credit positive for the preferreds, but it's also introducing cash drag for the common. How do you think about that trade-off in terms of maybe their cost of capital on the preferreds versus the drag?
Yeah, so I would say mathematically, and I've written about this like on Twitter and whatnot, but mathematically, they are not going to maintain a N-year constant amount of dividend coverage. It's impossible because, like, just think about this. If you're going to keep issuing more digital credit, and let's say you issue at, let's just keep numbers simple, at a 10% cost of capital, right? So every year you issue this share, and the share is worth $100. Every year you got to pay $10, right? If you wanted to maintain 3 years coverage on that, like, like now you have, that's 30% of your value is 10% times 3 years. Now that's 30%. So every $100 you raised selling this thing, you have to set aside $30, which is kind of like a, you know, it's not exactly this, but it's kind of like a loan origination fee of 30%. So this is like, you know, like there's an extent where this is like, okay, this is unacceptable. I will say, to the point of the discourse around the USD reserve, the true origin of like where this all came from was the S&P credit rating. They did the S&P credit rating like October of 2025, and in the credit rating, the agency specifically said, hey, it would be nice if you guys had a cash reserve. That's where the origin of all of this comes from. Okay? It wasn't like an idea that they just like thought up of. It was something that, you know, was specifically prescribed, and then they decided to act on that prescription, and now they have that reserve. And so the point of this reserve was always to just get your foot into the credit rating agency's door so that you can get a good rating on your prefs, and then this way you can sell more prefs, hopefully at a lower cost of capital. That was always the plan. It could have been, you know, now it might have, like, because of a lot of market fears and whatnot, things could have shifted towards like, hey, we need to make sure this cash reserve is always up and at all times. But I'm just saying, like, just trying to sound the bell here is just like, it's not going to happen in the long run. Like, if you are of the position that more and more digital credit will be issued, then you cannot simultaneously be of the position that this N years of dividend coverage will be maintained, where N is a constant number. Like, N has to start going down over time as more credit get issued, right? So I think that would be how I view that. I think a lot of fear is in the market right now, and the company unfortunately has to also respond to that. So that's kind of how I see like what's going on with that.
And do you think the cash reserve should be set aside for situations where companies simply don't have access to capital markets, and so it's their last resort, or to use it more strategically, like Strategy did earlier this year with paying off part of their convertible debt?
Yeah, like so this one I kind of want to take it away from just Strategy, right? Because, you know, there's companies in general that like have Bitcoin, and they can also have some cash. If a company just had Bitcoin and cash, the cash should obviously be deployed, however it is that would be most value accretive at that moment, right? And given the facts and the long-term time horizon as well, right? So incorporating all of those facts, what is the best course of action right now? So, you know, in general, that's how you should always like use cash, period. And then also, if a company had an operating business that was throwing off a lot of cash flow, and they also had liabilities that they needed to pay because they were financing their Bitcoin purchases, well, now they don't really need that cash, right? They don't need that cash to keep it to pay coupons or dividends or whatever, because they have cash flow from their operating business that they can use to pay that. So that question and the results of that question kind of change when the parameters change. With Strategy, like, unfortunately, they don't have that operating business that is able to throw off that much cash flow to pay all those dividends. So to the credit markets, it's like having that USD reserve is an insurance policy of some form. And because of that, like that's why they're stuck in this kind of situation. If they were to take that cash and deploy it, the deployment logic still is the same with any operating company. It's just whatever is most value accretive at that moment, given all the facts.
Yeah, that makes sense. And then there's also kind of the sequence of returns problem, right? Where even if we're long-term bullish on Bitcoin, outperforming the preferreds, in the meantime, we could have a very long sideways bear market, and cause kind of issues. How do you think about the sequence of returns issue for Bitcoin Treasury companies? Is the 4-year cycle over? Is kind of the other big underlying question there. But
yeah,
yeah.
I mean, sequence of returns is ultimately the main variable and question mark whenever you're dealing with any kind of leverage, right, or amplification. I know there's, people make that distinction, but for our purposes, I'll just say leverage, right? So anytime you're dealing with leverage, you have the sequence of returns. When it's margin leverage, your sequence of returns is just super time sensitive, right? It's like within a day or two. And if you're doing these kinds of like perpetual preferred equity given leverage, then you now have more time to be correct about something, and you've given yourself more time. But over this time, right, like given a poor sequence of returns, you will see the common equity get absolutely crushed. And this just comes back to what I was saying earlier, like the common equity should accurately be thought of as a call option, and that call option throws off decay of some form, like some kind of cost needs to be paid for access to that convexity. And so if you got access to that convexity for, let's say, 3 years, and 3 years, no big event happened that allowed you to profit from that convexity, well, then you would have been paying a lot. You would have been bleeding a lot, right? So, of course, your call option would be severely degraded in value. And that would be a common equity that got crushed by a poor sequence of returns. In terms of the second part of your question, the 4-year cycle, like for me, it's like I mean, I think we cannot deny that the 4-year cycle came on time, at least for the top. Like as far as like this time, it was concerned. Like it came exactly on time. Going forward, I do think like it's eventually going to fade because I don't see any like economic reason for why it needs to continue. But I cannot deny that empirically it has held up so far. If I were to guess, I would have to guess like, hey, most of the market's probably thinking that October of this year will be around where the bottom is. I don't think the bottom is going to be as extreme as in prior bottoms, right? Just like the top this time wasn't as extreme as prior tops. So that's kind of my view. It's like kind of, we'll more or less follow in lockstep this time around. And yeah, but things will be fine in the long run because I think the fundamental properties of Bitcoin really haven't changed at all. And if anything, the surrounding like political, institutional, and other kinds of backing behind it have only gotten stronger. So I think the long-term future is very, very sound. It's really these like, intermittently you have these kinds of issues. So that's my view on the 4-year. Yeah.
So on the point of cycles, there's kind of the diminishing returns thesis that every Bitcoin cycle has underperformed the previous one. And then we saw gold have a massive generational run over the past few years. And it's obviously much bigger than Bitcoin's market cap. I think it's 20 times bigger than Bitcoin's market cap. So in my mind, at least, it kind of invalidates this rule of thumb of saying, hey, the bigger the asset is, the harder it is for it to move. On the other hand, gold has been driven by central banks buying, and we don't really have that on Bitcoin's horizon just yet. We'll see how the strategic Bitcoin reserve develops. But what do you think have been kind of the catalysts for this bear market? Is it just the OG selling, or are there other macro factors that we should be looking at?
Yeah, I think it really does not have to be more complicated than OG selling. If you look at other macro factors, I think the last time we talked, we were talking about AI. Like AI can draw attention away from Bitcoin. Like, and I said, look, even Polymarket can draw attention away from Bitcoin, and all of these things kind of pool together insofar as factors that can influence how a cycle plays out. We have 3 very big IPOs, like the biggest of all time this year, right? That's going to pull a lot of capital out of assets. Whether we like it or not, like Bitcoin is still roped in broadly, largely, as a speculative asset, right? And so that is going to, new and hot and like really fashionable IPOs is by definition going to compete with that same theme for Bitcoin. So I think that's just what's been going on. But it doesn't really have to be more complex than OGs have sold, and them selling doesn't really have to be more complex than, hey, look, they've done the 4-year cycle like 3 times now, and they're just like playing in lockstep with how things have happened as they've seen it. So I don't think we need to ascribe more complex theories to that than just things are just following the prior lockstep.
And so this will come off as 2020 hindsight, but you'll hear people say, strategy, these other Bitcoin treasury companies, they were buying a lot at the top when they could raise a lot of capital, and they were immediately putting it into Bitcoin. They should have raised the capital and then DCA'd in or waited to time the market. Do you think that there's some truth to that they should be market timers, or should they be pretty agnostic as to when they're buying?
I mean, so I think there could be some truth to it, but I think the real mistake people make is that they're kind of taking on the perspective of what they should do as natural persons and then extrapolating it to how a corporation should be. Like if you were a natural person, and let's say you were just borrowing money or whatever, like you might want to like DCA it, right? And that would probably like smooth out your returns. With a company, it's not real. I don't think it's that big of a deal with a company, because at the end of the day, like they, like the less moving parts, the better. And you want to keep things simple. If your policy is to buy Bitcoin, or if your policy is to increase your cash reserve, then whatever money you have coming in would just go towards whatever standing policy you have. And then you can kind of leave a lot of like variables out of it. And I'd also propose that the flip side of this is, people are basically just talking a lot of trash during a bear market. And so, of course, every week, you bought in the prior week and this week it's a little lower. It looks like you had a terrible entry price. But on the flip side is, if this was a bull market and every week it was lower than, the current week, now it looks like he's buying below spot, right? So it's like if you just look at the perception and like did not really think too much about it, you'll always get the wrong and more biased view, and that'll always be your conclusion. But if you just think about it a little bit more, it's not really that bad. If you get the money, just use the money towards whatever policy makes the most sense for the company right now. The bigger question is like, is the money being deployed correctly between cash, and then should we even be issuing prefs at this time, or should we even be issuing common at this time? Like that's really the bigger question. I think like I would probably have liked to see the discourse more focused around that.
It seemed like the prefs STRC, when it hit $100, they were issuing more. It seems like there, as a practical matter, wasn't really a ceiling on how much they were willing to issue. And then they started trading at a discount. I've seen rumors that it was because people were leveraging up on top of the prefs to capture some spread with, margin loans on their stock portfolio or something like that. And then they get liquidated and are forced sellers. Do you think that the trading band and the communication about the $100 par value, that needs to evolve, or that there's some kind of game theoretic changes that need to be made to the instruments themselves?
Yeah. This is a great question, and it's a very, very deep topic. I don't know if I'll be able to fully cover it like here. So I think the bottom line up front is they were ultimately contending with something called the impossible trinity, right? And this is a topic that is very, it predates Bitcoin by like decades, right? It basically states that within any economic block, you can only have two of the following three things, right? You can only have either, you can peg I know it's not like a true peg, but I'm just going to use that word because that's what the textbooks use. But you can have a pegged or a fixed exchange rate. So in STRC's case, this would be the promise that it would trade at around $100. And again, I know it's not a promise, but this is like the implied. Okay, so so you have the fixed $100 price. You can have free capital flows, which means people can freely buy or sell, exit the system, which is always going to be true because it is a security that trades on the NASDAQ, right? You cannot impose capital controls there. And then, of course, you have the third thing, which is sovereign monetary policy, which in this case is just the ability to control the dividend rate. So that's the impossible trinity. Of those three things, you have to pick two. You cannot have all three. You've already said you're going to keep it at $100, so you've picked the fixed exchange rate. And you've already listed it on the NASDAQ, so you've picked the free capital flows. This means you no longer control the dividend. Now, if that's the case, then you're completely up to the whims of the market. And yeah, so if the market's going to push the price down, you will now have to raise the dividend. And there's no choice. And the only choice you have would be to compromise on the first thing, which is the $100 stated amount, like having it trade there always. So what has ended up happening? Well, I think the market, quite frankly, has pushed it down. And like you remember, I think back in, back when Stretch had first started, it was trading at around 92-ish, and they suddenly raised it like 100 basis points. Remember that? Like they raised 100 basis points to like force it back towards 100. And now we have Stretch at like, at the time they made this decision, it was like below 87, right? So below 87, they only raised it 50 basis points, right? So you can kind of see how there's already starting to become a compromise on the dividend side of things. Or the statement that was issued, might have been 2 weeks ago or 3 weeks ago, but basically it was the one where they had that new policies, like new everything, right? And part of that statement said, we will no longer raise the dividend on Stretch just because it is trading below 100. So when I looked at that, I'm like, well, this is clearly the company saying that, like, hey, look, we're not going to guarantee that this $100 fixed rate is going to hold. So this is them reclaiming control over the dividend, right? So in the impossible trinity, this is them saying, okay, I'm not going to do number one anymore. I still have to do number two, which is because it's listed on the NASDAQ. And then I am going to reclaim control over number three, which is the dividend. And that's perfectly okay. That's perfectly okay. They have every right to do that. It's their pref. It's within the rights of like the prospectives for the security. So it's fine. But I think in many ways it was needed. Like this was going to happen sooner or later. Now, the other thing is like, should we materially change the security? And I think this is probably even more interesting than everything we had just discussed because, like personally, I do think that there is room to make some changes. First of all, this is a floating rate instrument, or rather, it's a variable dividend instrument. If you look at the market for floating rate notes, for example, they tend to have about like 2-year maturity. So in 2 years, something has to be paid back. The principal has to be paid back. And then the way the coupon is adjusted is every day you snapshot the SOFR, and then you put a fixed spread over it. Okay? So the spread itself is fixed to the value of the principal, the face value of the note. And then SOFR, of course, is what floats. SOFR is the only thing that floats. Okay? So to all of these other instruments that are floating rate, SOFR is really what makes them floating rate instruments. It's by virtue of the fact that SOFR floats. That fixed spread isn't floating. Okay? If you look at digital credit, it's completely different. digital credit, it floats by virtue of the fact that the price, we are trying to keep the price stable. The price is not at $100, then we change the dividend. That's why it floats, right? So that's potentially a problem, because like it makes this thing a little too different from the others. So that's potentially a problem. Another thing is, and this part, it almost pains me to say this, because I do view perpetual duration as a good thing. But I think to a credit investor, right, the fact that something has to be repaid at some point is an anchor point on objective value. Like if I know for a fact, like 2 years down the line, I am going to be paid the principal, and like this is their obligation to do so, then I have that objective anchor point. If all I have is this promise that this dividend will be paid, but then the dividend can also be suspended if something happens. Like now you can see where, you know, to me as a credit investor, I would either have to attach a huge spread onto it, like a huge credit spread, or I would really not treat it as credit at all and treat it as something that should trade with more volatility. And if everyone else in the market kind of thinks that, you will have the volatility that we just had, right? So I think like this is a natural outcome of the economic incentives, and if we want to change this outcome, we have to change those incentives. So one thing I would like to see them at least consider is perhaps put some kind of investor put into these instruments. Okay, like if the stated amount is at $100, they could put the put at like 85, and then every 5 years, every 5 years, like let's say, the investors are allowed to put the security back to the company, force the company to buy at 85. What that's going to do is, first of all, it now creates the objective anchor point. So it kind of mimics what the floating rate note does, right? But also, you know, it keeps the perpetual duration. It's just no longer like a Macaulay duration anymore, right? It's more of a, you know, it's duration by virtue of the fact that, you know, this thing doesn't expire. But then again, if it gets putted, then it's done. So that's kind of the new game theory. And if we then look at this new game theory, as we approach that 5-year put date, what's going to happen is the price, if it's below 85, will go towards 85. And once it goes towards 85, you also have the perception that, hey, if I don't put it to the company, then I earn the dividend. And so maybe it goes to premium to 85. And if it goes to a premium to 85, they wouldn't put it anymore. They would just sell it if they wanted to get their money. You see? So I think something like that could create more stable dynamics to digital credit. But that being said, like, is it even possible to amend Stretch to that extent at this time? Like, I don't know. But I'm just saying for other like companies that might be looking to issue these credit instruments, these are things to consider, right?
So first on your point about the put, couldn't the investors overlay the derivative on top of the instrument? I think that now there are options chains on the perpetuals. Do you think that's a reasonable approach, or it really has to be the issuer to put in this protection?
I think the issuer would have to do it because the options market right now, I mean, it definitely got a lot more liquid after the sell-off, but you know, it's just not enough to accommodate the size, right? Stretch is a $10 billion notional value asset. There is not that much options trading on it, so I mean, it would be nice, yeah, it's true. Someone else could buy the put, but when you're talking like a really large scale, you know, money manager managing a bunch of money, like this is not an option for them, right? And ultimately, those are the pools of capital that we were looking for in the first place. So I think creating that accommodation of the investor put would it would probably fit that bill a lot better. It'll make them feel a lot more comfortable, right? Because then it feels just like one of those floating rate notes that they would otherwise buy. So yeah, those would be like my two addendums, right? Like, forget the variable rate that's based on the price. Just like make it SOFR plus spread. You make it SOFR plus 700 bips. That's more attractive than any floating rate note. Okay, like SOFR plus 700 bips, and then we can go from there. And by the way, if it's really SOFR plus 500 plus 700 bips, like, you will eventually get it to trade above 100. Because these things, it's not going to stay like that forever. Like, once the market like wakes up to it and they're like, yo, this is actually a good instrument and the risk isn't really that bad, it will like break the peg, but it'll go to the upside now, right? And so, of course, implied within this is also just remove your 101 investor call, right? Remove that $101 strike price to call everything back at 101. Allow it to trade above par if needed. I think like SATA did something like that. They were like, yeah, we can suggest that. But what they were doing was more so like saying, hey, like, this would deter the shorts from putting on short positions at 100, which of course, right, that's a reasonable deterrence. I just think long term, it's probably better to not target a stable price and better to just act more like traditional floating rate notes.
Yeah, and so that's a really interesting proposal with the SOFR plus. I think that makes a ton of sense. The protective put just, it sounds expensive for the common stock to underwrite that.
I think it's like this. Like, I think ultimately, with something like that, the company will not issue as much digital credit as they did right now, right? Like, imagine if they knew 5 years later, like, we might be on the hook for 85 cents on the dollar, right? Then they'll be more careful about it. But, and so what that would lead to is, A, they buy less Bitcoin in the meantime. But B, like, they probably have higher quality buyers. And this is the part where I think no one's really talking about. It's that, like, right now, I believe most of the buyers, first off, we know most of the buyers is retail. Okay, like, Strategy has their own deck. It says, like, for a stretch, about 80% retail ownership. But here's the other thing, okay? And this is the part that, like, people don't really think about that much. The 20% that's not retail, at least 6% of the 100%, about like $600 million of Stretch was owned by these DeFi protocols. Now that's probably I'm gonna assume, right, that's gonna come across as institutional. So, but like, that's institution ownership, but what's really behind it is just retail. It's like no institutions really use DeFi, okay? So like, what you really have is probably about 90% is all retail ownership, and they're all trying to do these like leveraged looping kind of things, right? And so that's the quality of the investor that you have under this current model, right? Because they think like, oh, you actually are going to make sure the price goes back to par, and you're just going to keep raising the dividend. So as long as I can like maintain this margin position, I can keep pocketing a spread. Those are the incentives at play. Whereas if you had other buyers who see that there's the investor put, they will come in and, they're not going to be the type that does those kinds of those games where they leverage loop something. And now the behavior of your investors is necessarily going to be different, right? So when you have a first wick down or something, everyone isn't getting margin called. They're just looking at their investor put and they're like, yo, like, we're going to be okay. Like, worst case, we hold to when this put expires and then we just exercise it. And that becomes the new dominance mentality for that market, right? For the market on that instrument. So I think there's something there. Like, there's something to consider about that. You won't sell as much, but your buyers will be probably quality buyers that's not trying to play these kinds of games that'll ultimately just make everyone look bad, right? Because look, if you promised that this, I know they didn't promise it, but if you're marketing it as like, hey, this will more or less stay at this trading range, then it doesn't for an extended period of time, that looks terrible. That looks awful, right? So these kinds of faux pas just won't happen as much because the investor base will be different, and I think the credit looks more like traditional credit and less like something too new and too like out there. And I think there are benefits to doing it that way. But to your point, it is going to be expensive, right? And it's expensive on the one sense because, you know, we cannot issue as much. But it's expensive on a different sense because, look, if we have to accommodate like huge lump sums of exercise, then, you know, we'll have to be much more disciplined with how we manage cash. But again, I will say, right, assuming the asset coverage is there, the exercises should never happen. Does that make sense? Like assuming the asset coverage is actually there, it will always go above 85. Once it goes above 85 or whatever the strike is, right, it'll always go above there, and it'll peak a little bit over that because there's a dividend yield in the future if you don't exercise. Because it peaks a little over that, they will never exercise because they're going to just sell on the spot market. The other thing is, if they end up having to, if investors exercise anyway, and the shares are trading above spot, you can ATM to just like raise the money and just give the money back. You know, like you could do that. So, I think I know the put is kind of, it could be more controversial, but I think if you think it through, it's like there's actually some optionality there, and the upside to it and what you gain from it could make it worth considering. So that's kind of my idea.
Yeah. Okay, just to pressure test it a little bit more, because I think it's a really interesting idea. If in 5 years you see this kind of flash crash, right, where there's stress in the market, not for any underlying credit reasons, not due to a lack of coverage, but purely because there's more sellers than buyers. Does that kind of force the company's hand when really they should have been able to ride through it?
Yeah, it does. In that case, it definitely does. Like but if that happens, right, like there's literally no problem in just selling the Bitcoin and then like meeting those exercise needs. Like there's literally no problem with that. They can also preemptively, like if it goes below the strike, like let's say we are 3 months out, right? 3 months later is going to come the exercise date. And then it falls way below. It falls to like 75, or how it fell like this time, right? At this time, the company is like, all right, so 3 months later, we're going to have to pay back 85 cents on the dollar. Right now, it's at 75. Let's just scoop up as much as we can at 75. Right? Like this becomes a, at that point, you're accretive. You're 100% accretive because you're buying something below the point where like you know you're going to be obligated to pay that money. So that would be an action to do, and this would be exactly what the cash reserve would be for, right? Like for stuff like this. Frankly, the cash reserve isn't for paying dividends because they sell Bitcoin or common to pay the dividends anyway, and the cash doesn't get depleted. So it's like this is the type of thing where you can deploy cash in like larger quantities.
Yeah, that makes a lot of sense. It's a really interesting idea. The other question I would have along those lines is, you know, the effective yield increases as the price of the preferred goes down, and doesn't that just naturally attract more investors or even just short-term traders who kind of see that it's mispriced, and so the issuer doesn't need to do anything, or do they have, again, promises made to keep it close to 100, and so they have to do something?
Yeah, so I think it's valid to assert that as the effective yield goes up, it draws in more buyers. But then I also think like that mental model only works within like your plus or minus 1.5 standard deviation type of event, right? Like once you go outside towards the tails, you have no idea what's going to happen. So this is something that we have to be very careful and precise about, because like ultimately the way normal credit assigns the value is because there is that repayment date. That's what anchors the value. If you just have an instrument that throws off dividends, but then it never has to like pay the principal, you have a situation where everybody in the market now knows that the next time I can get out and get my principal back is completely up to the whims of all these other people that are playing around in this market, like I am. Like which one do you think gives more confidence? Like the first one where like, hey, I'm definitely going to have to be repaid at some point, like 2 years from now, or like 6 months from now, or some specific date from now. Or the second thing, which is like, oh yeah, I can do this right now and it would be a high yield play, but when I have to exit, I am completely subject to whenever that future spot price is, and I have no idea what it's going to be, right? So that is clearly, yes, that could attract traders. That could attract people who are like long-term, short-term, right? Who are more short-term than long-term. But now think about it. Like if your entire premise was we were trying to sell to the credit markets, but now you're saying, hey, now we just want to attract traders who would leverage up and who would like try to go in for the high yield. Are you really targeting credit anymore? Or are you targeting people that are more short-term traders, right? Not that it's wrong to like sell instruments to short-term traders, but you know, if the stated goal was to like sell to traditional credit investors, and then in fact you are not doing it because of the way you've structured the instrument, then I think something is wrong there, right? Like maybe it's not legally wrong, maybe it's not like even wrong for the company to do that, but something's wrong in terms of like how you're presenting it, and then like what's actually going on, and there's a disconnect about that.
Like a product market fit issue, really. So this raises an interesting question, which is that rather than positioning the preferreds as better than a money market fund, for example, or kind of like a savings account where you do have kind of par, create, redeem, right? You don't have to worry about the principal. Positioning it as more akin to buying a piece of real estate, home, let's say, to rent it out, and that you'll earn the income stream of rent, which will be stable, but your ability to sell it at par is not guaranteed, right? So really the decision-making process should be about, do you want this stream of income, and how confident are you about the future dividend rate, rather than trying to worry about, can you get in and out of the principal at par? Does that make sense?
So are you asking me like
the marketing, the product market fit is of a longer duration than what kind of has been floating out there of, oh, this is like cash?
Yeah, I mean, I think if you're talking about it and like you're marketing your security as the issuer, yeah, you shouldn't use the kind of like cash thing. I think that's not the best like legally sound way to characterize it. But then also like it is hard to do marketing, and it is hard to like grab people's attention, and so I understand like there are incentives at play that just because of how attention starved everything is, right? It's just like you have to try to grab people's attention, and then you have to make outstanding statements in order to do so. This is just, I think, how things are in the social media age, right? So it's one of those things where we could wish it were different, but I don't think things would change that much. But that being said, like the larger point is absolutely correct. Like I think something like Strife, for instance, right? The most senior pref that just like it's basically a perpetuity, with of course a risk, with a credit spread that needs to be attached to it. But like that's a very good security, like all things considered. If you are truly a retiree, then you've like did your math and you're like, all right, from today until when I retire till the day I die, like I'm only gonna need this much money per year. This is how much Strife I'm gonna need to, fill that part of my investment portfolio. Perfect. Like then you don't have to worry about the price. So like, if you're truly a retiree, like yeah, there is a point to be made. Like why bother if the price like collapses below your entry price? Because as long as you're still getting paid the dividend, that's what you bought it for, right? Sure, like what's the problem? But again, like I think the pain that is felt in the market, like at least over the last month, is just frankly because those were not the buyers. The buyers were people that were leveraged long. They were probably trying to earn some like carry spread, and they're probably trying to like be the first ones out as soon as anything went wrong. And then a lot of them just got caught flat-footed, and that is how we saw the cascade that we saw. So I think that's really how it is. And part of it is also like, the super conservative investor that's just buying this for retirement, they're probably not looking at something like this that isn't rated, right? Like you just have to think that like there's just all these other variables at play, and strategy is in a very hard position to have to balance all of this, right? It's a difficult thing to need to balance everything and make as much people as possible happy. So I think that just also needs to be something that's considered, right? Like it's hard. It's genuinely hard. Not that it's an excuse for anything, but it's just difficult.
And on that point, as people kind of get more educated and see the track record for these over multiple years, is that how you change kind of the investor base for these instruments from short-term to more long-term income, or do you stick by your thesis that there needs to be product changes?
Yeah, I mean, I want to clarify. Like, I'm not saying there necessarily needs to be. I think what I'm suggesting would be very helpful. Like very helpful certainly in the next like 2 years. Long term, I don't think like these instruments are dead unless the Bitcoin thesis that we all have is wrong. Okay.
Right.
Like that's where this is all downstream from. So as long as like I think ultimately what happens is once the bear market ends and the bull market returns, like all of this stuff will be bailed out at the end of the day by the rising Bitcoin price. Okay? That's just what I think would ultimately happen here. Like we can suggest all of these things, like SAYLOR can and his team can put out these like new frameworks and whatnot, but this is all to just try to outlast the bear market.
And on that point, do you think there will be instability introduced in the bull market by people selling the preferreds to buy the common because now they think that's going to outperform, and then vice versa in the bear market, them at the beginning kind of just dumping their common stock to pick up the preferreds, and we'll constantly see this back and forth rotation? Is that destabilizing?
I think it'll happen. I don't think it'll be destabilizing. And the main thing is during the bull market, you'll just have so much more demand anyway. So, and remember the flexible load here, right? To use a Bitcoin term, right? The flexible load here is really just the ATMs. Like if a lot of people want to buy this thing, but then also a lot of people want to sell it, then the ATMs just won't run as hard. But if a lot of people just want to buy it and the demand is like gushing and overwhelming, then the ATM will run however high it needs to run, right? So that is how I think it is. Like the flexible load here is the ATM. And so I don't view that as a destabilizing factor.
Yeah, that makes a lot of sense. Allard, I've really enjoyed our conversation today. Is there anything that we missed? I want to encourage people to go check out your research report and to dig into it. But before we sign off, are there any major points that we didn't address?
No, I think we've covered a lot. We probably need like another hour or so to talk through like all the stuff happening on the protocol side. Like that's also lots of stuff going on. But yeah, on the corporate side and digital credit, I think this has been comprehensive.
Awesome. Well, thanks for coming on the show, and thank you to our listeners for joining us for another episode of the Bitcoin for Corporations show. As we travel through this bear market, I think now's a great time to be learning more and absorbing kind of what's going on. So we hope you'll join us on the next episode, and don't forget to like, subscribe, leave a review, and share it with your friends and family.
Is quantum computing a threat or is it overblown?
It's both.
I am fascinated by quantum computing.
I think there's definitely a lot of unknowns with quantum computing.
It is a theoretical risk on the Bitcoin network.
The big threat, in my opinion, is the discovery and unlocking of wallets that have been lost forever. Bitcoin is a scarce asset that you can make more of, but you can find more of it by unlocking these old wallets that could pose a threat to Bitcoin.
The quantum concept is, what do you do with the Satoshi coins if they are not quantum resistant and they don't move? It's a really interesting philosophical debate because you could argue that if quantum computing is a real threat and it can come and crack the Satoshi coins, I mean, obviously there's a probability of having a bad actor that wants to tear down the entire ecosystem, but the game theory would suggest that there's more incentive to break the Satoshi wallet, keep the coins, and build on that into the future.
I don't know what the answer is, but I do know that there are a lot of teams working on protecting Bitcoin against it. Teams like Blockstream have a lot of PhD engineers currently working on upgrading Bitcoin to stave off those threats.
I do believe that the technology, as all technology does, will progress and get better. The Bitcoin network has the ability to upgrade and change and morph, and I think that's really the beauty of Bitcoin, is that it's distributed network of nodes. Frankly, I'm currently unconcerned by quantum.
The question is still if and not when. Still, it is important to take that question into consideration and most importantly, not add changes to the protocol with rushing into a solution in search for a problem.
There are people in the Bitcoin community that don't want to see a change to Bitcoin. They believe Bitcoin will be fine as is, and it's designed the way that Satoshi envisioned, and it would be a bastardization of what Satoshi viewed if we make a change to the Bitcoin protocol.
And my view is that Bitcoin will win. Bitcoin will actually be the best prepared for the future of what could be quantum. And you have already solutions that are being proposed by the market, and the best will win. And my view is that the best will be an optional one where people can opt in over time as they perceive a potential risk.
I do understand why people have the fear. I think it's an incredibly complex topic. We're literally talking about quantum physics, and I'm no expert, but from the people that I've listened to and the people that I trust and the research that I've done, I do not think it's an immediate threat. And if it were to become a threat, there are things that the Bitcoin network can do to protect itself.
I would say the threat is less imminent than the headlines suggest, and the work being done already to address any potential threat in the future is more robust and diversified than people think. And what I mean by that is there's lots of different work already underway that they range from changing the protocol itself or updating the signature scheme to post-quantum proof signature schemes versus, say, having contingencies in plans that would allow somebody, in case in the future they need to move or migrate to that signature scheme, they can. And so there's a lot of work being done, and the community is already discussing and debating ways that this could potentially happen, but it seems like the threat is more theoretical in nature right now. And I think people underestimate Bitcoin's resilience. Bitcoin is the most secure computer network in the world. It's decentralized. And so what that means is there's a ton of eyeballs looking at this open source code. They're maintaining it, looking for vulnerabilities, making proposals. There's a ton of discussion, and that hive mind is one of Bitcoin's biggest strengths. And that's why its uptime is 99.9%. Despite it probably being the biggest honeypot for any potential attacker to go after. So I think Bitcoin is extremely resilient, and people shouldn't underestimate it.
I think it makes for a great story. It is incredibly interesting tech. It'll continue to move forward. We saw this back there with the Y2K bug back in 1999, where the world was going to implode. Technology marches forward, and Bitcoin continues to adapt for it. And if anybody's worried about quantum breaking Bitcoin, they should be more worried. Quantum will break everything way, way before Bitcoin. And Bitcoin's already adapting to it because that's the nature of open source software and something at this kind of network scale. So it's actually going to unlock incredible possibilities. So I'm not one of these people that sees the progression of tech as dangerous. I see as we adapt to it, Bitcoin, it will adapt to it, already is. The discussions are great around it. And we're going to see many, many great things unfold from quantum computing.
There's multiple attack vectors for quantum on Bitcoin, but there was even just a paper that was released a couple of weeks ago where, without even having to go through a protocol upgrade, we know how Bitcoin and Bitcoin wallets and the consensus mechanism can be completely quantum proofed. So is it a threat? Yes. Are there ways to alleviate that threat such that it will not destroy the Bitcoin network? Absolutely. Do we have to come to a consensus in the Bitcoin community as to what we need to do to protect Bitcoin? Absolutely. Do I think that's going to happen tomorrow? No, but I think we have some very smart people in the community that have figured out ways to make this work, and we have a couple of years before quantum really becomes the true threat that it may be. And at the end of the day, I'm more worried about what quantum and its threat will be on the global financial system as a whole, more so than just native Bitcoin.
Bitcoin's down 50% from the all-time high.
It's going to zero. Should we just cancel the rest of the podcast?
We got to cancel the rest of the podcast. Welcome to the Bitcoin for Corporations show. I'm your host, Pierre Rochard, and today we're joined by a return guest, Mike Belshe from BitGo. Mike, thanks for joining us.
Good to see you again, Pierre. How are you?
Very well. Very
Great.
well. We're here recording in Las Vegas at the Strategy World Conference. And obviously there's a Bitcoin element to Strategy World as well as a business intelligence technology component. So BitGo has had some great news. There's the OCC Bank Trust Charter and your recent IPO. Congratulations. We got lots to talk about, to unpack. And also I want to talk about trends in the industry, because obviously Bitcoin's down 50% from the all-time high. Sentiment's a little morose.
It's going to zero. Should we just cancel the rest of the podcast?
We got to cancel the rest of the podcast,
Okay.
or change
Bummer.
the name to AI for Corporations. But the reason I bring this up is because you're an OG. You've seen it all. And you founded BitGo in 2013 before anyone was talking about institutional custody. So I'd love to hear how kind of the founding story for BitGo and what your vision was and how you've built from that.
Well, thank you for that intro. Look, I feel fortunate to have learned about Bitcoin earlier than some folks did, but grateful and excited about what we could change from the monetary side once you find Bitcoin. So look, my background is all technology. Never had any intention to be in financial services, much less running a national bank. Yet here I am. And when I was going to college, I was studying systems. I did programming, of course. But my interest was more in how do you make the back ends work faster and more scalable. I have a lot of background on the web and things like that. But you discover money and you're like, wait a minute, how does this stuff work? And I remember seeing Eric Voorhees talk, I think it was in 2012, he's so eloquent, and kind of laying out, here's what the properties of money are that are interesting. And I think he said something to the effect of like, we spend so much of our time, so much of our money, time pursuing money, and yet we don't really know how it works. And it's so true. Most people, just this green stuff, you get it, you want more of it, you go to work and you do your thing. All right, anyway, fortunate to find Bitcoin and had this realization that, wait a minute, now we can have computers paying computers. And I had spent a lot of time on web protocols. There's a 402 payment required. Error code used to be the loneliest error in HTTP. I was in Netscape back in the mid-90s. And so I was not on the SSL team. I don't deserve credit for that. But Netscape pioneered building SSL, now known as TLS, which is how you secure web communications. And that was all done with the belief that we weren't going to be able to get e-commerce unless you had an encrypted channel. And of course, we built that, and then we used it to use credit cards. And that's, to this day, state of the art for payments. With 402 payment required and Bitcoin, finally now you can actually pay directly in the browsers. That's what got me excited. And then it is a fascinating rabbit hole, as many people call it, where it just keeps going deeper. These days, probably spending more time not so much on what's the properties of money, how do our markets work? There's a market structure bill. What does market structure mean? Most people don't know. Where we sit, we started out, you asked for the origin story, we started out, we just wanted to secure Bitcoin better. So we pioneered multi-sig, which is a protocol for using multiple keys. Basically the idea of securing large amounts of digital asset instead of having a single point of failure. I always try to break it into multiple. So anywhere you do have a single point of failure, you have more. So instead of having one key, you can have multiple keys. And instead of having one person hold the keys, you have multiple people hold the keys. Instead of having it be multiple people, you can have it be corporations, and then you have multiple users on wallets and things like that. So it's what eliminates that single point of failure, and we've been using that kind of ever since. We use more technologies. Some blockchains don't support multi-sig like Bitcoin does. I believe multi-sig is absolutely better than MPC for Bitcoin, and the reason is because it's very tried and true technology. And you can actually have two different signers, completely different technological stacks, signing on a transaction. And supply chain type attacks, you're not as vulnerable because it's two completely different implementations. There's a lot of things you can do that way. With MPC, it's a newer crypto. Most people think of crypto, oh, it must be proven to work, right? But actually, most cryptography does not actually ever get mathematically proven to be correct. Instead, what happens is, researchers at great universities do fantastic mathematics. It's complicated, and because there's no mathematical proof that it works, instead they put it out for peer review. And typically about 10 years, of peer review and getting different implementations and having people, try to poke holes. All right, MPC is a relatively new field. I'm not trying to criticize it, by the way. It is ready. But if you want to just talk about the best way to secure Bitcoin, you've got it on chain. You've got the ability to use multiple implementations. It's very simple, tried and true. It's definitely the best way to secure your Bitcoin.
And multi-sig is one of those magical properties that Bitcoin has that, for example, gold doesn't have. Like gold has to physically be in one place at one time. It centralizes to Fort Knox, right, or to the New York Federal Reserve. With multi-sig, you can actually decentralize custody and avoid that peril.
That's correct. So as examples, what we do with our own keys, we use 2 out of 3 typically, and those 3 keys are each of them 1,000 miles away from each other at all times. So we got our cold storage keys in one place, we got our data center keys in another place, we got our backup keys in yet a third place. You can also do it cross-jurisdictionally, right? So you can have one key in the US, you can have one key in Europe, you can have one key in Singapore. Again, making it so that if anything did happen geopolitically, that might make one of those keys vulnerable, the others would hopefully be able to be safe. And then with the 2 out of 3 model, we do one other thing. So just to bring it home, I mean, really the analogy that's easiest to understand is you think your safety deposit box, you've got a key, the banker's got a key. In order to get in the box, you both put the key in and you turn. Okay, so that's 2 out of 2. Now 2 out of 3 gives you a backup key. So, the problem that you have when you're trying to secure your Bitcoin is where do you put the private key? Well, by splitting it up into 3 parts and using a 2 out of 3 model, any single one of those pieces can be stolen. You still have, having lost one key is not going to compromise your wallet. the other 2 keys can still recover. So 2 out of 3 protects against both theft and loss.
And on that point about the private keys, how do hardware wallets fit into that picture and into BitGo's infrastructure?
Yeah, well, you could use a hardware wallet for one of those keys. So we use HSMs. We've been doing this probably earlier than anybody. I think we had our first HSM, I don't know, 2015 or something. We sell HSMs to some of our clients that use it for their local installs of cold storage. So those are, of course, institutional type HSMs. For the personal level, you can use a ledger or whatever for one key, and that works just fine.
Yeah. So kind of then zooming out of kind of the role of a custodian and the relationship with the clients, how is BitGo unique in the service it provides relative to maybe a traditional custodian?
Well, let me start by saying I don't even think we're a custodian.
Yes, yeah, right.
So,
right.
like, it is true that we have licenses to do custody. Yeah. So we are an OCC national bank, and we do custody through that. We have a license in Germany under BaFin. We have a license in Dubai under VAR. We have a license in Singapore under MAS. So those are custodians. Now, we built those because there weren't any banks or custodians that we could use. We started out, how do you secure this from a software technology? We added the hardware technology as well for the HSMs. That was for self-custody. But for institutions, like, they needed to use full custody. So our first really big institutional client was CME Group, probably heard of them. And we did a great engagement with them. They used our self-custody wallets. We didn't have a custodian at the time. This would be back to 2016. They really struggled. They didn't want to hold the key. They searched high and low for somebody to hold the key for them. They couldn't find it, right? And it wasn't in their DNA. So that was what really led us to say, like, okay, we just need to go and be a full-blown custodian. That was the start of it back in 2017 when we did that. So back to what's different about BitGo. The reason I say we're not a custodian, for us, custody is a means to an end, not necessarily the end. It is true. We do a lot on the security. I think we got the best security of anybody in the industry. So obviously building upon that, it sounds like custody and wallets. I think also, if you come in from any other asset class, you will find a market structure, and that market structure has a network of broker-dealers and exchanges and clearinghouses and custodians and banks, and they all have a place and they have a role and they fit in. You think of the largest custodians traditionally, State Street, JP Morgan, BNY Mellon. What they do is incredibly well known. It's been done for each one of those organizations, 100 plus years old. So the risk that they take, how they do it, it's pretty similar. Look, in crypto, it's very different. You look across the custodians, the folks that are storing this asset, very different technology, very different coin support, very different services on top. But more importantly, because there's no market structure, somebody chooses you, they like cold storage. We do cold storage, we do a great job of it, provide a lot of service around it, we do it all over the world. But then if you want to have liquidity, you have to take the money out of that custody, you have to go put it somewhere. So we ran into this problem back 2018, 2019. Market structure is what solves this. You don't have to trade off between security and liquidity. Like, why should you have to make that choice? You should have both, right? And that market structure is what gives you the fabric. So in the crypto industry, and to this day, we live on these vertical stacks of exchanges. That's what most people know as their kind of financial institutions in Bitcoin. And so the separation of these different roles isn't defined. And so you see different people doing it in different ways. So BitGo has started building that. Basically, because we started at the bottom of the stack, you can't build financial services that are world-class unless you've got a super strong foundation. So we started that. We spent nearly a decade kind of perfecting and building that. It's never perfect, by the way. Security's never done. But we built that, and then now the financial services where we spend most of our time.
So for the institutions that are using BitGo for custody, and due to the fact that they're not comfortable holding the private keys or spending 10 years building something as reliable as BitGo, they still have to hold the passwords, right? And so how do you advise and think about this with your clients of how they access BitGo and the secrets they do have?
Well, that's our job, right? So is to make that software usable, and I think that's what we've done. So when you're talking about businesses coming into Bitcoin, it's a little different than individuals. So it's your Bitcoin, you're thinking about how you're going to hold it. Is it going to be your personal? Is it going to be custodial? Then it's like, your backups and all that kind of stuff for one person. When an institution or a corporate comes in, the CFO wants to be part of it, just like with a corporate bank account.
Right.
And your controllers can be part of it. And you're going to have a few operational people that are part of it. All of these people have roles on your bank account. And of course, they all have roles at BitGo. Also auditors, people that have view-only access are also in there. So what we did is we built this role-based system. Of course, we start with the on-chain securities, this 2 out of 3 multi-sig. Then we layer policies on top of that and then multi-user management on top of that. And then in terms of how do you make this usable, it's really the policies which are unique. So in the traditional system where you're dealing with dollars or other things, those are not bearer instruments, meaning that if somebody takes them, there are usually database ways to get them back.
Reverse.
Also, when you're working with the traditional finance system, the banks have traditionally controlled as kind of access gateways, right? The entry points into the system. So even if there's movements between banks that's, an error, somebody fat-fingered something or whatever, they can undo it. Bearer instruments, not the same thing. All of a sudden, these policies matter incredibly. So all kinds of policies are possible. And what people typically will be doing is they'll, segregate their funds across different wallets of different types, different access around those, but then they set policies. And, hey, spending up to $100,000, no big deal. Just these people can authorize it and it's done. You want to spend more than that, maybe up to $1 million, 2 people are going to authorize that. So now what's happening is you're getting messages down to your phone. All right, so in addition to your username, your password, 2-factor auth, you've also got your phone, which has got, by the way, another public-private key that we're using to manage you, and it's got biometrics in it. Sometimes we rely on video IDs, more for the backup system when people kind of lose things. It's more of a human problem. All right, anyway, you can layer these things together. At this point, if you're doing a very large, if you're doing a $1 billion transaction, you can have 7 people approve this, right? And it can be these specific people, and then one of those guys, and one of those. There's a lot of configurable.
Yeah, and then is there a time element to it as well of 48 hours have to elapse after the approval so that there's opportunities to...
Those are all configurable as policies. So at this point, I think probably mostly what we do is we've recommended to most clients, and if they fit in a certain size, they have a certain set of policies. But sometimes different businesses have different constraints as well. For instance, an exchange is probably going to have some amount of real-time wallets that they'll deal with differently than they would with like their cold storage.
Yeah, fascinating. And it seems like at this point, it's almost more secure than some of the traditional financial institutions in kind of that rigor.
Look, on the digital security side, I think it probably is. Look, we have a target on our backs, and we're securing hundreds of billions of dollars. So it's a very, very serious business. Actually, one thing I mentioned in some interviews recently, it's a small one, but like we banned LinkedIn at BitGo.
Yeah.
And why? Look, social engineering is probably the biggest threat to pretty much everybody digitally, regardless of what your business is. I think I saw a report that said something like 60% of hacks started with some form of social engineering. And how does that start? Well, they look at who inside of a company might be likely to have access to something that the attacker wants, right? And so sometimes that's customer support information. We've seen that happen in a number of companies. Sometimes it's they want to get to your DevOps team, right? They want to know who's actually doing the security. So obviously, like there's a ton of security layers that we have internally, and we do that. But also, like why give people a free org chart,
right?
Where they can just find the people. By the way, so the reason we talked about it for a long time internally and didn't really want to do it. I don't want to take away like employees' ability
career development
to have their own social media, whatever it may be. But we had a new guy join in our IT team, and within 3 days he was getting phishing emails.
Yeah.
And it was targeted to him because he worked at BitGo. And it's very clear. The attackers have completely automated the process. And of course, they're trying to get in all kinds of ways. They'd love to know who your developers are, what are their GitHub accounts. So anyway, this is not a be-all, end-all. The hackers definitely have complicated database. They will find us. But we do our best to also minimize that stuff.
That makes sense. And we've also seen a lot of news stories coming out from my home country of France of just horrific, what we called wrench attacks, which is really nowadays almost a euphemism for the kind of the physical attacks that we see on people who are public about, being Bitcoiners. How do you think about kind of that physical security layer?
Well, the layers that we have hopefully prevent that. So
Yeah.
those have mostly been kind of retail type individuals. And I think what happened there actually was there was some just information identity doxing type of leaks that happened where they didn't.
From the tax authorities
Yeah.
and from other sources as well, but
yeah,
so it troubles them.
Here's your map of these people have lots of Bitcoin and here's their name of an address. And gosh,
It's because they have a wealth tax. So they itemize kind of all the assets, and that is a high
I did not know.
Yeah.
All right.
Yeah.
Yeah, look, governments do collect information. They ask companies, financial institutions to collect information. That then becomes, people in security are like, I don't want this information.
Right.
And sometimes we're regulatorily required to collect it.
Do you think there's a path? I've heard people kind of hypothesize about using zero knowledge proofs, for example, to try to minimize how much data gets stored in all these giant SQL databases while still maintaining kind of the regulatory posture.
Look, I think it's going to help. I think these solutions are coming to market now. I think it'll be good. Certainly can't be worse than where we've been.
Right.
But yeah, the wrench attacks are tough. So look, with the BitGo solution, there's typical things. There's duress capabilities that you can use. I'm not sure that those really work that well if you needed them, but we do have them. But mostly it's the policy. So by the way, something I'd like everybody to know, like you can come and you can get me. I've got access to nothing. All you will do is, cause me, I guess, a lot of pain.
Yeah.
It's actually a very important point. Like we made a very, very careful attempt. There's no collection of executives at BitGo that you can come and collect and then somehow steal the money.
Right. Yeah, that's really important. Okay, so to kind of get on some lighter topics, let's talk about kind of the regulatory landscape that's really evolving a lot with regards to banks and financial institutions. So you mentioned market structure that is in the works with the Clarity Act, but the Genius Act was passed that was related to stablecoins. Really curious to hear from your perspective, kind of why should Bitcoiners care about stablecoins, and kind of simultaneously, we also hear people say stablecoins make Bitcoin obsolete. So why should stablecoin enthusiasts care about Bitcoin?
Okay. Well, look, I think they're very different things.
Yeah.
So payments today, if you're here in the U.S., mostly done in U.S. dollars. You probably get your paycheck. You may not, but most people get their paychecks in U.S. dollars. All right. And imagine you walk into McDonald's tomorrow, and you're here in Las Vegas, and they say that'll be 13 euros, and you're like, well, I don't have any euros, and they'd be like, tough luck, you can't buy your burger. It just turns out that like U.S. dollar in the U.S. is going to be a payment system for a long time. You're required to pay your taxes in it, at least for now. It is the payment system that's used. Bitcoin, of course, could become a payment system in the future. I think right now most people agree it's kind of so small and it's volatile.
Yeah.
People would rather save it than use it as a payment. This is not a ding on Bitcoin. I think it's the state of where it is kind of in its evolution. So, all right, we're going to have payments. We're going to have store value. Bitcoin can provide one, but not a lot of the other. Stablecoins are better for payments than banks ever were. By the way, we know that banks have let us down on payments because of the existence of all these payment apps, from PayPal to Venmo to all
Cash App,
all of them. And what's happened is there's been a demand for better technology around how you do just basic payments, and the banking system just hasn't done it very well. Look, stablecoins are way better. So in addition to being able to be digital and easily added to any of those apps that we just mentioned, they can be a one-to-one backed, so there's no fractional reserve. So most people don't think about how banks work. We know that banks are highly regulated. We've probably heard the term safety and soundness of a bank, which is very important. Basically what happens is you put your money at the bank, and of course we know the bank lends it out. And the safety and soundness is making sure that the bank is doing that in a responsible way with the appropriate backstops and reserve capital, so that if you come and ask for your money right now, you're going to get it. And for the most part, it works. But it is fractional reserve, and from time to time, it doesn't work. By the way, the reason there's so much regulation in the banking industry is because there's been a ton of failures over time. Now, some of those happened 100 years ago or 50 years ago. But all of these rules have been developed to try to make sure that we don't have repeats of it. So look, with stable coins, there's no chance of that. It's one-to-one backed. So it's super easy to put these into a T-bill money market type of thing. It's very easy to audit that, very easy to see in real time. By the way, with our stablecoin, so we have a stablecoin as a service. We don't do our own stablecoin, but we're getting these things audited twice a month.
Yeah.
Show me a bank that gets audited twice a month.
Right.
Right. So, and by the way, one of those at the end of the month. The other one is a random point in time during the month, and they come in at a random point to make sure you're not like moving the money intra-month, things like that. All right. So stablecoins are one-to-one backed. They should be able to give you better yield than you get at your bank. Interestingly, the risk-free rate today is a little under 4%, and yet banks are giving you like 0.2%.
Right.
Think about that.
Yeah.
They didn't have to take any risk. It's called the risk-free rate because it's considered that the T-bill is the lowest risk, right? All they had to do was give you that, and they could give you nearly 4%, and instead they're giving you 0.2% while taking risk. All right, so look, I'm assuming that the reason they don't put it into T-bills is because they're making more somewhere else, but they're sharing none of that back. The stable coins ought to be able to give this all back to you. It should be like an ETF. So like BlackRock offers a Bitcoin ETF. They charge 25 basis points to administer that. What's that administration? Well, it's some regulatory overhead and some operational capabilities and some audits. That's basically what we do with stablecoins. We have some regulatory overhead, we have some operational capabilities, and some audits.
Yeah.
So I think 25, 50 basis points seems like a reasonable kind of fee for running that type of service. And then the rest should go back to you. It's your money. You should get, what's it. And all right, so, and then lastly, it's 24/7. Like there's no banking fees, no wire fees. We can build apps on it. It's programmatic money. So this is just a better savings bank than we've ever had before. So I think that stablecoins and Bitcoin are just, today, two different use cases. And the reason stablecoins are actually great for Bitcoiners is because it brings it into the digital era. So when you look inside of BitGo's code base, you'll basically see a big if statement all over the place. It's like, if US dollar, go over to wire system, with these, Monday through Friday, 9 to 5 and all this crazy stuff. Yeah. And then you got the digital world. Yeah. And then that's all the same, whether it's, Bitcoin or stablecoins, et cetera, we have common code there. So we're going to just build much more efficient systems, much better systems. I think it's going to actually accelerate the adoption of Bitcoin that we now have stablecoins. So you take your dollars. It's very easy to get your mental model around it. Oh, okay. My dollars in the bank are one-to-one to the stablecoin. I now have the stablecoin, which is digital. I'm now learning about how do I self-custody that? How do I custody that? How do I think about that being a 24/7 thing and what goes with it? And then now I'm going to go into Bitcoin, and it's like just a super easy stepping stone.
So stablecoins really emerged because of Bitcoin to kind of provide global liquidity for trading Bitcoin.
I think that's right.
And now I've seen it adopted for cross-border payments, remittances for people abroad who don't have a U.S. dollar bank account. But do you see it evolving domestically, where today with Apple Pay and a credit card, it feels so convenient that is it going to be an uphill battle here in the U.S. to penetrate that market?
I don't think it's going to be too bad. I mean, I think it takes a little bit of time. The regulatory components, getting the right participants takes time. There's businesses that are making money kind of doing it the current way, and they're making a lot of money. Yeah. Credit cards feel like they're free unless you didn't pay your bill every month, which a lot of people do, so they don't feel it. But you're paying somewhere around 5% on every single transaction you do, and about 2.5 to 3% of that goes to the consumer side, and the rest of it goes to the business side. Then, by the way, there's chargebacks and all kinds of things that happen, which are a secondary effect of basically this credit and not very good security behind it. So there's so much fraudulent activity, right? I mean, it's a 16-digit number that it's on a card. So it's so easily stolen that there's this chargeback system. And by the way, the regulators come in here and they say consumer protection laws. If you dispute an item on your credit card, because mistakes are made, it's not digitally verified, So the default goes to the consumer, which, by the way, I think this is a good law. But of course, in the end, you're paying for this. This is part of that 5%. So what's good about credit cards, if you do want to break it down, it's really an insurance package for whatever it is you're purchasing. Whether it's a meal that you're purchasing, whether it's a piece of art, whether it's, you know, a birthday gift for your daughter, you're paying insurance on that payment. And it's expensive, but it works. All right, so yes, I do think all of these things can go digital. I also think you can add an insurance layer on top of it.
Right.
I think it's going to be much cheaper insurance because it's cryptographically secured, whereas of course, the credit cards are trivially stolen.
Yeah, and now the other functionality of a credit card is that you get to pay the bill later, right? That you're getting extended a line of credit. Have you seen stablecoin type solutions that cater to that use case?
I haven't seen one. I haven't seen one that's happened yet, but there's no reason this can't happen.
Seems inevitable.
Yeah, and then of course you'll pay a small fee for that.
Yeah. Now, with this regulatory kind of new environment, we've seen Circle announce that they're launching their own blockchain. Tether announced that they're launching their own blockchain. Is this going to cause kind of a fragmentation of different ecosystems? How do you think about like interoperability between stablecoins and you as an infrastructure provider? You know, your role in that.
So there's a war on the layer ones,
yeah,
or competition, if you want to be the friendlier term, where different blockchains have different features, different scalability, different privacy attributes, and trying to win the general ecosystem game. And so each one of them is competing. And then on top of that, now you have some specialty stablecoin blockchains. And then the regulation that we have, which doesn't allow interest to be given back to retail, is making it so that everybody wants to be an issuer. So think about it. Like, let's say you're a bank, you've got a distribution of users, you're a believer in stablecoins as making a better product, you want to take that to your clients. You've got two choices. You can use one of the existing ones, which would be like USDC or Tether, or you can create your own. If you use USDC or Tether, your users get nothing. USDC and Tether make all the money. So instead, you're probably like, well, it's my clients. Why am I going to put it on their system? I'm going to do it. So, by the way, to some degree, the reason we're seeing this massive number of new stablecoins coming out is because everybody wants to be the issuer. You get to keep all the money by regulation. So if we just fix that, like instead what will happen is we'll have a couple of these come out. There will be an administrative fee like what Blackrock charges, 25 or 50 basis points. It'll get very big. The rest will go back to whoever the actual owner of the money is. And you won't have like all of these different things. All right, now back to the some of the features that are coming out. Look, privacy is a real issue, right? So people do want private money transactions. And today's stablecoins don't provide a lot of that. So it's an area that can be better. Also, fees are a little bit difficult. You know, most of these run on Ethereum. And then you have to pay Ethereum gas fees in addition to the stablecoin payment. So you were trying to pay $1, but it ended up being $1 plus some Ethereum. And that creates a usability experience which can be improved. So I think some of the new blockchains are trying to address those problems. They'll compete it out. I mean, this is great. Like, we have innovation that's happening, and different guys have got different answers about what's the best way to do it, and we'll see which one the market likes best.
And so what do you think that from a government perspective, what their incentives are with regards to stablecoins, and that they've been relatively, so it's interesting, I was at an FBI symposium, and I won't say who, but a representative from a stablecoin issuer was there explaining that they KYC AML the primary market, but they don't KYC AML the secondary market. But they can freeze funds on the secondary market and follow up with law enforcement and all of these topics, which some have called regulatory arbitrage, but it seems like law enforcement likes it and government likes it. And so how do you see kind of why there's this alignment?
Yeah, look, the regulators, especially prior to this administration, were very clear that you need to have freeze capabilities on stablecoins. You know, we're the issuer of wrapped Bitcoin, which is a stablecoin. Instead of measured in dollars, it's Bitcoin. Wrapped Bitcoin does not have a freeze function. And so it's unique among stablecoins in that it doesn't have that. So my opinion on the freeze function is it's a lot of power, and it doesn't seem like it's that bad. There's some good intentions for why to have it, For instance, people lose their keys, and then you can freeze the old one and issue some new ones. So there's good reasons to do that, but you're also ceding over power and basically personal sovereignty. So let's use Gmail as an analogy. You know, prior to having all these web-based emails, companies ran their own corporate mail servers. And if law enforcement wanted to come and look at your email, they had to show up with a warrant, and they had to say, hey, we want to see your email, here's the warrant, and you would fork over your, and that meant they had to go prove a burden to a judge and say that they had a reasonable cause to go look at your email. Now that it's gone to cloud-based providers, that warrant doesn't come to you.
Right.
It goes to Google. And look, Google doesn't want to fight these things. I'm not blaming Google here at all. I'm not trying to attack them. But they hand it over. Somebody shows up from law enforcement, says, I need to see these emails, they hand it over. Like, so you never got a chance to fight it. Even if a warrant has to be provided, that warrant was provided to Google. Google doesn't have time to go engage with your lawyers and say, hey, we got this warrant, is it okay? Da, da, da. So what's happened is you've given up your personal sovereignty over your email to cloud providers. The same thing is true with stablecoins that have freeze capability. Today, you got your money, right? It can be your cash, of course, that's definitely your own. But if it's at your bank, if it's at a place that you've chosen, law enforcement has to get a warrant and go to that place. Now they can go to the stablecoin issuer. They've got a level of abstraction, which is one-stop shopping, and we'll circle, we'll tether, fight for you, let you know, hey, we have a warrant for your stuff, or will they just freeze it? And of course, we know the answer is that they're just gonna freeze it. So I think people haven't carefully considered this enough. When it's for the good cases, there's good reasons to do this. People lose they lose their keys, they send it to the wrong place. There's good reasons. But what happens when there's Operation Choke Point 3.0?
Right.
Right. So what happens when they decide that certain types of payments they don't like and they're just going to freeze it? Or that happened to be a wallet that contributed something to politically was not liked. What's going to happen?
And we might think that here in the U.S. we have rule of law, so we don't have to worry about that. But there's lots of cases. And then if we go abroad, because I've heard people kind of hypothesize that stablecoins are going to enable the dollarization of foreign economies. I could imagine foreign governments not being super excited about that and wanting to use these freeze functions to freeze out stablecoins from their jurisdiction.
Well, now you get a new question. Who's authorized to issue a freeze? So if Circle is regulated in the U.S., is it just the U.S.? What happens if Europe wants to freeze, Circle in the U.S. or anywhere else? I mean, I got to believe the corporations are going to do the simple path. They're going to be like, wait, I don't want to be in the middle of this. I am regulated by this government. I operate in their business. I'm going to listen to it. So now kind of any government can make the claim. Look, these are complicated questions. And I don't know how in terms of the global dollarization, I actually do think this is a little bit true. And by the way, this is not unique to stablecoins, right? El Salvador, we talk about a fair amount. They ditched their own currency, I think, around 2000. I might not have that right. But they moved on to the dollar. And why did they do that? Well, they had a history of running their own currency into the ground. And finally, they got some leaders that said, you know what, I need to future-proof this. I'm afraid that the next leader might ruin it as well, even if we do a reset. Let's move on to the dollar, which seems stable. And so some have done that. I think Panama has done that as well. Others will do like dollar linked. So Hong Kong dollar, for instance, is dollar linked. Others are doing algorithmic stablecoins. So the UAE, the UAE dinar, I think it's called, is a combination of oil reserves and dollar reserves.
Oh, interesting.
It's a stablecoin. It's an algorithmic stablecoin.
Yeah.
All right. So anyway, these things have existed for a long time. I actually think as long as the U.S. had the most stable currency, this all works. I think in more recent, geopolitical times, the U.S. being able to sanction certain countries makes people a little bit more worried about dollars. That makes people wonder if they want to be something dollar-backed.
So let's say everybody here in the U.S. starts using stablecoins, no more bank deposits. What happens to financial intermediation? What happens to the banking system in this new world?
Well, look, I think we'll still have banks in some form, but I do think banks are changing right now, and this is not a bad thing. I think it's a good thing. So banks, when was the bank invented? I don't know exactly, but if you go back
ancient times,
if you go back 150 years, banks were very different, right? And we didn't have computers. And so this idea that you're going to, have depositors that want to secure their money, so they're going to deposit into the bank, and then people that needed loans to make the economy grow. This was very real. And so the banks provided a very local and real function in terms of, both safety for local consumers as well as making the economy work better in that region. And by the way, back in 1850, when they came in, when a bank came into an area, they would build these large, marble fortresses, and it was to show that they were there in San Francisco or wherever it was, and they're permanent. They weren't building just a temporary structure. They're coming in, and people could count on this thing because look at how big it is and look at how established it's making itself. All right, today we've got computers. Like this idea of linking the depositors and the lending, it doesn't have to be that way anymore. And in fact, it's already started to shift. So for instance, when you do your mortgage, sure, the bank underwrites it, they do the paperwork, all that kind of stuff. They have it for about 5 minutes before you're out the door. They've securitized it, productized it, sent it off to Wall Street, and now it's tradable over there. That's pretty much true for the entire U.S. mortgage industry today. Small business loans, I guess they're still doing it a little bit. But overall, can we make lending markets just completely separate from the depository? So we can take stable coins, they're the deposits. If you just want to be able to get a risk-free rate, have safe money, great payments, all your day-to-day stuff, your paycheck, etc., do that there. And then we'll have lending markets. And then private equity can come in, corporates can come in, high net worth, even individuals can come in and lend into those markets. And they're taking some amount of risk when they do that.
So then how does BitGo as an infrastructure provider kind of fit in with getting an OCC charter? And what was the impetus for that?
Well, let's see, a couple things. So we're infrastructure provider. This is money. We're sort of like SaaS, software as a service, but because it's money, there's regulatory requirements to do certain things. You've heard of money transmission, sometimes it's custody licenses, sometimes it's trading licenses, you've got lending licenses. We don't do lending much for retail, but the other three. So in addition to building software, web services, hardware in order to protect these assets, we also acquire these licenses. And then we help our clients use our products and services. So you can go about building whatever it is you're trying to do, but we take care of kind of that banking aspect of it. So we call this crypto as a service. In terms of how we fit in, because there hasn't been market structure, and I guess we could talk about like what the heck is market structure. But because there hasn't been market structure, we've been basically building it. I think we've been building it really kind of on principles. And the first principle we ran into as you get into custody is like, well, what should an account look like? What should the features of that be? I have a simple thing I've been recommending to pretty much all the policymakers. I haven't heard anybody that doesn't like this. You go to your bank, they're a fiduciary for your money. You go to your broker, he's a fiduciary for your equities. You go to your RIA, he's a fiduciary for your investments. You go to your crypto exchange, not a fiduciary.